Out of order should you do that. Now let me call the meeting to order. First order of business will be the adoption of the proposed agenda. Do I hear a motion that we adopt the agenda? So moved. Did I hear a second?
Second.
Okay. Any discussion? All in favor say aye.
Aye.
Ayes have it. May 23, 2013 minutes. Do I hear a motion that we adopt those? Okay. Hear the motion. Is there a second?
I'll second it.
And a second. All in favor signify by saying aye.
Aye.
Ayes have it. This is going to be a long meeting today, so forgive me for if I rush too fast through anything. Everybody let me know. First, I'd be remiss if I didn't welcome Rebecca. I welcomed her quietly, but Rebecca Gunlinson is our newest commissioner. This is her first official and full commission meeting. She's already been working as a member of the Global Equity Search Team. Jim Powers was on that since she replaced Jim on the commission, and they were in the process of getting ready to start a search. I don't know if you were starting one or finishing up one, but anyway, Rebecca jumped into the breach, and they will have a report for us later today as part of the meeting. Also, Jim was a member of the board of directors. The commission's appointment as a member of the board of directors, and Alan, correct me, is the name of the company CRT? Is
CRT.
CRT. And I'm recommending to the commission that we appoint Alan Gillespie as our designee on the board of directors of CRT. I'm asking you to ratify my appointment of him. I don't know if y'all have had a meeting since Jim's departure or not.
They're in the middle of a corporate transaction, so we're not quite sure what the board structure will look like when that's completed, correct?
Right.
Commercial? Yeah.
So the goal is that Mr. Gillespie, Commissioner Gillespie, would take Mr. Powers' role, assuming that board seat is still available. So I think that it's prudent for us to go ahead and make that determination.
Okay, and that's my recommendation to the commission.
Do we all know what CRT is?
It's a company we own an interest in. Alan, tell us brief the commission on CRT.
Yeah, so CRT was a broker-dealer firm, that Aquiline, in conjunction with Aquiline, and then we made a direct investment into it. So it's a broker-dealer firm. Obviously, that's, I'm in the broker-dealer business. I'm licensed any number of ways, so I think I'd have a pretty clear understanding of, both the business plan from day one, but also kind of what they're doing and what they're trying to transact.
Seems to be a very natural fit for his skill set.
And Jim had been on the board since we had the ability to appoint a member.
Yes.
And I think Alan would be precisely the right person to replace him. Do I hear a motion to ratify that appointment?
So,
Is there a second?
can we also get a list of all the board seats that we have available?
Staff can furnish us one, but yes.
Thank you.
Derry, if somebody will take care of that between now and the next meeting. All in favor of Alan's appointment to the board of CRT signify by saying aye.
Aye.
No, I'll abstain for the record.
Ayes have it. The schedule of the commission meetings for the next year is on the website somewhere. This is a matter of information. They're subject to change it at the vote of the commission, but that's unless there's a suggested change now or question now, that's what the commission will be working off of for the next year through November of 2014. Okay. The commission evaluation is as part of our governance policy. The commission has to evaluate itself annually, and the mechanics of the evaluation. Each commissioner submits a confidential vote on various what I call the scorecard items and their opportunities for comments, etc. The particular commissioner's votes, comments are confidential, but the overall report is something the chairman is required to give to the commission. The grading scale was just like we're accustomed to in college. I guess they haven't changed it since I was in college, but it's a 0 to 4 grading scale. So a 4.0 would be perfect. Our GPA for all the questions was a 3.22, which is a solid B. Whenever I'm looking at grading things like that, I like to throw out the highest score and the lowest score to see if there's some anomaly in it. If you do that throughout, that doesn't create any material difference in our grading. It's a 3.35 instead of a 3.22, and it didn't materially affect any particular grade to any particular question that was asked either. So I think we've got a statistically reasonable self-grade of 3.22, a solid B, as I said. The volunteered comments on the grading sheets, the ones that would affect more than one isolated opinion, would be that long-term and strategic planning needs more attention. Having taken that to heart, have some ideas about long-range and strategic planning and how to redevote our attention to them, and we'll be discussing them with staff in the next few days and with the consultant. We've already had a discussion with the consultant, and I hope that we can all address that. Some of the reason we haven't done that is it was event-driven. That we had a chief investment officer search and a chief operating officer search, and I think our attention was put to those things more so than long-term and strategic planning. And my desire to avoid some unfortunate meetings led to that too. But I think we need to do that regardless of whether it's easy or not easy. And it does appear that from the comments that some of my efforts to promote collegial and harmonious and efficient commission meetings have resulted in perhaps in too heavy a hand on the agenda and things like that. And so I've tried to loosen that up, and you see the result of that in the revised agenda and motion protocols that you received as part of the lead up to this meeting. The comments about the intra-commission relationships are predictable, and those that you would expect because we've all heard them before, so I'm not going to dwell on those. The other comments I received about past performance is that our investment returns are impressive for a widely diversified portfolio, and that we've had terrific success with our wise selection of the chief investment officer and chief operating officer. There's some feeling that we may not meet often enough, that quarterly may be insufficient, but that was counterbalanced by some comments that said that we have enough special meetings that maybe that's not a real concern, but that is something that us more than one or two commissioners felt that we needed to make sure that we meet appropriately often enough.
But just on that subject, Reynolds, is that something you need to? Yeah, just on the subject of more regular meetings, is that something we need to discuss and arrive at a decision as to whether we actually would like to have more meetings, or we feel that the present schedule is sufficient?
Well, I think we can always discuss that. The consensus seemed to be from the comments that that's just something that could get out of hand, and just make sure in fact we do meet often enough. And if anybody feels like we're not, I think the thing to do is at one meeting make a suggestion that we have a meeting different from our next schedule.
I think maybe the first step would be to have a suggestion from staff as to whether they feel that present schedule is sufficient, or whether they'd like to have more commission meetings.
Yeah.
There really is a balancing act here that has to take place, because I think from a commissioner standpoint, more meetings is desirable, but from the staff standpoint, they spend lots of time getting ready for these meetings, and when they're doing that, they're not putting as much time on the main mission of investments. Is that a fair statement?
And there's an expense factor associated with the meeting also.
There is, and I think it's really wanting to balance out the number and frequency of meetings that, I know when I first joined the commission, they were pretty much monthly, and then it seems like they staggered out, but what you would do is leave one commission meeting, have about a week to actually go do work, and then the next couple of weeks was just really preparing and getting all the information ready for the next commission meeting. So I do think you want to be balanced with the timing of those meetings.
Can I make a suggestion? I mean, I was just thinking on this question in the car coming down, right? I mean, from what I've heard from staff, one of the reasons why the public meetings are so difficult is because everything that goes up there now becomes a public document and subject to agenda protocols in advance and documentation, right? And we talked in the past about sort of staggering operational meetings, where we're dealing with administrative types of stuff from the investment stuff on alternating months, and that never quite seemed to happen. But I was thinking maybe if we, I don't want to say went for a 2-day meeting, but started late the afternoon one day where we just handled any sort of operational types of things, and carried had the next day be the investment meeting. I do think we could do some investment stuff that don't necessarily have to deal with kind of the current portfolio, but rather outlook stuff. And the only reason why I bring that up is I shared it with the treasurer, but Stanley Druckenmiller's kind of been all over TV, and I think his comments related to the new Fed chair and QE are definitely worth considering, understanding, talk about, having a plan, right? That I think is, and then we talked about the rebalancing issue some at the audit committee. Those are topical things that won't necessarily lead to an action or a decision that in the direct context, but I think it would be important for us as an organization to discuss. But that was just some ideas I had, that if we started late in the afternoon before and we did all the operational stuff on one day, and then carried over to the next day to the investment stuff, maybe that was a way to knock it out. Because otherwise I feel like people get tired over the course of a day, and some stuff that needs attention doesn't get attention.
So, Alan, you're suggesting that we would have one specific segment to focus just on investments?
Yeah, I was thinking like if you look at a lot of this stuff that's on here, it's more operational. Like audit committee, the retiree appointee budget, type of stuff. I mean, if we could probably handle most of that stuff in an afternoon, right? Like if we'd started yesterday afternoon, right? We could address it, and then today could be the investment stuff. So I don't think it would necessarily create more pressure on the staff in that regard, but I think everything would get its adequate time.
Well, I think you make a good point, because I think going forward, the whole investment climate is going to be very, very important in terms of our decisions, in terms of asset allocation, and I think to be fully informed on the whole investment climate, I think, and have a good understanding of the Commission as a whole as to what the climate is and how that should relate to our investments, and particularly how the staff feels about it. I think that's a good point.
Going back to what we talked about a minute ago about strategic planning and long-range planning, I'm hoping that in November a significant part of that meeting will address these kinds of issues, investment issues, long-range planning and strategic planning. And I agree with you. I think we ought to get that sorted out so we can spend more time on investing. Let me read verbatim the comments of one commissioner that I think are very thoughtful, that relates directly to this issue. I was going to read them later, but here it goes. Even after the distraction of the past couple of years, I'm tremendously proud of the 7.5-year body of work. I'm most proud of the staff that has been assembled and the ability of the senior staff to hold things together. My one greatest concern is that we may have, or being dragged away from, common sense toward an incredibly cumbersome process-driven environment in which many cases process has trumped common sense. I hope that at some point the Commission can regain its footing in this regard. And I think the comments you made talk about us regaining our footing on considering investments. With that, the other areas of concern that they felt like we ought to address are reporting, asset allocation modeling, building out our risk management function, our IT capabilities, monitoring our risk profile, and make sure that we have candor and accountability at the commission meetings and address items that are of concern, like business people, and not in anything other than a professional manner. That concludes my report, I believe. Is there anything else on there?
Ratify assignment.
Can we ratify the appointment of Rebecca to the Global Equity Manager search?
So moved.
Second.
All in favor, say aye.
Aye.
Ayes have it. And just as an aside, since we have one new commissioner and there's a chance we'll have another new commissioner after today's meeting, then in November I plan to present a recommendation for allocations to the standing asset class search and monitoring positions. But it didn't seem to make much sense to do that at this meeting and then redo it in November. Let's just do it then. That concludes my report. Alan, you have an audit committee report for us?
Sure. Since the last time we met, audit committee actually has met several times. Among the things kind of discussed, documents have been posted to the watchdogs. But most recently we reviewed and discussed the new swap rules. Currently we have no exposure, so hence it's not applicable to RSIC at this time. However, we want to make sure we have processes to monitor it should we become subject, should something we want to do in the future involve the new swap rules. So RSIC ops due diligence will review on a go forward and ongoing basis should our activities change such that we would become subject to the new swap rules that came down. We've received several updates on the Deloitte risk assessment progress dashboard. Progress is being made in the over the last quarter in the following areas. Fully completed. We did enhance and engage. Well, I don't know if it's been engaged, but enhance legal resources to expedite contract processes. Tasks which are still in progress. Some on the operational infrastructure side. Scoping out the private market system needs. Risk management function. There is a risk management RFQ that's been completed and issued. That was in August. On the compliance side, we have coordinated and distributed and received back RSIC's first manager compliance questionnaire and certification. That was completed in August, and I believe we had a 100% response rate on that, which was good. We've worked on the budget requests. We have worked on documentation of all different policies and procedures, specifically legal sufficiency policy, desktop procedures for internal management. We've looked at rebalancing, questions of the rebalancing. Kind of what our policy is, how it affects different items from compensation to operations. We received annual compliance certification report. All managers responded to that, 70 in total, and that was certified as well by our consultant. Topics covered in that questionnaire: regulatory oversight, internal compliance procedures, conflict of interest procedures, legal terms, back office policies and procedures. We received the investment fee report. It has not been reviewed and discussed yet at audit committee, but it's on the agenda for the next one. That data came in. We have completed some other matters which I can address in closed session because they're still open and involve some of our investments. So we have some activities there, and there's another report which is being finished up as we speak related to a PIC audit. Don't know if there are any questions, but that's kind of high level, quick, what audit committee's been working on.
One question. I understand that from the notes from the meeting that sufficient progress has not been made toward the goal of providing a complete and accurate number for the total investment fees for the 2013 for the inclusion of the CAFR. Are we going to miss those dates?
My understanding is Andrew or Monica here.
Sarah, do you want
Yeah.
to speak to that?
Certainly. Mr. Treasurer, it is our plan to include 100% of the fees in the financial statements this year.
And just to put that, our audit report's a snapshot in time. So we started that audit before June, I think
Yes.
it was, before June. So they have made significant progress since then, but we take a snapshot in time, so.
So we won't make the state's CAFR, but we'll make our financials and the PIBA CAFR.
It's our intention to put it in the PIBA financial statements.
And that rolls
We are
up into
doing
the state
everything
cap.
within our
Gotcha.
power to get
Okay.
100% of those fees
Good.
in.
Thank you.
It said that it couldn't.
Any other questions for audit committee?
Thank you. Good report. Herschel, Chief Investment Officer's report.
Thank you, Mr. Chairman. We have several items today. I wanted to introduce several personnel, several new hires, give an overview of some of the initiatives that we've been working on per the AIP. I'll have Mr. David Phillips give a performance update, as well as Mr. O'Connell from HEK. And then back in April and May, there was a lot of discussion around the classification of hedge funds with respect to low volatility and what that definition was. So we'll have an update, an informational update for the commission on that. Then several matters on the SIOP for clarification and a couple of amendments there. And then several manager recommendations for global equity and then one private equity. So that will be the things that we talk about next, and then we'll turn it over from that point in time. One of the things I'd like to do is introduce 4 of our new staff members. First, there actually were 2 interns that have become full-time employees, Steve Marino and Justin Young. I think they may be here. So there's Steve, and Justin is not here. Steve, actually, both of them were actually USC graduates. And Steve actually was an acquisitions analyst at Airgas and did financial analysis at Colonial Life as well. Justin was a prior intern who left the organization and went to Bridgewater for several years, and left Bridgewater and then rejoined us here on the staff. Also, we have the area of risk management, Senior Risk Management Officer Wei Ning. She joins us. She has a master's degree in financial engineering from the University of Wisconsin, and her latest role was risk manager for the equity portion of Stark Investments multi-strategy hedge fund. Also, we've added another intern, Andrew Campbell. Comes to us, graduate from the USC Business School, Charleston School of Law, so he's a law degree as well, and he will be working with Adam on the strategic partnerships, on the coverage there. So as we think about those new employees, and then how does that fit total organizational-wise with respect to the investment team, with the 5 new additional members or team members that we can hire for this fiscal year that were approved, that would get the investment team up to 23 people total. Currently 17 filled position and 6 openings. 3 of those 6 are actually replacements, and then there are 3 more that were not hired yet for the new allocation. So we're working on those right now. Those openings for the manager due diligence area would be a senior credit officer, senior private markets officer, operational due diligence officer, and then an analyst. With the research function that's led by Mr. Phillips at this point in time, we're looking for a senior officer, research officer, excuse me, and an analyst. So those are the open positions currently on the investment team. But one of the things I did want to update on is the initiatives that we had from the AIP, and start with the asset class initiatives and then go into more of the organizational type initiatives. The first is global equity, and we continue to make strides there. We'll make a couple of recommendations here today with respect to how we're restructuring that portion of it. And the idea is that we're going to continue to simplify from the number of managers, which tends to mean that you're going to actually end up with higher allocation to certain managers. Within the U.S. and the international or IFA part of the global equities perspective, where most of those assets will be passive. We're going to maintain an active exposure at the emerging markets level, as we believe that the inefficiencies in those asset classes still provide opportunity for excess return relative to those benchmarks. So we'll have some of those recommendations here a little bit later today. Within the core and global fixed income portion, we'll come back in November with a proposal to actually revise some of those manager guidelines. And the idea is that for The core and the global fixed income managers, we want them to be closer to the benchmark. So they have fairly standard guidelines that allow them to go into credit in other areas beyond sovereigns. And the way we have the new allocation with the breakout of credit as a separate sub-strategy, we want to make sure that those managers are taking the risk there. But then with the core and the global fixed income, that they're much more closer to the benchmark. So we'll come back with some recommendations with respect to that. The diversified credit, we're overweight a little more than $1 billion right now. So we're going to be making some reductions and recommendations for that in the coming future as well. Ideally, we would like to continue to keep a mixture of floating and some of the shorter duration strategies in that area as well, and some exposure to more of the idiosyncratic, opportunistic type investments as well. With that said, within that space, we're slightly underweight emerging markets debt. That's an intentional underweight. But with that said, we only have 2 active managers, and about half of that is through passive exposure. Hedge funds, as we've talked about as part of the AIP, is that we are unwinding the portable alpha strategy. So that entails selling down a significant portion of the hedge funds. The approved maximum allocation to hedge funds is 15% for this fiscal year. We're currently at about 17.7. So in dollar terms, that's somewhere around $800 million of hedge funds that we need to sell just to get back to that 15% target. The expectation as we continue to optimize that allocation is that we'll see the total hedge fund allocation fall even further. And that in itself, with what we're doing from converting from the portable alpha strategy to actual physical funding and global equity, what you'll see is there's about $5.5 billion of notional for the overlay right now, and about $2.5 to $3 billion of that will come out. So the overlay itself, the Russell overlay, will get much smaller. With respect to some of the other new initiatives, the internal management and research function. The key areas we continue to work on there will be more policy development with respect to derivatives policies, desktop procedures, soft dollar or commission management, broker selection policies. Currently, we're managing cash and short duration strategies. We have the authority to manage core fixed income. Currently, that's not being actively managed. There are 4 residual Ginnie Maes in that portfolio right now. They're being monitored, but we're not on an active basis at this point in time. Suggestions will be coming up for updating some of the accounting systems that we're currently using right now. The whole idea is to go away from a dual entry manual system to much more of a straight through processing. So again, that in itself will require usage of some of the new approved budget, as well as going through the procurement process, which typically will mean RFPs. Risk management, we just talked about our new hire and some of the build out we have with Wei Yi and some of the work she's doing. And actually, Mr. Phillips will show some of the reports that she's been working on and creating since her short tenure here. It's an area that's of great concern to us because we want to continue to build this out, not only from an enterprise-wide perspective, but then thinking about drilling down from some of the remaining issues from the Deloitte report, as well as taking a look at the investment risk. And that actually ties back into a lot of Mr. Gillespie's earlier comments with Stan Druckenmiller and some of the concerns that are out there. And then also operational risk. So one of the things that we thought would be appropriate would be sort of a mini survey, if you will, or quiz of the commissioners to identify what are the key risks and things at the top of your mind, culminate that into a report for November, and then actually prioritize those and start addressing those directly one-on-one and check them off the list. Strategic partnerships, the Commission is well aware that we continue to consolidate those, reduce the number, and that we're in the process of some of the investments that are being kept will be transitioned out of the partnerships, and then the partnership vehicles are being closed. So later today we'll have an update on the progress for strategic partnerships. Part of that is that with certain partners where we've been successful with co-investments, we'll begin to take a look at those again in the future. So that concludes really my comments, and I'll pause there before we turn it over to the performance update.
Thanks for your conversation yesterday about Russell, and I'm going to look at Russell from a lot of different standpoints. As you know, we've got a reporting issue, and thank you, Suzanne, for your help. Is Russell considered internal management or external management?
I consider him an external manager because we're not managing the assets directly. It's a directive to Russell.
So anybody that we give very specific guidelines to, once we give it to them, we say, we don't, we haven't really taken responsibility. That sounds pejorative. I don't mean it that way, but once we give someone very specific guidelines like Russell has, I mean, I think that's far more specific than our average manager. We would just consider that up to them. I mean, is there? I'm not explaining myself. Well, I'm sorry, because you answered a different way than I thought you would. I'm concerned that I haven't really talked to a commissioner that understands Russell particularly well, and it bothers me because, you know, we look at this reporting, we got some anomalies in reporting, we work on those. Can you explain a little bit more about that and how tight the parameters are? I know that you said 6 or 8 times a year you'll pick up the phone, you'll talk to them about that, and I'm sure there's other communication too, but you give them very specific instructions. Well, what type of instructions have you given them? Is it more of a computer type of model, like maybe they do it in Charleston at Citibank, or can you just explain to me?
Sure. Well, I'll give you some brief comments, but because of the audit committee discussion of the overlay and Russell, and I think these discussions here, it sounds like that maybe for November, we should add that as a discussion topic to the agenda to go in much more detail. The overlay started with a transition management plan for when the commission, before I even got here, to actually help them transition from the old portfolio to the new targets. And there was a systematic rebalancing put in place that Russell took those targets from the commission, and it was systematic and methodical to actually rebalance, I think it was either monthly or on a quarterly basis, to get back to the eventual policy target. Somewhere mid-2009, that transition or systematic component was stopped. That basically the rebalancing of where you want to get back to for your target allocation at the commission level was accomplished. At that point in time, the overlay was converted from more of that systematic perspective to an overlay management program directed by the staff. And it's to help to reduce transactions costs, because if you need to actually allocate from, say, a credit manager to a fixed income manager, you would actually go out and sell those securities and have to rebuy them, so there can be a lot of transactions cost. Or you could actually implement that portfolio risk exposure adjustment via the overlay program. So that's one use of it. Say, for instance, if you terminate large cap equity manager, you're bringing those securities and selling them into the market. Russell can help with the transition of converting that to cash and help minimize some of that market impact cost. With that said, as they're selling down that portfolio, they can actually put that exposure back on in the derivatives market to help you stay in balance with your overall asset allocation. So those are some of the key things that they're working on. With respect to the communication with Russell, it's much more than 6 or 8 times a year. Typically, the number of trades directed is about 6 to 8 times a year. So the margin requirements at Russell, we don't fully collateralize them at Russell. We only put up the required margin at Russell. And the idea behind that is we would rather have them send us a call for margin, and we'll send more cash to them as opposed to give them all the cash. And I think that's much more, but you'd see that in any investment organization to help protect and keep control of assets. So,
Well, I appreciate that in November. You know, no matter how we looked at the reporting, there have been some substantial losses in that account over the last 5 years, and it would just help me, one as a commissioner, but two as custodian. We got to figure out the reporting part of it. So thanks for that offer.
Absolutely. And with respect to the losses there, I think as you pointed out yesterday, it was roughly $1 billion since inception of that account. And if you go back and think about that, the initial notional value, going off memory here, was $10, $12 billion into the sell-off, the financial crisis. And as the transition of actually going from synthetic securities to physical funding of managers, you're selling into that downturn and then buying. So that in itself will explain a bunch of the losses itself. So with that said, it's still $1 billion, but it's not that. But it's a market exposure effect as opposed to Russell's done something wrong.
Yeah, no, I never thought it was.
Yeah.
It's just, I mean, it's investment risk. It's what we do.
So,
Thank you.
absolutely. Mr. Chairman, at that point in time, if there are no other questions, I'll turn it over to Mr. Phillips for performance update.
Hey, now let me know if, make sure you can hear me and everything. I'll try to do the best I can from the on the void up here. So my remarks are going to cover the fiscal year period ending June 30. Starting with slide 2 here. These are the market returns, our benchmark results for the fiscal year rated from best to worst. 3 observations from here: double-digit returns from the domestic and international equity categories, private equity, and real estate, much as you would expect in an economic recovery type of environment. Single-digit returns in the middle of the stack here from opportunistic credit category. Less impressive returns here than we've seen in the past, but that, again, is equally as expected coming off of the severe distressed levels in that category where we actually benefited quite nicely over the past several years. Then emerging markets, just below opportunistic credit category, both equity and debt. It's interesting to see the positive numbers here given the drawdown that these markets experienced during the first half of the calendar year this year, the second half of our fiscal year. So slide 3 in the top red box here, actual plan performance. The plan returned 9.99% for the fiscal year, which was 186 basis points ahead of the policy benchmark at 8.13%. Bottom red box, a couple of observations. The best performing asset classes for the plan, domestic equities and international equities, combined for 22% allocation, significant allocation at the plan level. Then alternatives as a group, private equity, private debt, real estate, and hedge funds combining for roughly 30% of an allocation to the plan, also returning among the highest performing classes for us. The worst performing classes, commodities and investment grade credit, both negative for the fiscal year, but we note here that this only combined for 5% allocation of plan assets. For duration was the largest fixed income allocation at 13% for the year, and it returned 1.5% as an asset class. So 2 numbers here, just for some adjustment and explanation in this. This report, as we publish it and transmit it to you guys and to the public, this comes directly, for the most part, from BNY Mellon, our custody, and effectively our official books of records, if you will. So there are 2 accounts here, or two classes, if you will, that require significant internal analysis to break out the real impact and everything. And those are, one, the Russell Overlay Program here at 40%, and the cash and other at -5%. So on the cash level, just note here that this includes both an operational expense as well as an investment category rolled into one number. And then adjusting for the Russell Overlay Plan, this Russell Overlay Program, this actually added roughly 1.2% to the plan local for the fiscal year. Slide 4, not too much time on this one. This is, going back to Herschel's comments on transition planning, this is last year's allocation policy. So the only thing I note here is roughly 1/3 of this pie chart is a fixed income, which produced the single-digit returns that we showed earlier for the year, and 2/3 in equity and alternatives produced very good returns for us. So slide 5, on page 5, very high-level consolidated view of plan dynamics here. We paid net obligations of $985 million during the fiscal year and earned $2.5 billion on investment returns. Breaking that out, there's 2 negative contributors for the year in the investment category. One, as I mentioned, is the commodities, a negative $31 million contribution. And then the other is the investment grade credit, which is actually rolled into this fixed income component that overall was positive, but it was one sub-asset class that was actually on an absolute level negative to the fund. The other thing to note here, equities and hedge funds were the most significant contributors on an absolute dollar basis. And I mentioned, just going back to the previous slide, I mentioned the overlay component, which was positive, and a cash and other, which this is actually a plug figure, but overall on the investment level, cash returned 11 basis points or so for the year. Slide 7, we start to compare actual results by asset class in the dark blue columns, bars, to the policy benchmarks, which are the shaded bars here. So on the left, again, going back to the total plan results, the 9.99% versus the benchmark, policy benchmark of 8.13%. And then going from left to right, we rank plan returns by each asset class from best to worst. So on the left, in the left circle here, we've got domestic equities and international equities. The domestic component exceeded 25% returns, and both large cap and small cap outperformed their benchmarks. And the EFA component we had high teens type of number of returns. I believe it's around 17% or so, but it did lag its benchmark. I circled emerging markets, equity, and debt here. It's interesting to note that both of these categories were positive for the fiscal year, even considering the drawdown that we had for the second half of the fiscal year in those categories. And then, as I mentioned, both commodities and investment-grade credit here were the two components that on an absolute level were negative contributors to the fund, detractors from performance, and they both also underperformed their benchmark. So slide 8 is a different perspective of the same information from the previous slide. This is the difference in the two bars on the prior slide. So this gives us a snapshot of implementation decisions and effectiveness. At our last update, we had two categories that were underperforming their benchmarks, so they would have been in this negative category here. This slide, bringing you up to date since May, then we have 5 underperforming asset class relative to their public markets components benchmarks. I'd just make a note that overall on slides 7 and 8, this clearly is not the same picture that we presented last time. As I mentioned, we only had 2 in the negative category last time, but we also noted that was an exceptional outcome at the time, and we didn't expect it to hold. Nevertheless, we are very pleased with both absolute level returns from our allocation decisions here, as well as our implementation decisions within each asset class. These are nice results. So slide 9, if you recall from the last meeting, we showed the top and bottom contributors across the entire plan, and we had mixed both public and private markets allocations in the same rankings, which we thought at the time, and particularly on reflecting that, distorted the rankings a little bit. So what we've done this time is separated public from private markets allocations and try to provide a bit of a purer comparison. So we start here with the public markets, top and bottom 15 contributors to the plan. Several notes. One is this total of 50 accounts represented here. Bottom 15 on the right side and the top 15 on the left side. On the left, takeaways here are both high returns and significant contributions from the best performing allocations. Concentrated in equities, hedge funds, and high yield categories. And then on the right, we would note that, again, with respect to the allocations, lower allocations for the lower performing strategies and managers, which again is reflective of some good decisions, I think, from the staff. Only 5 of the 15 on the right are greater than 1% of the plan, versus all but 1 of these on the left are greater than 1% of the plan. And 9 of 15 on the right had negative contribution, and those were primarily from fixed income, emerging market, equity, and debt strategies. So sticking with public markets, this is contributions from all public market allocations greater than 1%. This is 28 accounts. It represents over 50% of the plan. Only had 4 negative contributions from this list of allocations. They were BlackRock, Bridgewater All Weather, Mondrian Global, and Jameson. They were all fixed income oriented account or allocations, which has been a challenge to say the least in the past couple of years. Switch over with the same perspective on private markets. So I'll note here that these contribution analyses that we do put up here are time-weighted basis, and they're not IRR-based, which are the more appropriate and applicable, especially for private market types of analysis. So, we have alternative preferred ways of looking at this, but to keep all of it on an apples-to-apples basis, we're using the time-weighted numbers here. So 2 observations. This is 53 accounts represented or summed up in 2 best to worst boxes. Only 2 of the 53 are negative contributions to the plan for the fiscal year. And we'll note on the positive side that our strategic partnership relationships are well represented in that category. Continuing with private markets, similar approach. Here we just list the largest 20 allocations of private markets. So if you recall, private market policy allocations total to about 21% from a plan level target, and this list represents 12.4%, so it's just over half of all of our private markets allocations. In 20 in the top 20, in the largest 20 allocations or accounts. So this list sums to 12.4%. Only 1 of the 20 here had negative performance, and thus negative contribution, and it was the Alkaline 2 account. So switching topics to risk metrics, update on risk metrics for the plan. If you'll recall from the last meeting, we presented year-over-year comparisons of some of these metrics. We're presenting the same metrics here, but just in a time series format to try to discern some trends and show the effect over time. So the top red box, we note generally that the decreasing plan volatility from over the period, measured on trailing 3-year basis. This is a result from both market environment and lower risk profile over the time period, as well as diversification efforts at the plan level in our allocation. Bottom red box, we note risk attribution is still predominantly centered on equities here with the 70.3%. So rolling forward, a new report and tool that we have, Herschel mentioned earlier. This is a relatively new perspective that we implemented several months ago, and we've started to incorporate this into our discussion in internal investment committee decisions. So this is using a July 31 snapshot version, just to kind of maintain some continuity with the timing of transition from last year's policy to this year's policy. The top red circles here, estimates of expected return and risk for both the policy and the plan. And so based on current over and under weights at each asset class level, we are expecting a higher return at 6.89 versus 6.54 for roughly the same level of risk or volatility. Then in the lower red circle, the middle part of the page, again, this corroborates the Goldman Sachs report from the last slide, showing that the majority of both our risk and return is coming from the equity category. These numbers in expected return here would sum up to 6.89%. So this is a contribution of each asset class to the total number. Same with volatility rolling up to 11.62.
How are you driving that forward return estimate for each of those? I mean, are y'all taking real markets and discounting back, like a futures market and discounting back, or a futures market and discounting back, or is it?
HK actually updates it quarterly, those capital market assumptions, and so we're actually pulling the quarterly forward-looking assumptions into that, this as opposed to actual, say, a real-time snapshot of the past trailing 36 months or what have you.
Right.
So it's those updated forecasts.
From HEK.
HEK.
Right. But y'all aren't trying to discount back from a market variable like an options market or anything.
Right.
And I believe that concludes my remarks. Be happy to answer any questions.
Suzanne, would you mind commenting on where, go back over y'all's process, how those numbers are derived since they're feeding into our report?
Sure. Brady. So we have a whole team that does nothing but this, so it gets a little complex. So when we're trying to do our capital markets assumptions, while we do update them quarterly, they're based on long-term market expectations. So what we are doing is looking at what are the readily observable elements in the marketplace that might define that. So dividend yield, inflation, current yield curve, et cetera. And where that's projecting the returns to be and pulling it together that way. We update it quarterly, not because they materially change quarter to quarter, but because you do get obviously different market input to that. What would you add to that, Brady?
I think the only thing worth adding is that these inputs are the same that we used in the asset liability study that we just did, so it's consistent with that.
Except they've been updated quarterly from,
yes.
Yeah.
Right. And one of the things that flows through here, why the numbers may not look as robust as one might hope, is that our inflation assumption continues to be low right now. So it's about 2.3% currently. So that flows through a lot of these expected returns.
And I believe it was 3 that the actuaries, or 3.25
right.
the actuaries used. So that 60, 70 basis points difference will explain, some of this as well. Of being 6.5 as opposed to, the target of 7.5 from the actuary perspective.
But anyone that's interested, we have a paper we put out every quarter that has detail on all of it, gives all the data. So it's always on our website, but I'd be happy to send it to anybody that's interested. So if it's something that you'd like to see that you haven't. Pardon?
Do we need a login on the website, or is it just public?
No, it's we always post our research and our current market views on our website for anyone to look at that wants to. So please.
The ER, is that the period of time that's projected or estimated over the next fiscal year? Or what is that? What's the time period?
1 year.
1 year period, right.
Yeah, one of the things, if I may put this forward, Mr. Chairman, is kind of based off some of the comments I'm hearing today, and I know that historically at some points throughout the year we would have the 2-day meetings. One would be commission meeting, the other day more educational or markets-based. And if it schedules permit, then maybe we should consider that for November and think about certain key topics that people would like to dive a little deeper on. And then, say, for instance, these reports or these assumptions we're using, we can actually give a presentation of walking through, here's how we're deriving these numbers and how it's feeding back and how it's populating this report, or, the overlay component, or I actually think it'd be great if we could somehow get Stanley Druckenmiller down here to give his perspectives, because I know he actually gave a speech on entitlements as well, which has made you think a lot. So I'll just put that out there, and if the commission desires that may be a good time, then we can think about getting that coordinated.
All right, well, with the committee's permission, the commission's permission, we'll just spend a few more minutes on performance. I think Mr. Phillips hit all the most important points, so I'll just try to add a slightly different perspective and maybe point out a couple of things that will impact the universe rank. So Mr. Phillips didn't quite touch on that, so I'll spend a little more time. A lot of numbers on this page, but some important things that I'd like to point out that will perhaps put the peer ranks in perspective. It's a interesting, as it always is, time period that we're looking at. If you look at the 1 year period towards the top, the S&P 500 and the Russell 2500 up over 20% for the 1 year period. If you look at private equity during that same time period, up only 13.8%. Hedge funds up 7%, commodities up actually down -8%. And real estate up 12.2%. So if we look at how alternatives have done during this period when equities have rallied significantly, they've generally disappointed on an absolute basis. If you look out over longer time periods, though, we think this is perhaps more indicative of what we should expect over a longer period of time. So going out to the 10-year period, U.S. equities up between 7 and 10%, depending on if you're looking at small or large. hedge funds up pretty modestly, between 3 and 6%, but depending on the benchmark. Real estate at 7%, and then private equity at 13.16%. So as we look at your peers and how they did, particularly over very recent time periods, because of how strong the equity markets have been, more specifically public equities, how much you've had in U.S. stocks has really dictated how well you rank within that universe. So just wanted to plant that seed before we move on. Maybe a couple of quick comments here on the target asset allocation. So as we sit here in the room, we're under the new target in September, but the reporting through the end of the second quarter does use the old asset allocation target. So just a note on that. Because we round to one decimal place, our return looks a little better than Mr. Phillips, so we're showing a 10.0% return. I think one of the takeaways here is just looking at over the longer time periods. The 5-year number still does include a lot of the global financial crisis, and that is having an impact on the 10-year number, but the 1 and the 3-year number is certainly showing a bit of a rebound, and a strong absolute return and relative return. So the little green bar is the margin of outperformance, and that's positive across all time periods with the exception of the second quarter. And I'd like to focus my time here, and it's unfortunate because this is a very busy slide, so I'll try to hit what I think are the most important points for the Commission. If we look at just your rate of return relative to peers, it was a poor 3-year period. So we talked about outperforming the benchmark, but if we look at how you did relative to peers, another measure of performance, it was disappointing looking at strictly return. So we're showing your rate of return during the 3-year period being in the 88th percentile. The policy benchmark is if you would have just invested in index funds across your target asset allocation, that was even worse. But when we combine that with the standard deviation or the risk of the portfolio over this time period, the picture changes a little bit. And the reason I wanted to point that out is because a lot of the efforts in the asset allocation discussion were focused on providing a superior risk-adjusted return. Now, what does that mean exactly? We've included here a measure of risk-adjusted return. So the Sharpe ratio is the return minus the risk-free rate divided by the standard deviation of returns. And here the story is a little bit different. The Commission's Sharpe ratio ranked towards the top third, so 34th in a universe of Sharpe ratios. The benchmark was just below the median. So if we factor in the observation that the portfolio was very low risk during this period of time, the risk-adjusted returns look a little bit better than simply looking at absolute returns. It's a similar phenomenon over the 5-year time period. And just to put into perspective what all these different dots are, so I'll go back. We've shown them in a universe distribution here. We've plotted them on a risk and return chart to show you where your peers show up over this time period for the annualized rate of return and standard deviation. So I think it would be helpful to spend some time on what the average peer has done. And so we've tried to summarize that here. A lot of the peers in this particular universe, and this is the Boney Mellon universe of public funds that are greater than $1 billion in assets. The average fund had a much greater allocation to equities than we had. So you can imagine during that period of time when public equities are up 20%, private equities only up 13%, hedge funds are very modest, commodities are negative. Being skewed towards alternatives had a negative impact. And the alternative allocation here, we ran into this issue when we were talking about asset allocation. There are many different ways to define the term alternatives, and Suzanne is working on a plan to remove the phrase alternative investments from our lexicon, but we haven't gotten there yet. So just to give the Commission a little more information on how we arrived at that 24%, that includes a 5% allocation to hedge funds, 2.7% to commodities, 6.8% to opportunistic credit, and then 9.6% to private equity. Now, that commodity number includes the investments with managers as well as the synthetic exposure that comes through the Russell overlay. So they provide some exposure to the commodity portfolio. So that's how we arrived at the 24, and using that convention, looking at what the average peer does, they're essentially half that. So over this period of time where the 3- and the 5-year number is being dominated on the significant rebound in public equities, an alternatives-heavy portfolio does not look favorable. Now that begs the question of what we think going forward, and if you'll recall from the discussion of asset allocation from earlier this year, we do expect those to provide a higher rate of return than what we expect from the public markets going forward. So we're still comfortable with the target that we had shown earlier in the presentation. So I know you've got a full agenda, and yes, sir.
When we do this this is obviously an exposure basis. How do we pick up the exposure on the other side? I mean, we're going to have 24% in alternatives here. The bank says we have 40-something, and the accountants, the CPA that does the external audit is going to say we're in the 40s or 50s. Yeah. So, it's a real problem. How do we reconcile all this?
Well, that's a good question. We could try to adopt one convention of what is alternative and what is not. I think, when you went down the list of all the different people that have to define it, it gets difficult to get all those people on the same page. And we also have to deal with the fact that when we try to look at what your peers are doing, we're subjecting ourselves to Boney Mellon's definition and perhaps even the definition that those peers use for what is alternatives and what is not. So maybe the note of caution when looking at peer data, and I've spent a lot more time today talking about peer relative performance than we normally do. I think what Mr. Phillips focused on is the most important, how you did relative to a benchmark. Because when you look at peers, some of the data is, we don't have exact details, directly from all your peers on what they did. So, we question the data, and we have our own unique circumstances here. When we did the asset liability study, you may remember, we set our target asset allocation based on what we thought was best suited to meet our long-term obligations. You can imagine that some of these peers who may have more fixed income have a different funding mechanism, different funded status, so may have an entirely different investment objective.
And, I thought we kind of moved past these things, but unless I'm mistaken, the Boney definition is the Boney definition. Is applied across their universe. And we're not at 24, the rest of the peer is not at 12% in exposure, and that's actual. So we're just, these are apples and oranges. And I don't care if we have 100% alternative as long as they work. I don't care. But I don't think that we should be comparing apples and oranges here. I'd be very surprised if those are the very same. We were exposure clearly, and over the last couple of years, I'm pretty sure 12% is the average in actual asset allocations by these other funds. And sure, they have other ends in their mind, but we don't care about that. We're just trying to, as far as I can tell here, we're just trying to say, what do we have and what do they have? Yeah. And I don't think this does it. Okay. And while I'm on that, we've got several other things here, and I want to get with Herschel or Derry and meet with John about reporting, because some of the Bank of New York figures just don't match y'all's, and some of the Sharpe ratios and others. So they're significantly off. So either y'all are doing a lot of change to them, or there's an error.
Yeah, we will make an adjustment for a number of factors, one of which may be fees. So when we get the raw data from Boney Mellon, oftentimes it's gross of fees. So if we compare a net number to a gross universe, it can be misleading. So that's one.
Well, things like trailing 5-year, Boney has at 61%, and Boney has 85. Y'all have 61. So there's some significant differences in the Sharpe ratios, standard deviation, just all across the board. And if they're just reporting anomalies, we need to straighten those out, and I'm more than happy to do them because I'm agnostic about how they end up. I just want to make sure we got a lot of these problems going on. We've got to fix it.
Okay. Yeah, I mean, we'd be happy to figure out the source of the differences. Just let us know. And
our staff would be happy to work through that also. We should communicate on those issues outside the meeting and work to figure out what the differences are.
Say that again, Darren. David Stevens. I couldn't hear.
No, I said we should communicate outside the meeting on what these specific differences are, and the staff will figure out, why there are differences and which numbers, more appropriate. I think in our meeting yesterday, you pointed out that, you had some problems with the Boney report information. They probably need to correct. So I think it's good that we talk about these and come to a consensus set of data.
I'm sorry, David.
For purposes of this chart, Brady, what the assets that we have here are included in alternatives, 24%, are they the same group of assets that are included in the 12% for the average asset allocation?
we've tried to do that for the most part. Now, it gets complicated. So we've tried to make it a little bit simplistic, just to show the point that we're pretty heavy in alternatives relative to peers.
Now, the definition that, say, the outside auditor used for alternatives, would that 12%, and ours would increase, obviously, with what the outside auditor says are alternatives for purposes of their review. If you use that definition, would the 12% also go up? You know what I'm saying?
Yeah. That's I don't have a good answer for that offhand, so I'd have to follow up on that.
I think one way to look at this is what we've got here is a pretty conservative interpretation of alternatives. So if you erred on the side of including less, that's what it would be. And we did that because that's what we've seen people self-categorize in these universes as. So I'd be the first one to stand up and say, yeah, your alternatives allocation's higher than that. But what we're trying to do here is just give you a sense of how you differ from the peers. We're not trying to make a comment on your alternatives allocation. But what the main issues I think we're trying to get across are you've got at least double and maybe more than the average plan in alternatives, just depending on how you count it. And the equity allocation, which has been the real driver for this past year, is materially less. And that's what's driving a lot of these peer comparisons. So that's what we're trying to get at here, but we're probably confusing the matter a little bit because alternatives here, the way that it's being counted is different than what we usually do.
But it does bring up the point that we do have, I think, systemic and serious reporting problems, and they have evolved from the way the Boney account has been set up over the years. And as we try to bring all that back into one central focus, we're finding errors all over the place. And I spoke with Herschel and Derry about it yesterday, and they're more than happy to work. And I think you guys will be an integral part of it. And I was in New York on Monday and spoke to the bank. But these errors manifest themselves a lot of ways, like the Russell thing. I mean, that could be a terrible hindrance or help, depending on how you look at it. We just got to figure these things out, and they're the years and years overdue from being repaired. But I think we've got 4 interested parties now. We'll certainly supply the energy.
Yeah, I think here is the last place I want to discover errors in our report, so we'll work with you to, to figure that out.
Because they're just all over the place. That account was set up improperly, and we're going to be finding problems for a long time. And until we all work together, it's not going to.
Can I ask one more question? This is just, sure. It might be a stupid question, but when can we expect, our returns, just sheer returns, they lag our peer group. And it's based on the allocations and based on our allocations going forward. But what would the market look like when those are reversed? What's the market going to look like when our returns will exceed our peers because we are in the asset allocation we're in?
Yeah.
When can we expect?
So
you know what I mean? When
no.
See the fruits, I guess. How bad does the market have to get before we flop?
Yeah.
And we're leading the peers in returns, just sheer returns.
So that's a common question that I get, and I, to this day, do not have a good answer. The real answer is it takes a full market cycle. Now, what we've seen over the 5-year periods, we picked the bottom of the global financial crisis, and we've just gone up in terms of equity market returns. So that 5-year time period is probably not fair. What I'd like to see is perhaps a downturn, so that we've got a rally and a downturn over which to judge the performance. Because right now, anything that isn't publicly traded stocks over this particular time period looks good. But if we would have started this process in 2003 and we had a 10-year time horizon, the number may be a little different. It just so happens that the new investment strategy was implemented during the global financial crisis and its recovery. So given a market cycle, which is an ambiguous term, but maybe another 3 to 5 years to see an up and a down.
Let me add to that. I think it's really important to understand the peer rankings. You have to be careful with them. And I think everyone's heard me say that, so I won't repeat all that. But the real focus is going back to why are we structuring the asset allocation as we have structured it? And that links back to the asset liability study. So there's actuarial returns set by the General Assembly of 7.5 that's used to discount those liabilities. It's approximately 4% or $1 billion a year of a net difference. So there needs a high need for liquidity that has to be there. On a market value basis, we're 56% funded. You've got some 18% contribution rates. So it's thinking about how do you balance a portfolio of trying to be risk-seeking to get that return, maintaining enough liquidity to pay out that 4%, and trying to be in a position that if you do have another 2008, you minimize that drawdown relative to a more risky portfolio. Those are all the things we're thinking about when that asset allocation is designed. Now, the flip side is you can say, well, our job is to really focus on just investing and try to decouple the thought process from the liability side, but you don't want to do that, in my opinion. Because you could go the more aggressive portfolio and take the stance that, we need to make up a lot of ground from the asset side, so let's actually take on more risk. The downfall of that is if you do experience another 2008, then that 30-year amortization period, you're already at it, and those contribution rates are going to be forced to go up significantly. And that's the big concern, is there going to be the ability to actually meet those contributions.
Absolutely, I completely agree, Herschel. You've got to keep the liabilities in mind. I'm not suggesting or questioning the thought process. At some point, though, it has to show up. If we never earn more than the peers, then perhaps we estimated wrong.
Well, if I can touch on that, that's why I think the Stanley Druckenmiller video is so good, because essentially what he says is, look, all these markets are being subsidized very heavily because the Fed is printing $1 trillion a year. Now, nobody knows when that's going to end or how it's going to end, right? But he literally says he thinks the ultimate outcome will be a negative, just like Fannie and Freddie lost more in their last 2 years than they cumulatively had made. Right, that's essentially what he says, and he says he thinks that repricing will happen immediately.
At that point,
he thinks it's going to be like 87, essentially, is what he said. It's not going to be like 08.
Our allocation
will be like 87.
We would be prepared for that.
Better
based
prepared.
On our, I understand.
Still get hit.
Let's be
But
clear.
that's where
I think there's
we benefit from our allocation.
There's a difference in a modest drawdown, recessionary contraction type drawdown that I think this portfolio will give you a lot of balance against.
Yeah.
Versus, I think, we're Stanley Druckenmiller, that you're talking Armageddon.
Right.
I shouldn't say that. Very dire circumstances. And at that point in time, you're probably just going to make sure you want to have Smith & Wesson and Campbell soup.
But what we always end up with is we end up with a conversation of execution versus theory. And I don't think anybody would regret or lament the theory. And I think everybody here understands that. We've all studied it, and we probably exercise that in our own life. There are lots of theories out there, but this is the one we picked, and I don't have a problem with it. But there's an execution problem, and that's where when we bring up execution, we get into all this other things. But it's really not. I mean, what we're talking about is how do we make sure that we are at the best spot we can be for this allocation. And there is tremendous change going on. Some people will just call it a distraction, but there's tremendous change going on, and you're at the head of it. And you've got this whole operation, and a lot of consultants and other folks, the managers that we trust and use, and from how we're managing strategic partners to the whole investment setup to these audits and the fiduciary audits and hiring of a COO. I mean, it's a huge change, and we act like none of that's happened. We act like, this is our allocation, this is our theory, and anybody who says contrary. But, even today, I mean, everybody who says contrary is wrong. But even today, if you read this carefully, y'all are making substantial changes. We don't advertise them as a change. We just we call them re-rationalizations and things like that. But I think we should celebrate the changes, and we should celebrate where we're headed. I think we've got new consultants, and we're using them. I think y'all are listening to them, and it's a back and forth. But I think we need to get out of the dynamic that if somebody, I think David, who has to deal with this, I mean, he's the guy who's got to write the checks. If when you ask those questions, you get the theory back, and that just puts us in. It puts us in a spot where we can't talk about what we want to talk about, which is how do we help? How do we manage this process where we can make sure the retirees get the most bang for their buck? And so, the theory is good, and I think does anybody object to the theory? Anybody in the room? I don't think anybody does. I think you and Bob helped put us on that, and the commission. And some are now gone, like Powers and all. But I do. There's been a lot of subcurrents here today. I mean, like peers. You hadn't heard us talk about peers in a long time. We made those points. We're trying to move forward. But our reporting now is reflecting what was going on a year ago, talking about peers. And I just want to make sure that we know we have moved on, and that what I can do as a commissioner, or what I can do as custodian, is make sure that our underlying information is correct. Because I don't have a lot of confidence in it. Mr. Phillips mentioned that we were the book of record and we're the custodian. We had asked, and I'm sure that Mr. Phillips just never got the letter, we had asked that certain disclaimers be placed, and they're going to be placed. We're trying to be gentle about this, but the bank is in agreement. Our contract, the present one, the older than that one, and the new one, is always going to say that they're not responsible as the custodian of the assets not in custody, and they're not the book of record. We call them that. We've chosen to call them that. And I think that's a fiction, and I'm going to stop that fiction. I would like to put the processes in place where they can be the book of record, and they can be called with certainty and clarity our custodian. But that's not there yet. I mean, we're working there. I think everybody's working together. But we need to make sure that our language is appropriate. And in this reporting, I think it's important that we ask that those disclaimers do get placed on, and we'll get back with you because I don't think you even knew about it. We'll get back with you about that. But these things are important, and especially in the process of how we get the information to y'all. That's it.
Before we return to the agenda, let me both recognize and welcome Senator Kevin Bryant, who's here. We always welcome any elected officials, and they get to see how we conduct ourselves. And we actually, ultimately, we're working for them. So thank you for taking an interest. Getting back to the agenda with the hedge fund classifications.
Thank you, Mr. Chairman. With this, I'll give some brief background, and I'll let Mr. Phillips walk us through the analysis that he and staff worked on with HEK and give the results of that analysis. And this goes back to the February proposal of the new asset allocation and the descriptor of hedge funds, low volatility hedge funds, and what does that really mean and what that definition is. And then staff, along with the HEK, followed up in April and May with some discussions on what that is, and then promised to follow up with a study of looking at the hedge funds of how would they come out of that classification, or those definitions, how would they actually be classified. And this is a result of that study. And Mr. Phillips and Brian Moore and some others on staff, along with our friends at Hewitt, have put a lot of work into this. It's very data intensive, and I'll let them present the results of their findings.
Thank you, Herschel. So we talked last time about the hedge fund definition, so I'm going to kind of, in deference to time, we covered that in the previous meeting. There were a number of criteria that had been met in order to be classified as a hedge fund. So we've gone through that exercise with each of our allocations to anything that could possibly meet that definition. So from that point, we've got two categories, or two branches of the process, if you will. If once it's decided that it's a hedge fund, it has significant intentional beta to a traditional asset class, being equities or credit, then, or commodities in this case, then we will classify that strategy or that manager or that fund in the appropriate traditional asset classes. So the results of that are we had 3 funds classified as a global equity that are hedge funds. We have 9 funds which are in the mixed credit category. There are no funds in private debt or emerging market debt, and we have 1 fund in the commodity category, and no funds in opportunistic GTAA category. these were the ones from our policy directives, policy targets that are allowable to hold hedge funds, if you will. So that was the result of the first pass, the ones that did have this intentional beta, and I'll go into some metrics here in a second on that. The second branch of the process, if it has actually a low beta, and we put a limit of maximum of 0.40 to the equity benchmark, or to the fixed income benchmark, to the commodities benchmark, or we do have some esoteric, if you will, strategies that really don't fit in anything. So if they're in any of those categories, then it goes into this hedge fund low beta category, which is really the only remaining, I guess, asset class of hedge funds that we have from a policy perspective now. And there are 23 that we considered as the core components of that category that came out of that process. So once we get this populated with the 23 core pieces here, we put some parameters around how we manage this bucket as a sub-portfolio as a whole. So, just to be clear, any one of these funds, may be kind of toeing the line of any of these metrics, but once it's included in this fund from a portfolio management perspective, it has to still fall into this category. Still has to meet these broader parameters. So, as I guess a proof that we did everything correctly here, the low beta hedge fund category, the one that has the 23 core pieces in it, the trailing 3-year beta low versus both the equity and the fixed income benchmark, and very low correlation again as a group to both of the benchmarks. Switching to the equity hedge funds, or the hedge funds in the equity category. So there was 3 funds that we classified there. Those funds collectively had a higher beta and a higher correlation to their respective equity benchmarks. So thus the classification in that category. Similar results for the I believe it was 9 funds that were in the mixed credit category, traditional asset class. Very high beta and a reasonable correlation, or R-squared metric to the benchmark, which is the 1/3, 1/3, 1/3 benchmark identified here below. The actual analytical detail is provided to each of the commissioners in the commissioner content on your protected site. There was some sensitive information there, so we did not put that on the board, but you have the granular detail if you want to refer to that. So I'll stop there. Is there any questions I could answer?
Can we, I know it's in the minutes, but that hedge fund definition, do y'all mind just putting that definition back up on our web portal, please? Yeah, I saw it and I couldn't remember what they were, but I know they were in the presentation from the last thing, but it was in the book. If y'all could just pull that one sheet out as a standalone, I think it would help.
I won't pretend to recall all those definitional components, but as I recall, there are 8 out there, and if you meet 5 of the 8, then it's a hedge fund. But we'll pull that up there for the commission. Okay. If there are any further questions there, the next item for discussion on the agenda is what we've termed as SIOP matters. And the first one, there are 3 here. One is referencing the equity benchmark. The other one is, or other 2, one is actually an amendment with respect to in-kind transfers, and then the third is strategic partnership oversight and roles and responsibility for Hewitt as it relates to that. So one of the things we actually wanted to clarify for the commission, and if need be, there was a motion I know created for this, but it's to make sure that everyone did recognize and understand that for the global equity benchmarks, we're using the net of dividends indice as opposed to the gross of dividend indice. And the reason for that is in non-U.S. jurisdictions, you are taxed on dividends, and the recapture of that is going to be less than 100%. So that's very standard benchmarking for the industry to use the net indices, and just wanted to recognize that for the Commission's benefit and see if there were any questions there. And if need be, we do have a motion if the Commission feels more comfortable making a motion and formally approving that.
Do I hear such a motion? Second. It's the motion in the package.
The first page?
It's what? Is it in our written package?
Yeah. Yes, sir.
Written folder. Do you see it? Where's your motion sheets? Oh, here we go, right here. That one right there. It makes sure that the Vogel asset allocation benchmark is net of fees, net of taxes.
Dividends.
Net of dividends and taxes.
Oh, then I would second that.
He seconds it. All in favor, signify by saying aye. Aye. Ayes have it.
Is that unanimous?
Yeah.
Thank you for that. The next item is one that Mr. Feinstein had pointed out to us, and that we feel that the SIOP may not have been clear enough here with respect to the delegation of authority to staff as it relates to in-kind transfers. And let me just take a moment for in-kind transfers. What you sometimes find with your private equity investments is once that they have taken a company from private to public, they may end up with a larger quantities of shares than they wish to keep. So as opposed to liquidating and converting it all to cash, they may return cash plus some shares to you. And so those in-kind transfers or listed securities are on exchange. And then what this is saying is this gives the authority to staff to be able to take those in and liquidate them over time and convert them to manage the in-kind transfer. And this is just cleanup language to make sure that the Commission is, one, fully aware and that authority is delegated. So.
Any possibility you get back private securities?
From a contractual perspective, the LPAs, we push that back because getting a private entity we don't want that. So.
What other types of not easily priceable could we?
We avoid them. We do not. We structure the LPAs and things like that. And most of the LPAs will actually have language that they're not going to distribute that because you get into a lot of shareholder rights and purchase rights and things like that. But once it's listed, then the transferability transfers to the owner once they're in-kind transfer. So I'm unaware, and I would ask maybe Suzanne or even Dave Klauka to speak to, I'm unaware of any event where we've had a non-public distribution or a private distribution.
Because like they could have you take something
Anything we receive back from private equity firms in terms of an equity distribution is usually publicly traded, and you can trade out of it through the public markets.
The other thing that does occasionally come up, do you have anything in there to restrict, because I don't know the answer to this, real estate property to be coming back? That could happen through some of the debt vehicles. I didn't know if that has been constrained as well. That's the one potential that could come up that I've seen a couple funds struggle with over time.
We haven't had that experience.
We haven't had that experience.
It's very rare.
Will we have a value statement? Say we get a strategic partnership that's breaking up and there's side pockets that nobody wants. I don't know what happens to that. I mean, that's way above me. But if we ended up with something like that, will we have a valuation of it, or would we peg the valuation and put that in the file? How would that play out?
Zombie funds.
The deal was that type of a distribution from a strategic partner, and we would be in much more control to eliminate or stop that, because that would have to require a vote for a partnership to actually be able to transfer that security to us. So we would not actually accept that. We would have them work it out and continue to do the valuation work from a strategic partnership perspective. A private markets investment, again, we try to do everything we can contractually to keep it restricted, that the only type of in-kind transfers that we would take would be, or distributions back would be, cash or publicly traded securities. So that's an issue or an area that we want to avoid, is putting ourselves to be the valuation experts on say a piece of real estate or a sliver of owning of a real estate.
So if we ever did have something like that, we would have a valuation from someplace. It would be the LP.
Go out and hire a valuation expert, whether it's a Duff and Phelps or someone to actually go in and value that asset for you.
So on the valuation policy, which management, RSIC and people put together, so if somebody's not eligible for practical expedient, additional work has to be done to document it. So there's a specific section of the valuation policy that talks about it. It doesn't pinpoint that it has to be independent valuation firm, but you think that's the way people at RSIC would tend to go.
And if we did have that instance, we would definitely be notifying the commission immediately, because that would trigger the need to go out and hire independent valuation expert.
But the way our agreements are drawn, that wouldn't be a problem. We'd be getting back a publicly traded security, and we can just look up the price, right?
That's what we try to do, absolutely. You can never guarantee everything, but that's where we're.
In this last tag on the proceeds of settlement, security, class actions, or other litigation, is that because of something coming out of bankruptcy court and we're getting some sort of replacement security that's effectively new, or?
It could be.
All right.
And so a little bit later on, there is a discussion of securities litigation, and so there are some little small pieces there that we've had to clean up, actually. So.
What have we done in the past with any kind of distribution? Have we liquidated them, and this is just to make it formal and part of the official process?
Right.
We took some stocks the other day, or a month ago. That wasn't though?
We did.
Yeah.
There were 2 positions that were distributed from a private equity firm, and so the staff actually is taking a look at those positions themselves and are liquidating as timely. So.
I can't remember. Have we made a motion on this?
We have.
Okay.
Not yet.
Is somebody ready to make a motion?
Yeah, I think it's what they do.
We've discussed it. We technically should have had a motion already, but let's, can we do the motion now that we've had the discussion?
I'll make a motion.
Okay. Is there a second? Rebecca seconds. Any further discussion? All in favor signify by saying aye. Aye. Opposed, like sign. Ayes have it. Unanimous.
Thank you. The next order is the HEK Strategic Partnership Oversight Review. And one of the things that we wanted to do for the commission is we know that, at one point in time there was 14 strategic partnerships approved with potential capacity of $15 or so billion. A little less than half of that had been committed. And then earlier this past year, the commission had NEPC go in and conduct a thorough review of all those partnerships, and then that culminated in a report that was delivered back, I believe, September, almost a year ago. One of the things we wanted to do is, because that there is a delegation of authority from the commission to the CIO and the deputy CIO to make investment decisions within these partnerships, is to make sure that the commission was comfortable with the actual roles and responsibilities as it relates to Hewitt and their involvement here. And going back through some of the policies, it was, I think, actually quiet in the SIOP. It didn't necessarily refer to it. And then the AIP had just a small piece of a language with respect to investments, as it said something I think the consultant would review. And so what this was is actually, Suzanne pointed this out, and we actually think it's a great idea to actually outline for the commission what the intent of their role as it relates to strategic partnerships would be. I'll leave that opening there, maybe turn it over to Suzanne if she wants to make some additional comments.
Sure. It's a pretty brief memo and really just tended to be informational, but also to answer any questions that folks have or any concerns. I should point out that this memo was primarily written as it relates to our role in new investments being made with your existing strategic partners. So, for example, when Apollo might come and recommend an idea along with staff, and where we get involved. So I'd say that the key difference is that there we are more of a resource. We are not, we don't necessarily have a yay-nay vote. So we want to make sure that was really clear to everyone, that we're an engaged resource. We want to understand it. We want to point out concerns, pros, cons, constructively have dialogue with staff and the manager and help the process any way we can. But what we don't have is a vote, I guess, a yes or a no, and I think that is completely appropriate. This was intended to be a delegation to staff and with your strategic partners. Now, there is one element to this that's really not in the memo, and that is, what if we had a big concern? What if we talked with staff and we talked with the manager, we said, we don't think this is a good idea, this is not good, but they're going to go ahead anyway. What would happen? I just thought it'd be useful for you all to know that if we ever found ourselves in that situation, we don't anticipate it ever happening, but should it ever happen, we would feel it our obligation to go to the chair and the audit committee just to say, hey, we've got a concern here, and we just want to make sure that others are aware of it as well, because at the end of the day, we do work for the commission. So that's how we would operate should we find anything of concern. Have never found anything like that, but I think it's maybe just a helpful to know that we're out there making sure that we're comfortable with the investment thesis and the managers that are being used as well. Also, as it relates to our ongoing monitoring of the strategic partnerships, we're involved there as well, and I didn't really talk about that in the memo, but it occurred to me people might think that's all we do with the strategic partners. We have sat down with every single one of them, gone through what they've done over time, where they've made recommendations that haven't been approved, those investments that have done well, those that haven't, and we feel very comfortable with the strategic partners you have in place that are going to be with you on an ongoing basis. So we report on their performance in our private markets report primarily, because a lot of these are private investments. Some of them are in the general performance report or rolled up, but we go line by line item in the private markets report, so all of them are in there. And we do consider that part of our monitoring responsibility. But as it relates to a yay-nay vote on selection, we just want to be clear on what we do and don't do. So any questions, I'd be happy to address.
Something you said a little earlier, something about you've come across some things that were not approved?
Within the strategic partnerships?
Yeah,
absolutely.
I'm sorry, in the strategic partnership.
Just because a partner puts forth an investment,
yes.
we don't automatically do the due diligence. That investment has to come back through the internal investment committee to get a yes vote. If it doesn't get a yes vote there, we don't do the deal. So we haven't done all the deals, and I think that's what she was referencing.
That's exactly it. Thank you. And it was done to try and see how rigorous the process was.
I just wanted to clarify the point that no approvals are given without nothing goes forward or is done without our approval. So is that?
Well, we have approved the delegation of authority to the CIO to cast our vote.
No. When I say us, I mean.
CIO deputy.
Nothing got forward without their approval.
Yeah. In other words, our partner in the strategic partnership does not have a unilateral decision.
They absolutely do not, and there actually has to be a unanimous decision. So if there are three partners and myself and David Phillips, there's not a situation where we can be outvoted or have something forced down. So it has to be a unanimous decision or the investment does not get passed. And we felt that this was actually, to go through and actually clarify this, was a very good measure, because I know that if something happened to half the staff or whatever, that the partnerships, you already have this oversight mechanism from an independent body that's reporting back to the commission, so you don't have this void or absence of knowledge of the partnerships or what's in the partnerships.
A couple things. I've read these contracts, and I've spent a lot of time on these investment committees that we have with our partnerships, and I don't think they're as ironclad as maybe some of us believe they are. Perhaps today in executive session we can go over that. Is that possible? To talk about some of those.
You got some specific strategic partnership contracts?
Well, any of them. What we're talking about here is formalizing what we had with NEPC, and I think that ended up in the end costing us a tremendous amount of time, effort, and money. We had very little knowledge transfer. We had investments being done with one person at this commission knowing what they were. I'm not saying that's necessarily the case now, but we have hired a worldwide respected firm to give us investment advice, and I think they ought to do just that. It should be a formal process where y'all are involved, and there may be different levels. I see the last sentence says you think it's appropriate that there be different levels, but I think there should be some formal process. I don't believe these investment committees are what everybody thinks they are, and I think the commission itself should have a real a conversation about that. I'll have it in public, but executive session.
Yeah, you can bring it up, executives.
So I mean, I would.
Did you say investment communities or
Committee.
Committees, okay.
Yeah, investment committee. So I would. I took this in good faith, but I think y'all should have a formal process. I think if anything, we've learned that the strategic partnerships, the inner workings there, are some of our highest risk opportunities, and those are opportunities we should miss. High risk things, and we went through this whole thing 2 years ago, and it was it consumed a year of your life, I guess, to figure out.
My understanding is we do have a formal process. The question would be, do we want to change the formal process, not whether just initiate one? We've got to. Do we not have a formal process?
We do have a formal
Yes.
process.
Okay. But we'll discuss it in
I would like to hear Treasurer Office's concerns and make sure we address those, because they are, when the commission created these, the idea was to have very flexible, opportunistic capital to take advantage of certain investments that will come through and dislocations in the market, and that was the core investment theme behind a lot of these partnerships. And if it's the desire of the commission to deviate from that and change, then we should discuss that. And because at some point in time, if it requires a more formal vote that's coming back through the commission, then you've lost the flexibility of the partnerships. And our recommendation would be you don't need them at that point.
Exactly.
But you've given up some of the opportunistic investment ability. So you have to balance where does the commission want to be there.
Yeah, for sure. But the strategic partners are more than just this mechanism to allow managers and staff latitude to invest. I mean, they're a whole lot more than that. That's a portion of them. But it says here, the role of the consultant. We do not serve a formal approval role in the evaluation of potential strategic partnership investments.
Right. We don't have a formal approval.
So I mean, I guess so that your formal process is that you don't have a formal role.
In the approval itself, but in the vetting of it, we do. So perhaps a poor choice of phrasing, but we'd be happy to talk about how maybe that could be more formalized without taking away, I think, the expediency and the flexibility of.
That doesn't need to be an executive.
I don't think it needs to be either.
That discussion can be had in public, unless you're getting into some specific contract. I think just the role of AGK in this process. Sure. I mean, it doesn't have to be done right now, but it needs to be done in public session, I guess, not.
Yeah, my understanding was there's some specific contracts that were at issue. But if it's just a philosophical context, we can discuss that in public session, and should.
So if I may, we've only gone through two so far, unless I'm forgetting somebody, in the last year. And one was actually, so we won't go into manager names if that's all right, but one was a manager that actually had already been approved by our organization. So we had a full 40-page due diligence document approvals. It was, obviously very easy to have that conversation with staff that that's something we're very comfortable with and would support. The other was a new idea that we hadn't known as well. So we went through the process described here. We got some information from the manager. We discussed with staff what they found interesting, what they'd done so far, looked at materials they had, talked to the manager, raised some concerns, then had subsequent discussions with the manager about those concerns. Got to the point where we were comfortable. And that's where it stopped. So we gave all of our pros, our cons, all of that to staff. We did it in a memo. That's where we were. It didn't fall into the category of causing problems, so therefore I didn't come to all of you. Something we felt comfortable with. It was prudent. So I guess the one thing that maybe we have done occasionally I'm pointing to Brady because he has a client that uses a lot of strategic partnerships. And I would echo Herschel's comments. It's important not to make these so burdensome time-wise that you can't move quickly. That's kind of the whole point of these things. But, of course, you want good process to be followed. So we've done in the past, what do you guys call it, qualification letters or? Prudence letters that support any investment that's being made. So that could be something that we could easily add. And it's basically just a extension of what we'd already given staff in terms of our formal pros and cons. So we'd be happy to do that if that helps the process at all. That it may not be enough, but I just want to mention that.
Can I maybe touch on it, at least from my perspective, right? I mean, this, in some ways, it's no different than y'all look at a manager, but you're not approving every security that manager's buying and selling. I think what the commission, as it relates to strategic partnerships, or where I was a little taken back, was when inside a lot of these strategic partnerships, there were other funds that very easily could have been bought directly. right, that y'all would do your normal due diligence procedures on and have a very standardized, type of report, right? I mean, I think where because then you're not really getting the efficiencies of, you've just added a legal layer on top of something which ought to be a much more direct process. So I understand why HEK would write a memo, because you're not making a specific security recommendation at the end of the day, right? But I would expect y'all to have a report if it's an existing fund, if it's a fund that's being done. I would hope we're not doing too much of that inside the partnerships, and I think the expectation would be, at least from my perspective, that y'all would have a report on the organization as a whole, right? Maybe not the specific, item that's being done, but I mean that's always been kind of my understanding or perception, right? And then the way it got implemented, obviously there was more latitude, and then the overall exposure. Where do we stand on that, Herschel? I know we've been carving it back. When we first looked at this, it was what, $13 billion in capacity. And
I think around 15, and about 7 or so had been committed. So roughly half of it had been committed, and a lot of that is still committed capital or in the ground, maybe slightly north of that now, but. In prior conversations, we had made the decision that we're not going to keep 14, and it's going to be a lot less, and we're in the process of making those changes and transferring out those investments to balance sheet investments, if you will, or outside the partnership, so they show up as a line item at Bank of New York. So we'll have an update on that in executive session of those specifics of what the commission elected to do, to walk through those as well. And the other thought, I'll go back to the newer investment that Suzanne had mentioned, and I actually think it was a very good process of going back and forth and doing a full vetting of the idea. And what that led to is for us to push back and ask a different line of questioning to actually get comfortable with doing the investment as well. So there are some things that were pointed out to us that we need to focus a little bit more time on. We did that, we got comfortable with it, and we still saw that as a potential risk. You're not going to escape risk, or you just don't get a return. But what we've done is we've scaled back the size of that investment. So we re-risked or resized based off these conversations. So I think that's the true value add that we're looking for. But you're right, if it's the next private equity fund, 8 or something like that coming out, then I think that's where Suzanne's speaking, that they've already got the 40, 50-page memo on that. So
I think something like the letter of prudence letter, is that what you call it? Yeah, I think that's very important. We've had investments that didn't go well. We go back and look and see where we didn't get a clear recommendation. We just had the pros and cons, which to me is not very helpful, because everybody's going to weigh the pros and cons separately, and I'm not sure how often they actually get read. But I think that would kind of be a minimum that we would ask for. But I do think it's important and that we have something in paper that says this is what we think, and it's clear and it's unambiguous. And I'm sure you got to have, because you're not doing the full due diligence, you'll have to have certain disclaimers, and that's fine. But
well, I will say, I mean, the audit committee, I mean, this is one of the first projects we did on these internal. Each of these partnerships is required to keep minutes and voting records on approvals, and all those have been collected historically and are being
collected. They weren't audited; they're collected. We're in the middle of the strategic partnership contract compliance audit.
Right.
thank you.
Ready to move to the specific investment recommendation?
Yes, Mr. Chairman, if no more questions there. So we do have 3 manager recommendations for you. The first 2 are global equity managers. Asked Brian Moore to actually come up and present his work there. The commissioner assigned to this again was Dr. Gunlagson. And this actually ties back to the overall equity plan that we talked about a little bit earlier, of moving a significant amount of the assets back to more of a global equity framework, because you'll remember we used to have U.S., small cap, EFA, EM. But we're converting a lot of that exposure back to more of a broader global mandate. So you'll have 2 recommendations for that. They're both passive recommendations as opposed to active. And with that, I will turn this over to Brian. And I know at some point in time we're going to have to bring into the discussion the sizing of these investments, because their size in the SIOP, the limitation for the manager for the broad mandates was 7.5%, but these are passive beta replication strategies, which the note at the bottom of that part of the SIOP made a reference to. They could be much larger. We didn't want to just go through this approval without bringing that up, and I believe HEK actually has a memo on that as well. And we can discuss that now, or else go ahead and let Brian discuss the ideas, and then we can have that discussion at the end. But these allocations would be, initial allocations would be closer to, I think, 10% for the initial allocation. Those would have to be scaled into as we're going through the transition. But at the end of the day, they will be very sizable allocations to firms. So we want to make sure that we call that the Commission's attention to that, and make sure that, if we need to make a revision to any policy or rethink what we're doing here, then we're happy to do that as well. So maybe it's better to take a look at the managers and then have a discussion about the sizing piece of it.
Great. Thank you, Herschel. Good morning, Commissioners. I'm here today to discuss the recommendation of BlackRock Institutional Trust Company and State Street Global Advisors to passively index to the MSCI World Benchmark. Since both firms are very similar, I'm going to present them together, but we'll highlight any differences along the way to point out. To briefly give some background on the search, staff initially screened the universe along with HEK and identified 6 different firms for meetings to be held at RSIC offices. Staff then narrowed that list to 4 managers, which on-site due diligence was performed along with Commissioner Dr. Gunnlaugson. After further deliberation, BlackRock and State Street were identified as the best to manage to this mandate. Both groups passed investment and operational due diligence performed by staff in acknowledging the work that J.P. Boyd had performed, who was instrumental in helping get these recommendations done on a very short time frame, along with Sarah Corbett for her work on the operational due diligence side. To go into the recommendation, staff is recommending up to 12% of total plan assets for each manager, which in aggregate is 24% of plan assets. And as Herschel mentioned, this is in excess of the 7.5% limit to any individual manager. The actual amount planned is expected to be less than 10% of total plan assets to each. However, staff would like to reserve the additional capacity for 3 different considerations: a buffer against future asset allocation changes where we might make a decision to increase global equity allocations in the future, an increase to the assets that may be passively indexed, or redistribution of capital in the event that there is an issue with one of the groups that we're hiring today. Want to point out, with an index manager, the most important feature is the process. BlackRock and State Street manage 1.7 trillion and $1.1 trillion passively, respective. The processes have been refined over the years, and to the point where BlackRock itself has went out and built an entire system internally around their process. This controls all aspects of index management, from reallocation decisions from the portfolio manager straight through the back office. State Street has an equally defined process, but has chosen to build this using third-party systems. Staff spent a significant amount of time with each group to understand their processes and have gained a very high degree of comfort. I think it bears to mention the costs associated with this particular mandate, given that it's a large size, but the allocation, the cost itself is very favorable. In doing so, we're indirectly gaining access to the resources and teams of both organizations. Just to highlight, BlackRock itself has 81 professionals dedicated just to corporate actions. Corporate actions could be tender offers, mergers and acquisitions, or rights offerings. This group takes those potential impacts from corporate actions and looks to see how they would impact the index. And they have been on occasion able to add value given those changes. State Street brings a dedicated workforce to the passive management team of 27 global professionals, 150 operational professionals, and 13 data professionals. The economies of scale with indexing have allowed BlackRock and State Street to hire and retain the best-in-class employees while pricing the product very competitively. I wanted to highlight a few concerns identified by staff with regard to each manager. As presented in the information provided to commissioners, the large assets under management, a software systems integration, and the option to gate redemptions was a concern noted for BlackRock. With State Street, the large AUM, the affiliation with the custodial bank, comparatively higher custody costs to BlackRock, and the option to gate client redemptions were also concerns. Staff looked at each of these issues independently and were able to gain tremendous comfort with moving ahead with each of these groups. In closing, I wanted to note that Commissioner Dr. Gunlickson participated in on-site due diligence with us. Staff has conducted reference calls with 6 public pension plans of comparable size. Sarah Corbett has conducted operational due diligence on the opportunities, and the Internal Investment Committee has approved these investments. HEK has provided a buy rating for both firms, and Andrew Turnick has performed his completeness check on the due diligence process. Right now, I'll pause and take any questions that the commissioners may have on either of these opportunities.
I think the word non-lendable means they're not lending out the securities.
Then we have, if you will, 2 flavors. One where the securities are lent, the other non-lending. At this point in time, we would recommend non-lending. And we go back to the fact with BlackRock, there's not an indemnification a formal contractual indemnification, and the Lehman debacle and so on and so forth. In their lending portfolio, they actually, correct me if I'm wrong here, made their clients whole where there were issues. So they have a track record of actually making their clients whole. But there's no contractual reason that they would have to do that other than more, reputational. With State Street, while there is indemnification on their lending portfolio, we do see, looking back in history, that we believe that there has been an instance with another public fund that they had to delay the redemption. And for us, and a lot of that goes back to you've got to make sure you call securities back and get the cash and so on and so forth. So for us, we believe we mitigate that risk by being in the non-lending vehicles so that we can maintain a higher degree or higher confidence of liquidity when and if we needed it. So these would both be non-lending options.
Although, may I just add, Mr. Gillespie, the motions that have been presented do authorize the CIO to utilize the manager's SEC lending options for both of these?
And and I think that could be something that if you ever did get comfortable, we'd want to bring that back to the commission to notify them that we would make that change. But the initial allocations and expected allocations are non-lendable classes. And the other option that I don't think we talked about is that at some point in the future, if we wanted to convert these to separate accounts, then we would have the ability to do in-kind transfers to the maximum level that we can. Obviously, some markets will not let you do the in-kind transfer, so you'd actually have to go through the transactions cost piece of it. So that's a reserved right as well.
And we've had significant conversations with both State Street and BlackRock regarding the in-kind transferability. And given that Greece is falling out of the MSCI World allocation, there's no longer any issues with transferability of rights. So we would not have to go through selling the securities and repurchasing them for a separate account.
I don't hear any questions. Is there a motion?
Which motion are we on? We're on the expansion of the limit, or are we on the...
It's parts of the same motion, is it not? Or is that two different? Let me see the written motion.
It's within the motion. Thank you.
So maybe we could...
Yeah, the BlackRock one is within the motion.
Should be both.
And I'm happy to go back and spend a few more moments on that. Within the SIOP, it was page 12, if anybody happens to have a copy, that as we talk about the manager level concentrations, there was the broad mandate at 7.5, and it referenced asset classes such as global equities, core fixed income, global fixed income, and global asset allocation. So these would tend to be much larger allocations than we had anticipated that, as opposed to, say, if you're allocating to a hedge fund or very active manager, those would be capped out at 4% and be smaller. But at the very bottom of those descriptions, there's a part that says the allocation limits are not applicable to cash or internally managed passive, enhanced index, or beta implementation, which are currently currently primarily implemented via the overlay account or the Russell account. So the idea here is that you are substituting that overlay. That overlay will be coming down and being replaced with physical securities. So this is a beta exposure component to it. So that's the rationale for having a higher allocation to these two managers.
It sounds like you're asking for the increase just in an abundance of caution. It's probably not subject to the increase to the limit anyway.
Yes, sir, it really is. It's one of those things that one want to make sure the commission is fully aware, and that, to make sure we get any, potential issues on the table and discuss them, and to make sure everyone's comfortable before we move forward with that. So.
Question, perhaps I missed it, but we have two world index funds here.
Yes.
I guess, what's the difference? If they're index funds, what's the difference between BlackRock and State Street?
So staff spent a lot of time on the concentration side of it, and we have essentially each group is deploying a full replication of the index. So they're purchasing in the exact way every security in the MSCI World Index, which is 1,600 securities. Diversification, there's no diversification benefit from buying or going into additional managers, because you're getting the exact same exposure like you would with active management, where diversification is key. But in doing so, we also didn't want to concentrate with one group a very large portion of the plan assets. You could also make the argument that if we were to hire 3 managers and not seek out an increased limit, the breakpoints that staff has negotiated with these managers would actually increase the total cost of management of this mandate to the tune of about a 26% increase in the management fee.
All right, so essentially what you're doing is trying to diversify the managers as opposed to diversify the asset class.
Correct.
Right. And so each manager would end up with somewhere close to 10% of the plan assets. To put that all and have one manager at 20% we wouldn't want to make that recommendation. But you're right, you get this exact same exposure, but you're having to split that across 2 managers.
And we've achieved the maximum break point on the fee at either one of those.
So we spent a lot of time negotiating the fee structure.
One other question: if you go to the max of 24%, how does that match up to our asset allocation?
Sorry.
I say if we go to the max of 24%, how does that max up to our equity asset allocation?
So the global equity allocation is 31%, and that the emerging markets portion, we're keeping an active mandates. That's why you're not seeing an ACWI replication. You're seeing a world equity. So that world equity is completing the overall global equity piece of it here. But the cap on this would be, was it total of 24% for the 3.18 billion would be the cap. If we need to get additional exposure, then I think that's where we would continue to use the Russell overlay to have that exposure. There would still be some active managers. There are still 2 active international equity managers, and we do have 3 active small cap managers as well within the passive large cap piece. But if we do find ourselves running into those instances, then we would come back and make some additional manager recommendations. We would not want to continue to add additional size from a percentage basis to these 2 managers. That would be the max limit.
It seems to me, in going to 12% above 7.5 and the 2 firms, you're saying the risk is in what they invest in as opposed to the manager. And how you view the risk of the manager itself, fraud being involved, or somehow there's a really rogue guy at the top that does something that just surprises the world. How do you address that?
These are in collective investment vehicles, so they themselves are bankrupt remote if you have an issue at the firm. So the firm's liabilities do not spill into these vehicles. Okay. So you're protected from that aspect of it. So that's the protection mechanism. Keeping in mind that the automation and processing of this information is very standardized and straight through, and the investment technology investments that these two firms make mitigate the risk that you're speaking to. So if you did have a bad actor, they could pluck that bad actor out and the process doesn't stop. If you're in a smaller shop where you have, say, fundamental active management going on and you have an issue with your technology person, then you may not be able to replace their skill set very soon. So you would have, a lot of potential blips in the performance or what's going on with that fund. These two organizations are typically not in a market-making business, say like a J.P. Morgan. So that's very limited. I'll ask Brian to go back and answer that, but we went back and took a look at this, and we feel that the risk at the firm level is very, very low for you to run into that type of an issue.
And we always control the option to in-kind the securities back to our custody in the event that there is an issue. So we have that ultimate trigger in that regard to safeguard the assets. But both of these groups are very high credit rating, very respected firms, and we're hiring them for the process that they've built up in the 20 to 30 years of index experience that they bring to the table. That's the most important key to this. And there's also many different back office systems that control potential bad acting that could occur with that in terms of compliance systems.
Are there any restrictions on exiting these funds?
There is not. We have the ability to call capital. That we're investing in very liquid markets. So if we were investing in a product that might include emerging markets, there might be some issues with getting the securities to sell or getting a market for some of the securities. But given that we're investing in the most liquid markets, there's very limited ability, other than perhaps maybe a country holiday that might limit our ability to get the proceeds out at any time. But these positions are really meant to serve as a core for the rest of the global equity portfolio.
Daily valued.
They're daily valued. We get from BlackRock, we would be getting daily transparency for the holdings. With State Street, we'd get monthly transparency.
So then I'm assuming that obviously that these are all public security, or
yes,
we're not involved in private securities in these indexes.
No, so everything that's included in the MSCI World Index, which is a well-known benchmark, that's exactly what we'll be holding in the exact weights that are outlined in that benchmark.
Do I hear a motion for the adoption of investment recommendation 1A through F as set forth on pages 1 and half on page 2 of the open session motion sheet? I have a motion. Is there a second? I haven't heard a second yet.
Oh, you want to take them separate?
Well, might as well, because it might be different. You haven't made the presentation on State Street. Will there be any material differences in that?
Go next page.
You did go through State Street?
No, you didn't.
So I covered both of them and included in my comments. The full materials that staff put together are available on Watchdocs. But
so are we ready for a motion on items 1 and 2, both BlackRock and State Street?
I'll make that motion.
All right. Ed has made the motion that we approve that Global Equity Recommendation 1 and 2. Rebecca, you on the committee? You want to second? You have a comment, recommendation beyond what's already been presented?
No, he did a great job.
Thank you. Is there any further discussion? All in favor signify by saying aye.
Aye.
All opposed?
late question.
Well, yeah, I just had, and this is more of an operational question. You know, if he does opt to do the securities lending, are there any operational items that we would need to be aware of? You know, because are these going into a commingled trust at these managers? And it's all done within the pool? Is that as opposed to we have straight title on the securities and are lending them directly?
The commingled trust would be the lending the securities. That would be the client. And so that would be, so it would not be us directly lending securities, South Carolina lending securities.
It would be switching, excuse me, Mr. Chairman, it would be switching from one commingled fund to another commingled fund at that point, correct?
Oh, I'm sorry, if you were converting from one to the other?
Yeah.
If you go from...
Yeah, I mean, the reason why I ask this, I mean, this gets a little bit into the operational budget question, but in the past when we've done securities lending, right, the revenue split comes back into the, you know, for lack of a better term, the operational budget, right? Whereas when securities lending, in this case, it'd be inside the fund and it comes back as part of the net return to the trust. But you know, as we know, our operational budget question is different from the return question. So this could potentially become a little bit of a budget item question as well.
If I may, we actually had a relationship very similar to this with State Street. In fact, they were our first equity manager back in 1999. And we had 2 index funds with State Street. As y'all may recall, it was an S&P 500, and we also had a Russell 2000. And we had a similar commingled enhanced index fund with BGI. And all 3 of those at the time did participate in SEC lending. You're exactly right. The revenues went back into the pool, but we realized a split of that within the pool. Does that answer your question?
I think there's a different question being asked. Yeah. And I think it actually goes back to South Carolina and the Treasurer's contract with Bank of New York and the securities lending, and that securities lending revenue is what is paying for, or their split, Bank of New York split is what's paying for their custody services. So that actually goes back into what's the sourcing of funding, and are you selling securities that are in that lending program to fund this? And the sources of funding will be from cash, the hedge funds, the credit that we talked about. That would be the primary sourcing of funding for these 2 opportunities. So the active emerging markets, those are already in commingled funds that aren't lent through our direct program. The 3 small cap managers and one of the international managers are in separate account in bank assets. So at this point in time, we're not recommending any termination of those. So those securities would remain in that program to be lent as it relates directly to the Treasurer's contract with Bank of New York. Once you move these assets into these collective trusts to invest with, I said BGI, BlackRock and SSGA, those funds then lend, if you go into the lending class, and then the revenue share goes back into those commingled funds to help give you a slightly higher return or offset some of your actual cost. The funds that we would go into would be the non-lending, so we would not participate from that perspective. But I think it goes back to the question you're asking, is our direct securities lending program would be minimal impact, if any. So.
Anybody want to change that? I vote based on that intervening discussion.
No, I just think it probably behooves us to come back to the securities lending question in the future, right? Both from a strategy standpoint and a budget standpoint.
I believe that's going to be part of the executive session.
Okay, sorry.
It's in the executive session.
Okay.
All opposed? Ayes have it. Unanimous. Industry ventures.
My question was that the approval for the managers plus the additional capacity?
All of that was as stated in here. It's as stated in items 1 and 2 on pages 1 through 3.
My apologies. The next manager up for recommendation, Mr. Clocker will present that to the commission, is Industry Ventures. And Dave, I'll let you correct me where I may veer here. The initial allocation recommendation would be a total of $80 million. Over the past 24 or so hours, we've had feedback from, let me stop. That total of 80, 40 would be into their main fund, and then they've created a co-investment fund, and 40 would have gone into the co-investment fund. What's been communicated at much more favorable economic terms, and there were several investors going in that strategy. What's been communicated back to us in the past 24 hours is that the capacity for that co-investment fund has pretty much been taken. So the probability of us getting any access to that is very, very small. So with that said, we could go ahead, if the commission feels comfortable, and approve that in case we do get some small allocation. But I think we'd want to leave the door that we could not make that investment if the allocation is too small. With that said, I think the main focus should really be on the main fund itself, which is a $40 million allocation. So with that said, I just want to make that caveat that that's just a new development in the past 24 hours and getting some final responses late last night.
Part 3 here, where you are asking for authority to commit not to exceed $40 million to the special opportunity. You do want the authority, but you're letting us know that you probably won't exercise it unless something changes.
I would like that authority in case we're able to negotiate that $40 million or a sizable portion of an allocation. But if it's one of these things where you get $5 million allocation, we're not going to take a $5 million allocation.
But you still want the authority?
In case we are able to get to the point of, yes, sir.
We also wanted to make sure that the commission was aware of this situation. We didn't want anybody going into this thinking that we were going to get full allocation to both and then not be able to get it to the co-invest fund, which does have favorable economics, and then come back and say, well, we got the one in the main fund, but the one that reduces our overall fees and expenses, we didn't get access to, because then that could raise a lot of follow-on questions at that point. So we want to be open up front. We want to let you guys know what's happening in real time, and still want the flexibility to be able to invest in both if we get the allocation that we've requested. So. Okay. Well, on that note, I'll go ahead and get started if I may. First of all, I'd like to thank my colleague Louis Darmstadter for the hard work that he contributed to this proposal. I know he and Commissioner Giobbe worked well together, and appreciate his experience that he's had with industry in his past life for the high quality analysis that you saw in Watch Docs. Industry Ventures is well known to RSIC. We've committed $40 million in Fund 5 and another $40 million to Fund 6. Performance has been above expectations, and therefore we're recommending an initial investment of $40 million to the follow-on Fund 7, as well as, like we just discussed, $40 million commitment to the sidecar fund. Just as a refresher, Industry Ventures is a secondary ventures capital fund that buys interest from other investors at a discount to NAV, and then holds those opportunities until the time is right to harvest the return. The investment rationale has been consistent over time. Some of the key points are that investments in the venture capital industry are done at a point later in the cycle where there's a reduced amount of downside risk. Let me elaborate on that just a little bit. If we were to commit to a traditional venture capital fund, we would most likely have a 10 to 15 year horizon ahead of us, and there would be some investments within those funds that may not produce as well as expected. By investing in a secondary fund, you're able to get into those funds at a later point in the cycle at a discount to fair market value, so you're getting it for getting it at a reduced value, and a lot of the downside risk is taken out. So it's a lower risk, better return profile than what you would most likely get from early stage venture capital. Industry Ventures has been able to produce better returns through its established process and specialized ability to source high quality transactions. The team members have a strong background in IT and technology, which helps them identify the lucrative opportunities in both the VC funds as well as direct companies. There's a shorter time frame for investments to realization versus investing in a VC fund. As I just mentioned, you could have a 10 to 15 year horizon in a venture capital fund, where you're going to have a 5 to 10 year horizon with something like this. Again, I'd like to reiterate there's been positive performance for Fund 5 and Fund 6, and we expect that to continue for Fund 7. And there's also a diversified investment base from the previous funds based on the type of investment, the transaction size, the sourcing partner, and the holding period. A couple of items that I'd like to draw your attention to. As we just mentioned, the co-invest fund is oversubscribed, and there's issues around that. But the other item is the fact that the team has grown fairly consistently over time. This helps alleviate two problems. The first is the amount of people dedicated to each of the underlying investments, and then the second is the reliance on Hans Swilden, who's the key person. As the team grows, this is a positive trend in the right direction, and we're happy to see him building out the organization as a whole. Other notable items, I'd like to say that the commitment to industry venture fits well within our private equity allocation plan for this year. It's the only commitment that we're going to be making into the venture capital industry, as well as the only commitment that we're going to be making to a secondary fund manager. Industry Ventures provides RSIC allocation to the VC market in a way that reduces downside risk while still providing upside opportunity through secondary purchases. The terms are reasonable and in line with expectations. Industry Ventures is reputable in terms of being an institutional quality organization. Other investors include Ohio, Texas, and New Mexico, so we're happy to see other public plans in the fund. It's passed operational due diligence both internally with Sarah as well as with HEK. Their custodian is Merrill Lynch, and we've received an SSAE 16 that was completed by PwC. Auditor is Ernst & Young. Administration and operations is done by Standish Management, who's done it for the prior funds. It's been approved by the Internal Investment Committee. HEK has endorsed the investment. Andrew Chernick has completed his completeness review. Ed Giobbe was the commissioner assigned to this, but Travis Pritchett was the commissioner assigned for Funds 5 and Fund 6, so he's got some perspective on it as well. And so we are recommending the two separate transactions, one for the main fund, one for the co-invest fund. And at this point, I'll open it up for comments from either commissioners or for any questions that you may have.
Dave has presented a pretty good picture. The only thing I would suggest is that this gives us an opportunity in the venture capital area, but at a little higher up in the risk profile in terms of not being at the beginning and having that 10 to 15 year time span, and more like 5 or 6 years. And I think going forward, that's a very attractive opportunity. The one problem that you brought up is this, the fact that we may not be able to participate to the full extent that we'd like to, and if we give you the authority to say yay or nay, depending on what they offer us in terms of size, if they come up with a very small allocation, well, and if that's something you decide that we shouldn't be doing, well, then so be it.
Anything to add or not?
Travis, you have?
I haven't participated in, the due diligence this time, but from a historical perspective, I've always been really impressed with this firm. I think it's a great team. It makes smart decisions. We've had good returns, and I think that's whether or not in the beginning we weren't doing co-investments, so we were there without co-investments at that time. They add a little levity to the situation. I think this key person is a dead ringer for the actor James Dean. And I shared that with him the first time we met. Really amusing to me.
You're dating yourself a little bit with that.
Some people didn't get that at all.
I'm going to take that as a motion by Ed and a second by you, and then I'll invite discussion.
Okay. With your permission, sir?
Yes.
Given the update that the CIO provided, could we propose additional language be added to the third part of the motion?
Let's hear it.
Okay, so it would, all that existing language in 3, but then we would just say, comma, with discretion delegated to the CIO as to the amount of commitment, comma, if any.
Would you accept that amendment?
Yes.
All right. Yeah.
Thank you.
Is there any more discussion on the motion as amended? All in favor signify by saying aye.
Aye.
Opposed by like sign. Ayes have it.
Thank you very much.
Thank you, Dave.
You made the motion, who seconded?
Travis, second.
And it was unanimous?
Right. Now, we have... We've reached the break, and we're mercifully ahead of schedule.
As you can see from the agenda, there's a lot of topics here. I'll try to cover the highlights of all of them so that we can finish up the day efficiently. Under operations, give you an update on personnel, a few important system procurements going on, update you on our new and improved website and logo, and facilities matters. There's some important policies and procedures that I want to talk to you about. Several are already implemented. A couple, one will be a proposed change, and one will be a ratification. Then an important issue is to review our preliminary budget proposal for fiscal year 14-15. And then provide a legal update on a couple issues for your information. So on the personnel side, we have no open full-time positions on the operations staff. There were 2 new positions approved in this year's budget, which have been filled. One of them filled from within. Happy to say Kathleen Sheely, who joined us as a part-time person in late 2011, was promoted to a full-time position in July of this year, primarily involved with the management and maintenance of Tamale, also working on our new and improved fee collection and reporting process. We're happy to give her that opportunity. Our newest addition is Josh Green, who is sitting over here. Actually joined us about a week ago from Mr. Giobbe's area of Aiken. His prior experiences with Morgan Stanley Wealth Management, I think, will benefit from that. He's going to be working with David King on the reporting staff on our reporting systems. In addition, we brought in one part-time person this fiscal year, Landry Phillips, in mid-August. He's been working with our team on our fee collection and reporting. We welcome him. One more personnel matter to mention is related to one of our current staff, Mr. Robert Feinstein, our Chief Legal Counsel. Happy to say was admitted to the South Carolina Bar, which is a tremendous accomplishment, and I think we're all proud of him for that. On the systems procurement side, we've been working for a long time, several years, frankly going back to the Deloitte risk assessment, to improve our internal infrastructure, processes, and procedures. And a part of that is acquiring important systems from outside vendors. We've actually been approved some appropriations by the General Assembly to do that, and we're working hard to spend them. These systems would have a very positive impact on our ability to invest and manage the assets. As you know, we do have a procurement exemption when we recommend and approve investment managers, but we don't have a procurement exemption for these systems. And we're not talking about buying tablets and pencils. These are systems that are fundamental to our business and directly impact our decision making and some of the issues that we talked about this morning. And I think that's something that the organization may want to consider going forward, a procurement exemption for this type of thing. Without the exemption, we do follow state procurement process, which, as many of you know, is lengthy, cumbersome, and bureaucratic. Coming from the private initiative I do, it's been frustrating. Nonetheless, we are making progress. And I wanted to update you on a couple of the procurements that we have right now. One is for the risk system. It's been mentioned a number of times. A lot of benefits to us, providing real-time risk assessments on our holdings, an accurate quantitative assessment of our global risk, very important, fundamental to what we do. We've been working on this process with the Information Technology Management Office, ITMO, developing what was initially an RFQ that we finished and sent to published in May. The process under procurement allows vendors to raise questions, which requires us to respond and republish it. That happened. Final vendor responses were reviewed and evaluated by a panel of 5 RSIC operations and investment staff in mid-July, and 5 qualified vendors were selected. That is leading to an RFP process to now get bids. Right now, we've drafted an RFP, gone back and forth with the procurement office, and my latest word as of last evening was it's still there being reviewed. We're hopeful that it's going to be launched shortly. The remaining processes, once it is launched, there's going to be some similarities what we went through with the RFQ. There's a ability for vendors to ask questions. We republish. They'll respond. Our panel will score the responses. Then there will be a demo process where we'll select the highest scoring vendors for demos. After that, we'll score those demos, negotiate with the best solution, and best solution isn't necessarily just price. It's there's a number of 3 primary categories: technical solution, business proposal, which includes cost and qualifications through this scoring process. We'll negotiate, and then once you work out a deal, ITMO publishes the award, and there may be a protest. Our best estimate, if nothing goes wrong and this thing gets out on the street soon, we're probably talking about having a decision in mid-December. So as you can see, it's a very lengthy process to go through. We're very anxious to get this in here. A protest would add at least a month and possibly a restart of the process. Those of you who were here when we acquired Tamale, you know that was a 16-month process. The other procurement that we're working on is for a private market investment monitoring system. It's going to give us more performance information of a portfolio of liquid investments such as private equity, debt, real estate, et cetera. Again, very important. We've been trying to get this for a long time as well. We are starting off with an RFP. It's drafted. It's sitting there with ITMO. We're waiting it to be published, and I would then expect, short of anything else, a similar process with responses, scorings, demo, et cetera, and it's going to take a long time to get through that. Finally, we're interested in exploring what we would call administrator services. We've mentioned to you in the past. Some of these are risk and private market. They could be a portfolio accounting, trading, other compliance services, fee validation. And in this case, we've sent requests for information to a number of vendors to try to get an idea of capabilities and price, and that's just the beginning of that process. Any questions on our important procurements? Okay. Our website and logo, you've seen our letterhead. Hopefully you visited the website. It looks different. It feels different. Hopefully you like it. It was a part of our Get to Know Us campaign that I talked about a couple meetings ago. It was time for a refresh, but that's only one phase of it. It's also the content. And, you know, we're early on in this. It was just updated about a month or so ago, launched. www.ic.sc.gov, just to remind you. You'll see some new information on there. For example, we have an extensive FAQ on there now that we thought was important to put out and help to clearly explain to stakeholders what we do, why we do it, et cetera. So you'll see things on there like a definition, our definition of alternative investments, why we pay fees, what causes fees to be generated, et cetera. Please go to that site. Please give us feedback. This is our website. It needs to work for you, and we're very receptive to feedback and comments. A lot of us participated in this project. And I wanted to give some special thanks to a few people that made it happen. Danny Verrett, James Manning, David King, Katie Walker, Brittany Story, and Josh Braid. Great job, guys. Thanks a lot. On On our facilities, there's actually a variety of things going on, and there's no real action here that the commission needs to take. This is just for information. When you walk in our office, things may look a little bit differently. First of all, we're making accommodations for the 7 new FTEs that we're approving this budget to make places for them to work. In addition, and this is just how things handled over time, you have investment and operations staff in I guess I'll say non-contiguous spaces throughout the office. You have pockets of people, and to improve efficiency, communications, we're going to move those people around, try to centralize and consolidate investment staff in one section, operations staff in another section. And so those two things are going to require some leasehold improvements, some furniture purchases and things like that, one and done and move on. More importantly, and this is pretty much hot off the presses, while we do have our own lease with the landlord for space on the 15th floor, we have a couple arrangements with the Department of Commerce. One of them is a sublease for about 5,100 square feet, primarily where our investment staff is right now. Another one is called a space sharing arrangement, which actually is the room that we probably all wish we were in today, our presentation center, and some of the adjoining conference rooms. Commerce recently informed me that they're taking space on this floor. While they can't really get out of the sublease, they did have a 30-day bailout clause on the presentation center area, and so they'd like to cut that because they're going to replace it with more space up here. We've been sharing that rent. Our share is $26,000 a year. We use that space pretty hard, not only for these meetings, but a lot of other internal and external meetings. We have managers coming in, investment staff, a large number of them get in that room, use the AV equipment, et cetera. So we certainly want to continue to take over that space, and we're going to work with Commerce, and they're amenable to us to make sure that, and there's a couple ways we can do it, either continue to pay 100% of the rent instead of 50%, and they don't exercise their bailout, or they exercise that and we actually have a right of first refusal to take up the space. So our proposal is to go ahead and do that. But as a part of them moving, there's a couple other aspects. We've been fortunate enough to be able to have the use of free furniture. On the investment side, there's cubes, the desks, file cabinets, and they do need all that stuff up here, and they're going to take it probably in about 30 days. Also, in the presentation center and the adjoining offices, it's pretty much their stuff. They paid for it, AV, conference table, and et cetera, et cetera. So we need those type of assets. They said it's about $100,000 worth of stuff at cost. Obviously, they're not expecting to get cost. They want to get something out of it. So, our proposal, and they're interested in working out some kind of a significantly discounted deal for that. And I have a meeting with their department head next week to continue to talk about that. The good news is that we feel that in the current year's appropriation that we have in operating expenses, we feel there's enough to absorb any and all those costs. All decisions aren't made yet. Herschel and I have been working on other priorities, and we're still getting bids and estimates on some of the construction and furniture and that type of thing, but we feel like we'll be able to fund it. But one of these days you're going to come into that office and things will look a little bit different, and hopefully we won't have to make alternative arrangements for meetings like this outside of that presentation center. Any questions on that? Okay, next section is policies and procedures, and quite frankly, I'm really happy to talk about this today because I think pretty much all what I'm going to mention today is very positive news. It's positive for all of us. It's positive for the organization, clearly positive for the people why we're here, the retirees and the stakeholders. There's been long-standing issues that we've all dealt with, and before I got here, all of you have dealt with them. And one of them was the issue of legal sufficiency, which pretty much revolved around documenting whether the key investment terms that were approved by you at the time the investment was recommended actually ended up in the final contract, and where there are changes. And there's been a lot of discussion about that. There was discussion at the last commission meeting where I think the treasurer hoped that there would be a simple piece of paper, expressed the desire not have to read a lot of documents, and I think I got the strong message from all the commissioners that they felt that something should be done. And so right after that meeting, I worked hard with our investment staff to draft up a new policy, talked to Herschel, and got his impact and anybody else that needed to be involved. And we did put together something that we have implemented, and it's actually 3 documents. One is a certification that's sent at the beginning of what we now call the 30-day review period, that's signed by one of our legal staff, and it does address the key terms that the commissioners recommended at the time of the investment recommendation, and whether they've changed or not. And that's reviewed by internal audit and compliance. Very solid, straightforward document that should put any of those issues to bed. Then there's another certification signed by our legal counsel that signifies that the review period is ended and all conditions to closing have been satisfied, and it gives the chairman comfort, and it's sent to all commissioners that he can sign. And the third document is a voucher and funding directive that we provide to the treasurer's office, signed by the chairman and the CIO, that attaches these 2 documents, even though they're provided to everybody before that, so that he has something to make sure that everything has been done and the I's are dotted and T's are crossed. This happened pretty quick right after that meeting. I mean, this got wrapped up in June. Very pleased to see how it worked on 2 investments so far, Brookfield and Oaktree. Both of them had extremely smooth closings and fundings, and you know, I think it just showed the testament of everybody in here working on these issues, talking about them, and coming to a conclusion that everybody seems happy with. And so I truly believe that issue is put to bed, and I hope everybody is happy with how it works. So the next issue, which I don't want to say it was more or less important, but it was fundamental here, it was the issue of, I guess, information access. And so, you know, I came in here, and this issue was in front of us. To me, I think it revolved primarily around the staff of the commission wanting to ensure that there was a protection of confidential information. Meanwhile, commissioners and you know, primarily the treasurer, you know, wanted to be able to enlist the help of his staff, you know, to discharge his responsibilities. And this was talked about for a long time. And in fact, at one point, the Budget and Control Board was involved to help, you know, come up with a solution. I think a number of things were discussed, but there wasn't a solution. It was mentioned in the July report by the Inspector General, you know, that this thing, you know, needs resolved. And again, at the May Commission meeting, I think all commissioners said this should be resolved. So, you know, I started working on it shortly after I was hired, and in fact, at the May Commission meeting, did have a draft NDA. However, at that point in time, we didn't have feedback from, you know, the treasurer and his staff. The right decision was made to table that, as with a reduction in the review period. So we solved the legal sufficiency problem, which I think, you know, positively impacted this. As a result of the Inspector General's report and the May Commission meeting, our internal staff got together. I worked with our legal staff, worked very closely with Mr. Bill Condon of the Treasurer's staff, and we resolved all the issues. And we disagreed on some of them, but we came to a consensus because it was time to do it and it was the right thing to do. And I think that's a great result, like I said, for everybody. This document, it's up here. It's on pages 226 to 229 of the book. I'll summarize what it says because it's pretty tiny type. It allows a principal to designate staff to review documents on his behalf. And all of those people agree to maintain the confidentiality of that information. This document's signed once. It covers prior and future investments to be recommended. Very easy to administer and monitor. There's an exhibit attached to this with an extensive body of documents that are going to be provided. Much more than in the past. And in fact, and you know, I'll pat Herschel on the back, you know, to take a lead in this, making sure that his staff has this stuff available earlier than ever. And our goal is at least 2 weeks before the meeting where you all get together to recommend to approve these investments that we're recommending. I think we've done a pretty good job for these current investments to do that. And so you're getting a lot more documents sooner than you ever did. So we came to an agreement on this before this meeting, and us and the Treasurer's Office didn't see a need to wait until this meeting to start using it, and so we talked to the Chairman and the Vice Chair, made sure they were happy with this decision, and you know, recommended that they give us the approval to start using it, which they did. The Treasurer submitted requests for 4 of his staff, which the Chairman signed, and we've been operating under that so far. So today we have a motion to ratify the use of this, which the staff highly recommends. Any questions?
I've signed it, so obviously I'll make the motion, and Ed approved it before I signed it.
And I'll second it.
I assume he'll second. Good work, Darren.
I think it was a collective effort of a lot of us and Treasurer's Office staff. Very happy.
But this is actually a motion right there.
Yeah, it's on the floor.
Right.
Yeah.
Should it be read or?
Somebody would like to.
I've moved it, and Ed has seconded. So we have this open for discussion now. That the NDA be ratified. Hearing no further discussion, all in favor signify by saying aye. Aye. All opposed by like sign. Ayes have it unanimously.
Great. So now we've solved legal sufficiency, information access, and the third leg of the stool, which impacts how the staff operates and how we interact with our investment managers, is the review period. I guess it's been referred to as the 30-day review period. It was something that the commissioners implemented, and this is why the staff is coming today. Normally, I would think the staff would just institute a policy and a procedure and run with it, but we think that since the commissioners put this in, you ought to have the opportunity to consider it and approve it as a change. So what we now have is we have a legal sufficiency process that gives people comfort that key terms didn't change as signed by our legal counsel. We have an NDA process that says staff can help principals review documents being published much earlier than before. And we also have a new way to get these documents into your hands with that called watchdocs that allows printing of documents. And that was another sore spot that people had to sit there and read documents on a monitor, which certainly had its troublesome issues with. I think with all that, I hope it should be obvious to most folks that what we've in fact done is expanded the period the documents can be reviewed. When we post documents 2 weeks beforehand, and a lot more documents, there is probably, and I'll go on the short side, probably 4 to 8 weeks before we come back to this committee with 4 to 8 weeks between that date where we're recommending to when the side letter is negotiated, which starts the review period. I'd say 4 to 8 weeks. Probably more, could be less in some cases, but probably in that time frame. In addition, now, we're saying that we'd like to have a 14 calendar day period to review the side letter. Now, my experience is side letters should be pretty straightforward. They normally make things better for the investor. I don't know how complicated it is to review a side letter, but hopefully with, additional staff to be able to review it if requested, that can be done. So that process, which is maybe an 8 to 10 week process, is compared to right now where we had 30 days to review everything. And so to me, I think we've expanded the time frame to review particularly everything except this side letter. So in our industry, time is of the essence. And since I've been here, I know of at least one investment where it was discussed and our investment staff said, this looks good, but we can't bring it to the table because we're never going to make the 30-day review period, and that was it, case closed. Oftentimes we're getting in on the later or last closing of these investments, and there's some benefits to that. I mean, you might pay some late interest, but you're getting a look back on what's happened with the fund and who the LPs are, and there's benefits to that. But our investment managers, when I get our documents, they want to get to a closing, et cetera, and run their business. And so, we'd like to shorten the period for them to wait. So at the May meeting, we tabled a proposal that we had to shorten the review period to 10 business days. Now, since then, I've also had more experience. I've seen a couple more investments here and what happens during this review period, and I have to be honest. I think there was some problems with, really what should be happening, definitions. There wasn't a lot of definition about what should go on. And so shortening the time frame was one thing, but I think making sure there was a process in place to address questions, answer questions, etc., that needed to be put into place to make sure everybody's comfortable what was going to happen. I mean, it was just unclear. So we have a new recommendation now, and that is on pages 230 to 231 of the book. Pretty straightforward. It is step-by-step of what we'd like to have happen once the review period starts, a process of how questions should be answered, responded to, and it gives the commissioners 14 calendar days after they've already had, for the side letter, which before that, remember, there should be 4 to 8 weeks to review all the other documents related to the investment from the date that we recommended it, and it was approved. Then the staff has to respond, and the staff is going to try to respond really fast. But if it takes a year for the staff to respond, then this thing can't be done. And so that's one point to be made. Secondly, let's go to the bottom line. You get to the end of this process, and somebody believes that a question isn't answered or didn't like the answer, or they have some problem with anything related to any of the body of information. Normally, to vote on something, call meeting, et cetera, it takes a majority of commissioners. In this case, the proposal is that it takes 2, or the chairman. So if somebody has a problem, convince somebody else, and we will stop. And we will not go to a closing until it's resolved, because everybody should be comfortable with what we're doing. Don't always have to agree, but be comfortable. So we feel that this is a very appropriate process during the negotiation of the NDA process and working with Mr. Condon. We also talked about going to this process, provided some documentation back then related to that. And we hope that the commissioners will consider this. It's certainly a commission decision because the 30-day was installed by the commissioners. I feel like the organization has been criticized in the past for being slow to improve processes and procedures. And I think this should be a win for the commissioners, and I think to make sure that there is a process, and it's a win for the staff because we know what the process is and we can get our jobs done faster. So I think it's a good thing. And with that, I'll see if there's any questions.
I agree with much of what you say. I mean, the process has worked well. I think the Treasurer's Office was able to add real benefit. There were suggestions and alterations we were able to to make, and they were taken in many cases. But, we've only got a few investments out there right now. It's not a ton of them. And since we've just started, we just got finished with our first round, and everybody's very pleased with it. Everybody's very happy. I'd like to see this postponed until November, which at that time I would expect to be the biggest proponent of it. But what I'd hate to do is that we got through this first round, and it was a real burden on the office, because before I'd been doing it, and I could do it at night and Saturdays and Sundays and all that. Well, these people have lives, and they can't do that. And so it took a great amount of time. So what we're trying to figure out is how we can refine that so there's a lot less time. We probably have redone some of the work that y'all have done. We've got to just define that process. But if this could wait 60 days, which I don't see why I couldn't, that would be a great help, because then we'll get through this, and whatever final modifications we need to make to this policy, I think, will be just that, the final modification.
Jerry, I thought you and Mr. Condon had agreed on this one.
No, in all fairness, I think, we did agree to the terms of this. We had a meeting at the Treasurer's office yesterday to talk about a variety of issues, and this was discussed. And the Treasurer's staff brought to my attention probably shortly before 5 p.m. yesterday that they would prefer this to be delayed until the next meeting. And I considered it. I did talk to our senior internal staff about it. We came to the conclusion that we still should recommend this to the commission, to the commissioners, to see if they feel it should be delayed. Sometimes, and I made all the points, I don't want to go over them, and I think they'll have the merit as they may. But I think to see if a process works, you have to start following it. And I think during the break, the treasurer talked to me about stress testing, and maybe we need to stress test this and see if with all these people reviewing all these documents posted earlier, that by the time BlackRock, State Street, and Industry Ventures finally come to the certification that all this staff manpower couldn't have gone through these documents, and we couldn't respond to questions. And if it turns out that there's no way on God's earth that we can get things done this fast, then I'll be the first one to say, you know what, I think we need to talk about this again. But until we actually do that, and you're forced to see if it works.
If it's not working, we could amend it in November.
I agree.
But, Derek, didn't you also say that because of the fact that you're getting the documents prepared a week to 10 days earlier than we had heretofore, that this has gained additional time?
I want to, again, I'll try to make it real clear to see what the time frame. Before now, we had a process where a 30-day notice went out that said, we've negotiated the side letter. And up until then, and correct me if I'm wrong, staff, we did give a brief recommendation memo back at the meeting where we recommended the investment, but other documents like LPAs and et cetera really weren't posted until that 30-day review, or if people requested them. So all that body of stuff, a commissioner had no access to staff to help him review it, and had to read it on a monitor, and you had 30 days to do it. That was before. Now, what we have is, we have all these documents being posted 2 weeks before the meeting that we bring recommendations to the commission, and you approve them. There's then going to be the period where we're negotiating the side letter, which might take 1 to 2 months. Now we have 6 to 10 weeks time before the legal sufficiency notice will come out that says the review period starts, and another 2 weeks after that. So that's why we think that we're actually giving significantly more time to review these documents to significantly more people, because they can include the staff, and the documents can be printed. Just for a time frame, again, I found out about this yesterday, and again, in any new negotiation, people can change their minds, and new things can come up, and this is no deference to Mr. Condon, who I enjoy working with him, and I respect everything, and he has helped us shape this, and I applaud that. But a little over a month ago, we sent an email that had generally this process in this 14-day time frame, and I wish if this was going to be an issue, we could have come up, because I think we've shown the ability to like talk about these things and come to an agreement. But it came up at 4:45 yesterday, and I just, if I had to make a decision, which I do here, and I think I was brought in here to try to recommend improvements, and based on what's going on, I think this is a good recommendation, but it's the Commission's decision. Again, I think we've been criticized for not implementing improvements, and this is either going to work or it isn't. If it doesn't work, I'll be the. If it doesn't work, I will come back to this commission and said, I have seen evidence that this isn't enough time to review this stuff, and it would have to be compelling evidence, because it seems like there's a lot of time here with a lot of people, and if there is legitimate evidence, all of us want everybody to be comfortable with the job that you have to do. We are here to serve the commissioners, so this is our recommendation for the commissioners to consider.
We all have our piece. Mr. Benchmark is the fact that you weren't needed death. Because one person did it doesn't mean the rest of us can do it any sooner. There's a tremendous knowledge transfer here. We're looking at, some of these folks are looking at for these particular documents at the very first time. And if the commission does it, if it goes off the tracks, it goes off the tracks when there's not a meeting. So it seems to me that we can probably make these time limits. There's only one office that's really interested in this, and that's the Treasurer's Office, and we're trying to get our hands. We're not just looking at these documents. We're taking these documents and working with the bank to try to see how that relationship's off the wall. We're only talking about 60 days. And what investments do we have in the pipeline here? I've got the two of the world's largest businesses, investment houses. So this is not like something's going to probably not get done, but why do we want to change it and it's working? It's just a great way to burn goodwill is the only thing I don't understand here, and we're asking for 60 days.
Yeah, I don't know why, this is operational procedure, but on our governance procedures, we've always issued them and voted at them at the subsequent meeting. I don't see the harm in putting it out there, reading it, and voting on it next time.
Well, there are always good excuses to delay everything. We've been fiddling with this issue for a year, and we've got a recommendation from the staff. It's a simple issue. Can we shorten it to 14 days or not?
Well, let me ask a question. The present procedure allows 30 days. That apparently, from your point of view, is sufficient and it works, and you'd like to keep it at that?
Probably so. We haven't dealt with the documents as soon as they're being put on the watchdogs much sooner. But what if we get in a situation where some documents are being altered? That something comes up and they've got to change a document. Or, we've got one today where we delegated the authority to the CIO to make the investment or not make the investment. So, there will be non-standard opportunities coming through. I think it's a good chance we'll get this thing done in the 14 days, and we'll have it back over here. But this is just staff trying to dictate what could become an ugly situation, and I think for the sake of success.
I don't think the staff is trying to dictate anything to anybody. So let's just
staff is making a recommendation.
It's right off the bat. They're not dictating anything. So let's just get rid of that.
It is wonderful. When the press shows up, you become very, very mean.
No, I don't like that kind of
We haven't had a crossword all day long.
I think our staff deserves a little more. They deserve a little more respect than you generally give them.
How is it?
And if the press is here, fine. If they want to hear this morning,
just like on cue. Give
our staff the same respect that you deserve your staff to receive. End of discussion.
Well, it was your discussion all along.
Fine.
So we go back to where this is. Well, you see where this has gotten us there. The goodwill seems to evaporate pretty quickly. All we asked for was less than 60 days. Less than 60 days. I've been fighting for 2 years for this. And if I can stand another 60 days, it seems to me it's reasonable. We always operate by the prudent man rule, right? That's what we've been lectured 100 times.
What is the 60-day thing? What are you talking about?
I don't know what you're talking about.
The November meeting is in 60 days.
Okay.
Yeah. So it's 60 days.
I hear we're discussing this and nobody's moved that we adopt it. I hear a motion that we adopt the recommendation. I'll move that we adopt the recommendation. Do I hear a second?
Mr. Chairman, Does the chairman make motions according to Robert's Rules of Order?
Yes.
He can relinquish the chair temporarily.
No, I don't have to relinquish the chair. I can make a motion or vote at any time I choose. Chairman, any chair.
Mr. Feinstein, is that?
That is correct.
Robert's Rules of Order.
Mr. Chairman,
I
I
recognize
also-
you right now because I need a second before we get to that. Is there a
Before the
second?
motion, I want to make a clarification on this.
All right, I'll withdraw my motion.
There was a previously approved investment, Golub, back in May. And our proposal would be, if this is adopted now, that investment would be grandfathered under the 30-day review. It would be the investments that were recommended today going forward under the shorter review period. Golub would remain 30, just for that one.
So that motion's been out there since May.
That investment has been out there since May, yes, sir.
So it's a grandfathering of an investment. The text of the motion hopefully is at your places. I hope. Yeah.
I move that the recommendation of Mr. Oliver, as set forth in the draft of pages 229 through 31, or whatever the actual pages are, be adopted as a replacement to the 230 to 31 be adopted as a replacement for the 30-day review policy. Is there a second?
Do you need a second just to continue discussing?
Yeah.
Okay, I'll second.
Okay.
I'm sorry, could I actually ask for some clarification on this?
Yes.
You're saying that now, under this new proposal, more of the documents will be out there ahead of time?
Yes.
So, and then once the 14-day approval period commences, that's once the side letter's posted. So just say, let's use Industry Ventures as an example that we just approved today. If this were in place, does that mean that right now pretty much all the Industry Ventures documents are out there?
Yes.
And
all of our diligent information.
so probably most people reviewed those already. Okay, but
it was available for them to review.
Okay,
yes.
but if not, all we're waiting for is a side letter. And
That's right.
when the side letter comes in,
Whenever it's negotiated.
okay, so once the side letter gets there, then 14 days basically to finish reviewing the side letter.
Yes.
Okay. And that's different because in the past, people didn't have all of the documents until
the review period started.
okay, and
That
then they
was
had to
just the
review
process.
everything for 30 days.
When does the review
And there was no, and in the past, under the current policy, there's no defined mechanism. What do you do if a commissioner says, I don't like this, I don't want to do it? There's no defined mechanism how to handle that right now. It's just a common sense of the whoever the chairman is on how to
And
do it.
another question, because I think Treasurer Loftus made a really good point, what if a document changes? Is that a possibility that something in the body of documents out there right now could change? And if that happens, how would we know?
I can answer that question.
Yeah.
That's happened. I believe it was with Brookfield. We received a supplemental PPM, and so at that point, I contacted all the commissioners. You probably received an email. I think you were on board. And also, I contacted Mr. Condon because we had discussed that in advance and let him know that the new update was coming, and kind of summarized what the purpose of the update to the PPM was. And I mean, it was non-consequential in that case. And there was another one, TA Realty, I believe, had some changes after that. We summarized, or Betsy would say.
A proposed amendment to the LPA that came out literally like the day before we were set to close on it, that we had the right to vote yes or no on, but it was going to be approved by the majority of the LP, so we didn't have a sole vote on it, but we did send it out, summarize what had changed, what they were going to propose, and went from there. So if anything does change like that, we would notify you.
And how frequently do documents change from now to, say, the time the side letter comes out?
It really just depends on the investment. Oftentimes you don't
Where
see
you are
the
in the
LPA
cycle.
amendments, right? And it depends on where we are in the close. Often you don't see anything before we close. But it does occasionally happen. I can only think of once or twice since I've been here, and I've been here over 2 years in December, that we've had.
So it's rather infrequent. Is that?
No, it does
PPM
happen.
supplement
It
is
can
not
happen.
that infrequent.
It does. Okay.
So it's a very, you're right. It's a very valid point that the treasurer has brought up. I do think, however, that the proposal that Mr. Oliver's presented would still provide adequate time for commissioners and folks who have signed the NDA to learn about these changes, think about them, and give feedback.
Most of the changes I've seen have been both beneficial to us and relatively insignificant. But I would think that any sensible chairman, if there were a change that were either not beneficial or significant, what they ought to do is restart the 14-day period once they get the report from the. But you can't cover every single circumstance in written procedures. I don't, in my opinion.
I also want to reiterate on this because I don't think you can figure out or guarantee 100% of the possibilities that could happen. I hope that everybody would get comfort at the end of this process. If somebody has an issue, they just need to get one other person to agree with that issue and call a timeout before the deal was closed.
Well, if the question is just additional time, does 20 days make any difference between 14 days or 30 days?
I suspect we can make the 14 days, and we will know probably with 100% certainty that is the smart thing to do in November. It's just right now there's a lot in flux, and we haven't been able to get the processes down. So now we're going to have an artificial deadline.
All right, so if I understand you correctly, then, would you regard this as a relatively temporary situation that because of present circumstances you need some additional time, and that perhaps by November that you would feel 14 days might be sufficient?
That was my initial comment.
If that's the case, I have no objection.
How does that impact any of the current investments, Stone?
I've heard from our legal staff that the time frame on industry ventures, might be a little bit tight, but I don't think it's going to be a deal killer. I'm not aware of anything else. Are you?
No, just that one.
I mean, if this is what it's presented as a temporary situation that at this particular juncture requires a little extra time, and at the next meeting we can hopefully bring this back to 14 days, and I don't see a problem with that.
So would that be
I'm hoping it'll be an
don't
up or
implement
down
any
vote.
of this, or just change the time frame temporarily for 30? Do this procedure, but 30 days versus 14, or put this whole thing on hold and just keep doing our undefined 30 days? What is it?
Put the whole thing on hold.
The whole process, everything.
And we will endeavor to finish these as quickly as possible. I mean, that's our goal. We would like to, get the process down to where it's very quick.
Is that going to create a problem, Gary?
I don't think it creates a problem.
Okay.
One thing in the past, silence has been consent. So during this, between now and November, I would request all commissioners, once you make a decision that you're okay, if you'll notify us. It may be that everybody reaches the okay point within that 14 days, and if we've got an email back that says no problem or okay or whatever, then we can pretend or assume the time period has been properly met, even though it's shortened a little bit.
14 days begins when? Or the 30 days now begins when exactly? The review period begins after the contracts have been negotiated. The review period begins after the contracts have been negotiated to the final form, which are ready for signing. At that point, they're posted to the watchdogs, and you'll have the review period, whatever it's going to be.
They're posted to the watchdog, and there's a certification from the legal staff.
And that begins review period. Now,
it always says today begins the period.
That review period, that point can be reached within 4 to 8 weeks of the approval by the commission. So if we're looking to invest the invest, I can't remember the name of the one we were just talking about. We're talking about 4 to 8 weeks from today that'll begin. Right. So the 14 or 30 days kind of I mean, if it's at 8 weeks down the road, then it seems more imperative that you get it done in 14 days as opposed to 30 days. If it's in 4 weeks from today, then 30 days isn't such a big deal because, heck, we were going to put it in the 8-week category anyway. I mean, so I don't...
I think we'll be able to refine it to make it much faster. I think we'll be able to.
Yeah, David, in the past, we didn't have the documents, like the industry venture documents already out there. In the past, we would vote, and we didn't have the documents yet.
Well, this time last year, we never saw any documents. We just saw the one summary memo.
Right.
We never, nothing. Right. So we've come a whole long way in a year.
Based on this discussion, I'm going to withdraw my motion and just let's put this on the agenda for the November meeting, please.
Thank you. The next item, as far as a policy and a form, is related to the sourcing and disclosure form. This is something that all the commissioners and staff have actually been using, but in discussions with internal audit and compliance, who have some responsibilities under their charter, and discussions with senior staff, we felt that it was appropriate for the commission to formally approve the form and process. So I'm going to have Ms. Dory Diddy go over this briefly.
Okay, so as Gary said, this form was presented by Herschel for information back in November. It's one of the initiatives that we're working toward being, as transparent and improving our processes and policies, and to avoid even the appearance of impropriety in commission decision making. So the document, the purpose of the document is to show how the investment opportunity was brought to the commission, and also it's a mechanism, or it puts in place a mechanism by which potential conflicts or conflicts can be disclosed and reviewed by the appropriate parties. Like Jerry was saying, we've been discussing this recently, and we feel like it would be appropriate for this to come from the commission with approval, and that would include that the commission finds it acceptable that the audit committee would review or address conflicts or potential conflicts in the event that a commissioner disclosed those on their form, or for a staff member that there's a committee that would review any potential conflicts or conflicts by a commission staff member. So we think that from the staff's point of view, these are acceptable based on the governance policies, which would give the COO and the CIO authority to make sure staff complies with the law. And the audit committee has certain responsibilities under their charter and authority, so we feel that they would be the appropriate body to review those of commissioners. In light of these things, and they're on page 232 to 235. So we would just recommend that the commission approves and adopts the recommendation of staff that's listed on the motion sheet, approving the form as presented, including the mechanisms for disclosure and review of conflicts or potential conflicts, and as we generally put motions, authorizing the staff to make technical revisions or formatting edits consistent with action taken by the commission, just so we wouldn't have to come back if we changed letterhead.
And if I can just touch on this, the audit committee recommends that we do employ this form. It's something we looked at, but that's when we realized we were actually reviewing these for the investments, and that's when we realized we had not actually voted on this as a procedure at the full commission. So it is a recommendation that this form be adopted by the audit committee.
There being a recommendation of the audit committee, a second is not required, so we can proceed. Any discussion? Any more discussion? All in favor signify by saying aye. Aye. All opposed by like sign. Ayes have it unanimously.
Mr. Chair, if we have staff on the outside that need to do a formal presentation, can y'all come closer to the table, to the mics? This room kills sound, and it's hard to get it on the mics, just for recording purposes.
We are on the lectern.
Who do you want to come closer to the mic? The commissioners?
No, not commissioners.
Okay.
We got y'all just fine. Yeah, staff on the outside.
Okay.
It's just hard to hear from the back walls. Thank you.
Okay. Budget proposal.
Yes, sir. This starts on page 236. Somebody get me there, please.
236.
There we go. Thank you. Thank you. So I wanted to show a history of our budget. Oops, fast finger. Sorry for the color here, but this indicates our actual budget is approved by the General Assembly over the years and head count. I went back and looked at some recent history as far as what we requested, and there was a funding gap from request versus approval. And interestingly, you know, we've been requesting 47 staff consistently, and we were certainly delighted to get about a 22% increase in our budget this fiscal year. This year, as you can see, we had no increase in staff or head count. Notwithstanding the level of approvals versus requests of appropriations, how did we do? Because this really is the bottom line with the staff and the organization. And so this is a chart showing net of fee returns versus policy returns, outperformance, and trying to dollarize that. Again, the policy returns are assumed that you know, it was a invested passively in indexes per the AIP allocations. And so this, the way I look at this, and I think it's fair, is this is the impact of the organization. Certainly the commissioners approving recommendations, but the staff doing their job, finding managers, recommending them, doing the diligence, monitoring, recommending changes, rebalancing, you know, and everything that everybody does in here as a part of their jobs, that there's been a benefit over just buying an index and not having an organization, literally. One way to look at this is over 5 years, and again, you know, all these numbers are impacted by the 2008 performance, but 92 basis points, you know, estimated over $1 billion of excess return performance. If you go back here and add up, before this is this year, these 5 years, you know, less than $50 million of the whole organization's budget. And if somebody said, you give me $50 million bucks and I'll give you $1.1 billion in 5 years, you know, I think most people would take that in a minute. Just a little review of where we stand. Again, we requested $14 million and 12 new staff, and we got an increase of about 22%. $12.3 million with 7 new staff gets us up to 42 approved positions. There was an additional proviso added on top by the General Assembly, earmarked specifically for the fiduciary audit, so we really can't spend it on our regular operation. But technically, in the state budget system, we're at $13 million, the 12.3 plus 7. Split legislatively over 3 lines: personal services, which is, you know, salaries, etc., employer contributions, you know, benefits, and then operating expenses, everything else, systems, you know, travel, etc., legal. Generally, if you have if you're planning on having an over expenditure in one area from your budget, you can't move money. I think there are, you know, there's this BD 100 form that you can ask a transfer once a year or something like that, but generally you can't. Herschel and I have told you we filled some of these full-time equivalents so far. We're 6 short of this, as Herschel said. 3 of the new ones and 3 of the prior staff are still recruiting. The operating expense that's approved gives us the opportunity to do the RFPs that I've been talking about, and some margin for others being investigated, but I already told you about this procurement process we have to go through. Legal and diligence costs here are variable, obviously. It depends on, you know, volume and other activities, so we manage those. So a little bit about our request for the fiscal year that begins next July. Obviously, we have an important role here with what we do to invest and manage the assets of the trust. We need some specialized skills in here for management oversight. On the operations side, we're still identifying and nailing the risks that Deloitte identified. And so we'd like to request approval for 11 new FTEs. which is 5 that we've been requesting for 3 years and 6 more for growth and some different strategies. 7 on the investment side, 4 on the operations side. Some of these, again, the carryover positions of a director and officer, but the additional talent focusing on direct and co-investment capabilities, additional internal research, additional internal management, diligence, et cetera. Herschel addressed some of that. I'm sure he'd be happy to give you more details if necessary. And by the way, as I say here, at the end of this presentation you read, there's a lot more detail that I won't go over at this meeting on a lot of details of these positions and et cetera. On the operations staff, again, we've been relying solely on PIBA. We're bringing in more sophisticated systems. James does a great job, et cetera, but we'd like to bring in somebody to help us on the application development side. Obviously, reporting officers, we keep talking about the importance of our reporting and how we all want it to continue to evolve. So we'd like to bring in 1 more over and above what we're requesting. And Herschel and I kind of modeled where we are with the current strategies in place and the current AIP and SIOP, and barring some major change in strategy and philosophy, which the Commission could decide based on current circumstances, we feel like if we can get near this, we're going to pretty much be at a full staffing complement here, and any future increase is going to be very, very modest. On the operations side, obviously, we want to continue acquiring these systems for the reasons we've talked about year after year. The request in this budget is consistent with what we requested in the prior year. Remember, it wasn't fully approved, so we're going to request about the same amount again. Risk, private market, very interested in data warehouse, performance analytics, fund administrator, Herschel mentioned accounting, et cetera. It might be some fee validation services that might save us some internal costs, but because you never know what's going to be able to be approved in the budget, what we're going to try to take is a modular approach so that we don't deal with somebody that it's either all or nothing. We got to be able to bolt these things on as we have appropriations for. Procurement process is going to delay getting this information, but we're going to we plan to continue to rely on our good friends at PIBA for their for IT outsourcing. Obviously, every time you bring on somebody, there's some overhead. There's computer setup, supplies, et cetera. There is a number in the budget to update the compensation study. Over a year ago, the Commission engaged McLaughlin to look at the comp policy, do a survey of compensation levels. We've used it this year. Later on, you'll see the PIC presentation. A year from now, probably makes sense to consider updating it. I'll also let you know that we're going to take steps to try to get compensation survey information out there for free. But just to take a look at all our overall policies and procedures. We put some money in there if you think it's appropriate. The modest rate increase that I mentioned for the presentation center, et cetera. 2 important things to note that's not in this request. Nothing for the fiduciary audit. From what we understand, there won't be a fiduciary audit of us next year, as there is this year. And we are not including any costs for global or domestic custody in this budget. And as you know, the Treasurer is working on an agreement that's going to change the economics of that so that it won't be paid out as second lending, but it's not in our budget. So these are the numbers compared to last year. It's a 25% increase in total, but if you exclude this, which was earmarked, it's really about 32%. And this is worst case, and that's to make sure that we have enough money, assuming we're fortunate to get this approved. You have to assume that all these people are hired on July 1st. They all, and the investment staff get the full PIC, and we get all of our systems acquired on the 1st, and you pay the full year license fees and setup and et cetera. But there's likely to be normal delays in this, as every year. But you have to budget for the max, and when you get it, you have to be able to afford it in the following year as well. This is a simple analysis of the biggest changes going from the $13 million this year to this budget. Obviously, we're reducing it by 7. There's a $3.2 million net, primarily driven by personnel. let's face it, our most important asset is our people, and we'd like to get more of them with the skill sets that we need to do our job. Systems capabilities, again, we're going back to ask for what we did last year. It wasn't approved, so we're going to ask for it again. So this is a pretty simple analysis to show you where we're at. The rest of it, again, are the appendices of the details that you can read or ask questions about. Obviously, this, the presentation before the General Assembly will happen months after this, but we'd like the Commission's support and approval for this level of budget request, and we hope that the performance of the past justifies what we're asking for.
Is there a motion in the packet? On page 4, the first full bullet on that page, which would be the Commission authorizes COO to submit a proposed FY 2015 detailed budget substantially similar to the draft budget presented for inclusion in the Governor's annual budget.
Can I ask a question?
Yeah.
In the past, we had a budget subcommittee that I think Jim Powers ran. Do we not have that anymore?
The full commission would be the budget committee.
I mean, we got to submit a budget, so I'll make the motion because we're going to have to get it and talk about it at least. So I'm making the motion, even though I can't vote. Because we're not going to meet again before that budget has to go to where it needs to go.
Okay. Now we'll discuss. Anybody got questions, comments? Travis, I'm sorry. All right.
I just wanted a little more information on the custody charge, potential custody charge, whatever you want to call it. So, I don't know who responds, the treasurer and Derek or whoever. But they're assuming that securities lending doesn't take care of it some way like it has at times in the past. It seems to, doesn't the custody charge, whatever it's going to be, need to be in somebody's budget, even though it may be going to come out, I assume it's going to come out of the trust, but doesn't it have to first be in somebody's budget?
I would think it would have to come out of the general fund.
But, the general fund of the state?
I would think so, because the retirees are not the custodian of these funds. The treasurer is the custodian, and your office is funded by the general fund, isn't that correct?
Yeah, but that's not the way it works, though. The trust pays the expenses of the trust. I mean, we pay, the trust pays all the bills, whether it's a wire fee or post office or rent or whatever, it pays it all. General Assembly gives permission to spend that money. This is an unusual situation. In the past, we've earned as much as $6 or $7 million in securities lending. That's all, of course, gone now. Last year, we were able to procure services for, I think, $240,000 is what we paid for core custody, which, of course, is a real bargain. At some point, they're going to kick us to the road. So that's one reason we're hustling with this contract. It ought to be in somebody's budget. It ought to be in either David or Gary's budget, because they're the ones who are going to authorize the spending of that money. Because it depends on how many accounts they want to have and type of custody arrangements they want. It comes through the treasurer's account or contract as the custodian, but we don't. We're not able to pay for those fees that other folks want.
Well, in the past, on the securities lending, the retirees have been funding a part of the operation of the state government, and that's never seemed fundamentally right to me. That they don't have. Why are the retirees paying to fund the state government?
Because it's a cost to the fund, just like this rent is.
15% of the securities lending proceeds. When I got on the commission, I was told that went to fund the state government. And
just the investment operations. They were using it to pay for Bloomberg's. Like, they were using it to pay for some of the tech costs, which is not uncommon, by the way.
Yeah, but wasn't it coming out of the retirees' earnings off of the securities that they lent?
Yeah, I mean, it would be a reduction in the amount of cash that went back into the account.
Well, to me, that sounds like the retirees funding a portion of the operations of state government.
Well, they are. I mean, we are a portion of the state government. I mean, you guys get paid. These computers, these desks, this is all state government.
I think certainly it's an appropriate expenditure of trust funds to pay for custody of trust funds, but not to pay for any other custody cost of any other fund.
That 15%.
That whatever's been custody on behalf of the
existing
trust fund, I
contract.
think that's an expense that can be borne by the trust itself. I think you have to. I think the settlers or the legislature has to give somebody authority to spend that money. I don't think I have authority as PIBA, or I don't think PIBA has authority. We have authority to spend money to do our administrative task as approved by the General Assembly. We don't have authority to spend it on a custody cost right now that I see. But I do think custody would be an appropriate amount of money, appropriate expenditure of trust funds on behalf of money, to pay for trust funds that are custody, or the cost of those, the custody of those funds, but nothing else.
Yeah, and I agree with Dave. And the reason I raised the question, I hate to see us get down the road and nobody has it in their budget, and there's no money, approved to pay it. Assuming we don't have security lending.
The Treasurer's Office has in its budget funds, general funds, for that purpose, for the core custody.
All right.
This always gone back to the reporting thing, right? We tried to, a couple of years ago, put it all out there, right? Because back to the lending, right? I mean, you can say, okay, if I didn't have the fee split, I'd be getting $10 million back, but with the fee split, it becomes $2, and so you're getting back sort of a netted number, right? But it's treated from a transparency and a reporting standpoint completely different across the road, right? And so one of the problems has been nobody's wanted to admit that these custody costs and operational costs exist at all. They've always said, well, just have it at a net number back into the fund, because nobody really wants to see it, and they want to pretend like it's not there.
Fees, expenses, right. They just... It's difficult to understand. You guys get it because you deal with it every day. But when you don't deal with it, you say, "What? You mean we're spending money someplace else?" They don't get it. So I think it just as a general principle, everything ought to be as transparent as possible. We ought to write a check instead of splitting fees. It would be cheaper for us.
Would we be getting a bill if we put it in our budget? From whom would we be getting a bill?
Bank of New York.
Well, we don't have a contractual relationship with the Bank of New York.
But it comes through the custodian account.
So we'd get a bill from the custodian?
Yeah, that's sent it to us. That's the way it's always worked. If you remember the agreements you signed with Converse and the ones Mr. Powers signed previously, y'all negotiate a service, bill comes to us, we review it, we send it to whichever party needs it, and then y'all would authorize payment.
So our bill would come from the Treasurer's Office. Treasurer would basically be a pass-through from Bank of New York.
We've preliminarily they'd like to be paid on a quarterly basis, so it gives us plenty of time to look at the fees, make sure that they're reasonable.
I think one thing you really want to consider when you're thinking about putting these costs on budget is that there's, especially as it relates to the non-U.S. assets, that there are variable charges based off of the AUM. So you may plan and budget for $2 million of costs, but because your AUM allocation may exceed and you find yourself needing to pay $2.5 million for custody of those assets. So to actually budget for an exact amount will be very, very difficult. It seems to me that, and I don't know if this is even possible, but that if there is some agreement that custody should be a necessary expense of the trust funds, that there should be some form to pass through whatever that exact cost is, as opposed to putting on a budget, because it's going to be very hard to predict exactly what that figure is.
Yeah, and the transparency issue is the same as in the fee area. It's the same, and it's a perfect analogy to me.
Yeah, but at the end of the day,
you need to be transparent, whatever it is.
We're not exactly where we want to be with the fee, so let's don't bring that one up. But I agree with you, yes, sir.
You can hide them and look at the net, or you can be transparent about them. And if you want to be transparent, then you put it in somebody's budget.
I always thought Bob was very upfront about it. He'd say on budget or off budget when we had these conversations. He was very upfront, and there were no secrets from over there. So I do think because of just the environment, we're going to have to bring them on budget, and I don't see a problem with an arrangement like you have couldn't be reached with the General Assembly.
I think that that you have to have some variance in what that custody cost will be, because you will have to pay it. And again, as you transition assets from commingled funds into in-bank assets, that custody cost is going to continue to increase For the domestic piece, we know that there's a flat fee out there for domestic, but for the non-U.S. assets, it's an asset-based fee. So the more assets that go into custody there, the higher that cost is going to go up. You can try to pro forma and have an idea of what that cost will be, but it's not necessarily going to be exact. So you will need some variability and approval for way overshoot it just in case, and recognize that you may need some room, or it could impact how you actually have your assets in custody. But at the end of the day, whether we're talking about going forward or legacy, securities lending revenue as it relates to the trust funds would belong to the trust funds. The revenue split that was taken out by Bank of New York of 15%, that paid for the custody and the ancillary services for Bank of New York. That in itself is a negative net reduction to the overall securities lending revenue that went back into the trust. So the trust, legacy-wise or going future-wise, I guess there could be some debate, but legacy, the trust is, paid those costs.
You don't own any money.
So and so I think that as you go through this contract, you build that in to say that maybe you have to get the expectation of what this pro forma is approved, but have some variance around what that potential cost could be if you're putting it on a budget. Because I think for us, where we're at, we're struggling to get dollars to build out just simple technology and systems. And if you got into a position that now the custody costs are going to be higher, then does that then start to cannibalize your other budget for risk systems? And that you don't want to get into that situation. Right. So it's a discussion, and you got to figure out how it's going to be paid for. At the end of the day, fortunately, the securities lending revenue is not that high, so we're probably well underpaying for what the actual cost of custody is right now. But in prior years, you probably overpaid. But at the end of the day, it's a cost that has typically been borne by the trust funds, and that's not just South Carolina. That's typical in the public pension fund world. So.
For the global custody, even the domestic cost, you put that in your budget, you submit it, and you don't get 100% of your request approved. How do you pay for the rest of those costs? And I guess we're talking about next year's budget. I mean, unless I'm wrong, are we going to have an issue coming up real quick when the new custody contract becomes effective? Are these custody costs going to have to be paid in this fiscal year? And, again, our budget's been approved. It wasn't in there. Who's going to pay that invoice?
So to get to your point, Herschel, and to yours too, Mr. Treasurer, in terms of transparency, if it's a trust fund expense and there's no way, like for instance with the global custody or the foreign assets, to project the exact amount.
The exact amount, right.
Would it solve the problem if the legislature authorized payment of custody out of the trust funds, and you're picking up the accounting because there's going to have to be an accounting for any money that's withdrawn. But instead of having it a line item on budget that's approved by the legislature, instead the legislature's authorizing the amounts essentially to be deducted from the trust fund account.
To me, that sounds
and you still have an accounting of it. It's unlike just the SEC lending split where it's 15% and it may be more or less.
What you want to do is because you want to make sure that if your pro forma costs are lower than the actual realized cost, you don't want to cannibalize your other budget dollars for operations. And you guys certainly know much more about this than I do, but if there's some way to have an approval or proviso attached to it that there's an approval of a fee schedule by those markets and a pro forma of this is what we expect, but it could be different, and that is just they're approving basically that's the general direction you're going to be at, but that will come directly out of the trust fund as opposed to directly out of someone's budget, then maybe that is one way to do it, because I really don't think you want to be in a position of putting your budget in jeopardy if your custody costs go beyond. Or the flip side is if they're below, then I'm not sure that anybody wants you to have a windfall for a year either. So.
Well, if it's netted out of the account, then if it were lower, we're earning interest on that because it's sitting in the account. Well, no,
Yeah, I guess
that's
our budget's not
irrelevant.
taken until it's actually used, so it all stays back in the trust. But you wouldn't want someone to accuse you of maybe you overstated and you actually came in under it just to get a bigger budget, and that whole issue, you'd want to take that completely off the table. And I think that whatever gets approved, you want to make sure that this is a very specific approval for this estimated cost based off of this fee schedule, and it could be slightly higher, slightly lower, but this would come directly out of the trust as opposed to PIBA's budget, the treasurer's budget, our budget.
We run several organs in the Treasury Congress where we have similar type of arrangements, not exactly the same, but similar, where the General Assembly understands there can't be costs, and we have to end up deducting those costs from a particular pot of money. Say a bond issue. That's one. And so I don't think that the mechanism is not very difficult. It would just help if all three parties agreed that that's the way it was going to do. I don't think it'd be difficult. Of course, David would, kind of be the grandfather of this because he's the ultimate protector.
A mechanism in place similar to that.
Yes. We do. I mean, say like with the bond issue, we issue the bonds and we'll capture the money from the issue. Similar to a trust, we don't know the expenses until the end. We get all the underwriting expenses and the lawyers, and so it's a similar type of thing. They don't know what it's going to cost. They give us the authority, and then we capture that money at the end of the process. It would be the same here on a quarterly basis.
Language to staff, they can start working.
Yeah, so like on a quarterly basis, the treasurer would just receive the bills, capture the money from the trust, and it would effectively be one of those kind of not seen, but it would be duly recorded. I think that's easy enough to do. But it's important that David has really good comfort in that because he's just the protector in this issue.
Is it reasonable to assume that you two can work this out and we just move on? I mean, ideally, we don't want it in the budget, but I just want to be sure it's taken care of somewhere.
At best, we want an asterisk in that budget.
The cost is going to depend on how many accounts are in the bank for these things. So it can't be we can't exclude y'all from it has to be.
Yeah, I think he meant us all.
We can do whatever we want to, but if
I was going to get out and put you in charge.
There's got to be some. The triangle has to be around the table.
All three bodies to figure out what needs to happen and come up with a joint proposal.
So, I mean, that deals with that issue. I mean, you have the FTEs, and just the way that budget process, clearly all 11 aren't going to probably get approved, right? I mean, I've never seen it happen. I don't expect it to happen. I mean, I don't know that, but just know if you get two, I mean, out of these provisions, because some of them are operational, some are investment, which have y'all discussed and know, all right, you got two, which two are you going to fill?
Short of flipping cards for it, I'm going to defer to the fact that, we need to invest and manage the assets of the trust.
It really comes down to seeing what resources you get, because if you get zero for technology as well, that impacts what decisions we have to make. So to sit here today and say which ones would you hire, it's very difficult. I think that if you get zero increase in budget or a half increase in budget, you've got to go back and circle the wagon and say, all right, based off of the goals and objectives of what we want to accomplish, what could you even do? And so, for instance, if you budgeted $500,000 for a risk system, but you only get $250,000, then well, I can't pay for the risk system. I can't get half of it. It doesn't work that way. So you have to go back and remap the whole thing, and then come back and we can give you an update as to how that budget allocation would be spent that year and the FTEs.
That's exactly what we did this year. And we looked at the total number of staff and determined how many would be investment versus operations. And Herschel's right. Part of it was how much money we have to spend on systems, which was cut.
For the first time today, we're in danger of getting behind schedule. Can we go ahead and vote on this?
Right.
Anybody feel like they need to explore this topic further?
No, I would just add that from, I guess, audit committee standpoint and the risk assessment and stuff, the reporting infrastructure, I think, kind of rank ordering within the budget, I think we ought to keep that in mind. If you don't get it, I'm going to ask.
All in favor of the motion as printed and read, signify by saying aye. Aye. All opposed, like sign? No. One no.
One no. Okay.
Mr. Laughlin.
Thank you.
The ayes have it.
Next item.
Legal update.
Legal update. I'd like to have Ms. Betsy Byrne give you an update on the Tribune bankruptcy litigation matter.
I stand here.
I can't. No, he wants you to get over there by that mic.
Trying to avoid that. All right. Okay, we just wanted to bring up this litigation that has been in place for some time. It has been stayed, so we've not been needed to respond. But essentially, Tribune went through an LBO back in June and December of 2007. It left them with about $13 billion in debt. Less than a year later, they filed a Big 11. The Unsecured Creditors Committee filed suit naming thousands of defendants, everyone from the board of directors to advisors to shareholders, anyone who had received, a shareholder that had received more than $50,000 as a part of the stock buyback. And the suit is seeking to avoid or treat as what's called a fraudulent conveyance under bankruptcy law, the transfers to the shareholders in connection with the stock buyback, among many other claims that have been asserted. The litigation has been stayed for several years as the case worked through the Chapter 11, and they worked out deals with the lenders in the LBO. And we've been monitoring the case for over a year now since we first received a copy of an amended complaint that named the retirement system as a shareholder defendant. A litigation trustee has now been appointed, and Tribune has emerged from their 11. Their plan was confirmed, and it appears that the stay on the case may be lifted sometime within the next few months. So we thought it was an appropriate time to bring it before the commission. Once the stay is lifted under federal law, under federal rules, we would have possibly only 21 days to respond to the complaint. So a timely response would be needed. However, I expect that they're going to issue a procedures order because this case is so massive and it's been under a special order for a few years now that would set very specific deadlines as to when answers and 12B motions to dismiss and other types would be filed. The records that we've obtained through BNY indicate that retirement systems received around $1 million in the buyout when they bought back the stock that we held. The plaintiff is seeking to set aside this transfer as a conveyance under the bankruptcy code. They're not alleging fraud as to the retirement system. The fraud that is titled within this section of the code is as to the debtor's conduct. These claims are used by trustees to bring assets back into the estate so that it increases the assets available to distribute to the unsecured creditor class as a whole within the Chapter 11. There are currently several law firms that are representing different groups of defendants, and we believe it would be most cost efficient to seek the AG's approval to retain as outside counsel in the event we need counsel. One of the firms, which is currently providing and actively involved in representing other state pension plans. There are tons of pension plans that have been named in this case. Again, there are literally thousands of shareholders that have been named. So we put forth a motion, and we're requesting that the commission adopt that it will permit the COO and legal at our discretion to pursue retaining counsel as needed to represent the trust funds in this case and authorize engagement of the counsel upon approval by the AG's office. And if anyone has any questions or wants to discuss it in more detail, I'm happy to take those now. It's our records, the records we got from the bank show that we received about $1 million in the stock buyback.
Right, but that would have been, presumably there's some value prior to the LBO announcement.
Presumably.
So you would have
That's not what the plaintiff's alleging. There are, and I mean, obviously there are certain defenses. I don't want to obviously get into those unless we're in closed session. But the risk, as I see it, this is a distinct case from a case where there's potential money that we may decide is not cost effective to go after. In this case, this potentially could be a default judgment against the retirement system. Now, whether or not they would be able, right, they would be coming after us for that money potentially if they were to get a judgment.
If and when y'all hire counsel, y'all will provide us with the name of the counsel and the fee arrangement?
Yes. Mm-hmm.
Did I hear a motion? second? I got a second. Any further discussion?
I mean, my only thought on it, right, if we got back $1 million and presumably the buyout premium was, what, 30%? And we're talking $300,000, we're going to spend what on legal?
Well, I will say the firms that I talked
For that, we could tell them to go stuff it, send it to a creditor, and you'll get a third of it? I mean,
well, and that's certainly
seems like a lot of effort.
an option. The law firms that I talked to that are currently actively involved are doing a cost sharing. So that would be a benefit of going with one of the firms that's representing a lot of the state plans because they're prorating the cost. One firm is prorating the cost. Half the monthly cost is divided just flat out among the plans, and then the other half is done pro rata based on who's got the largest claim. And from what I was told, our $1 million is on the lower side of the claims that they're dealing with. So we would be sharing a smaller portion of the bills.
Do you need any input from the trustees on hiring an attorney to represent the trust fund in this type of litigation? As
I don't think so. I think it's regulation of management of the assets.
I mean, the option, there is the option to just sit on the sidelines and let them get a default and take their chances, but that's for the commission to decide, not for me to decide.
Well, it just seems like they're.
I've never recommended any client exposed to $1 million to just sit on the sidelines and see what happens.
Well, I mean, they're clearly going after guys who owned a lot more stock than we did, right? And our exposure can't be the total dollar amount we got back. I mean,
no, but we don't know what if we don't fight back, then we don't know what some jackleg lawyers go convince some idiot judge to do.
Our outcome's not going to be any different than what it's going to be for the larger shareholder. What? Right? They're not going to split the class.
I presume they're asking for punitive damages and attorney's fees. So I would think
under the bankruptcy code, they're suing. The claim against the state funds is under Section 548 of the code, and they're essentially seeking to turn over the entire transaction. Now, there are statutory certain types of defenses. However, depending on the way they bring the claim, some of them are not available. And they're actually, and I don't want to get too in the weeds with the bankruptcy law, but they are bringing this claim under 548A1, which is an intentional fraudulent claim. And some of the statutory defenses that would be available are not available under that section because they're alleging that the debtor had intentional fraudulent intent when they constructed. It's not just our transaction, it's the LBO as a whole. So they're not looking just at you own this amount in shares and I bought them back from you. It's the whole LBO structure of the loans that they took out to get the money to pay for the transaction. They're trying to collapse it into an entire one transaction so it guts some of the potential defense of, well, the shares had some type of intrinsic value, potentially.
And Ellen, and that was a wonderful explanation. Just to build on what Betsy's saying, default is just not an option. The next time we have to sign an investor rep letter, Nancy and I were just saying, you don't want there to be a blemish that we have to explain to the GP of a fund about why we defaulted on a judgment in bankruptcy court.
And I will say these rarely go to trial.
A place to go.
These rarely go to trial.
Yeah,
this would most likely, these rarely go to trial. They would.
If they're split the attorney's fees that way, our fees would be nominal.
Yeah, and
that's an incredibly small hourly rate for us.
So that's the motion that we would like to have you consider.
Take a vote. I seconded it.
Okay, we're ready to vote. All in favor, signify by saying aye. Aye. All opposed?
I'll abstain from that one.
Okay, ayes have it.
Oh, wait, I'm sorry, 2 abstentions or no, just 1? Okay. Thank you.
Thank you, Betsy.
Okay, next.
The next item is a securities litigation update that I'm going to ask Robert Feinstein to give. I understand that our policies require this to be given quarterly. I think we've been behind in doing that for the commissioners. We don't plan to let it happen again. I think Robert's going to do a catch-up update for you all, and we'll make sure that this gets updated quarterly.
Thank you, Karen. Earlier this week, I sent an email to all the commissioners regarding this topic of securities litigation, I'll do a quick little summary of what was in the memo and the 2 reports that have now been posted for you on Watchdocs. The Commission's securities litigation policy, the most recent iteration of which was adopted in November 2011, calls for legal, as Gary said, to provide quarterly reports to the Commission regarding the status of 2 things: securities litigation-related claims, in which the Commission may be eligible to obtain a recovery, and actual recoveries collected. In going forward with the quarterly reports, what we're going to try to do is house them on Watchdocs, a nice little home that Mr. Manning is helping us to create. He's feathering the nest right now. You'll have the ability 24/7 to pull down these reports and track the progress of the securities litigation recovery function, which relies very heavily on the Bank of New York Mellon. For a number of years, the custodian has performed ably, we believe, the function of timely submitting claims in connection with securities class action matters. I want to just take you through very quickly what those 2 reports were that I posted, as well as the memo. The first report that I posted is from Bank of New York Mellon. It shows all securities litigation-related claims as of June 30, 2013, in which the Commission, on behalf of the South Carolina Retirement System Trust Funds portfolio, may be eligible to obtain a recovery. And then the second report, also from Boney Mellon, shows all recoveries that were collected for the portfolio during the fiscal year. The materials that were posted are rather straightforward, and I'll be happy to answer any questions. But again, apologies for falling behind, and as Dara said, we will catch up and stay current.
I've got some questions. This is a quarterly mandate. I think this is the first one I've had since I've been on the Commission for 2.5 years now. This report from Boney I'm familiar with, but it doesn't really, I mean, it's a good housekeeping report, but it doesn't really tell us anything. I'd like to, since we seem to have a new standard and a new interest in litigation, can you help me understand some of these? On the amounts that were the plaintiffs filed for damages, what percentage have we recovered, either on an individual basis or overall?
Individual or overall. Mr. Loftus, that is not information that we have tracked in the recent past. Nancy used to maintain very voluminous records on things like that. Suffice to say, the data for the fiscal year ended 2013 indicates that the recoveries in the vast majority of the cases are more nominal in size. And I don't know the percentage of recovery. The fees is a percentage of recovery.
Yeah, that's
I wouldn't know how you would use, what number you'd use for the denominator.
Yeah, we were able to track a lot of that. What's the what were their attorney's fees in dollars or in a percentage?
And Mr. Loftus, that is not something that we presently track for the actions that are filed by Boney Mellon. That is something that the securities litigation policy certainly contemplates, the ability to, on the Commission's part, to identify instances where attorneys' fees are deemed to be out of line, and to then perhaps file objections with the court. That is something that can be done. That is not something that we have noticed as a problem in the cases that are covered in the report.
What were the? So you wouldn't have any idea what the fees were. So we're receiving these checks, but we don't know what they're for.
I'm sorry?
We're receiving refunds or money, and they're going back into the accounts from which the loss was originated, but we don't have any idea whether they're fair settlement or not fair. We're not tracking any of that.
If they're class actions, the federal courts and the state courts have to approve all those settlements and the attorney's fees. So it's always if somebody's interested, all they got to do is track back to the court records, and so it's all these elaborate processes that the judges go through to approve attorney's fees.
So we're okay if a judge approves a fee, then we're okay with it.
I'm gonna answer the question by repeating what I said. The securities litigation policy that the commission adopted in November 2011 certainly permits the commission in instances where it feels there's a problem to object to fees or take other steps.
But we wouldn't know if there's a problem if we're not tracking the fees.
That is a fair point.
So it's our overall presumption that if a judge signs off, we're okay.
It's not quite. It's not quite that.
No, they're claims that belong to the trust funds, and they are, for that reason, important assets of the trust fund. These are very fair questions.
Do we pay all fees on a percentage basis as determined by the court, or do we ever have a situation where we pay an hourly fee?
But Mr. Loftus, the one thing about the structure of federal securities class actions is that when we are a passive member of a very large class, these arrangements are being struck in the typical case by the lead plaintiff with counsel, and then ultimately with the court's approval. So that is not a matter that a passive member of the class typically gets anywhere close to.
So, no?
Yeah, at the inception of the litigation.
I just want to make sure.
Right.
In federal bankruptcy court, do the parties actually have to agree, or would that mainly be imposed upon them?
Did you say bankruptcy?
You switched over.
Litigation. I'm sorry. Excuse me. Litigation.
So one more time. I'm sorry.
Is it likely that the parties agreed on the determinations, or is it more likely, just from your experience, and this is one of those off the top of your head questions, that a judge would impose that settlement?
Usually the lead plaintiff would agree and present it to the class. The class votes whether to participate or not. If they choose not to participate, then they can go sue on their own. If they stay in the class, then the lead plaintiff is going to be in charge, and the lead lawyer is going to be in charge, and the judge. Everybody who stays in the class is going to be stuck with whatever the judge decides.
As I understand this right, so either the parties agree or the judge decides.
About what? The terms?
About determining the whole event.
It's always going to be triggered by the parties agreeing. A judge is not going to bother to decide if they haven't agreed unless they've tried the case.
Right, and about 99% of these matters settle. So in the typical course for a federal securities class action, I've been dealing with these since before the enactment of the PSLRA in 1996. So yeah, in the typical course of the life cycle of these cases, settlement negotiations heat up, and you finalize the settlement, you send out the notice of proposed settlement, which is a model of transparency in that the fees that counsel is going to be requesting will be very prominently indicated, and moreover, that gives opportunities to members of the class to identify and object where appropriate to the fees. And it's wonderful that there is this kind of robust data available to us all regarding federal securities class actions, but it is in no small part because the rules of the game permit that, unlike in state court where settlements can get finalized and there is no disclosure to stakeholders or parties in interest about legal fees.
Let's see, we've got two more questions. So I'm not quite, I mean, you were trying to make a point without making a point. I got your point. So either this can be either settled by the parties themselves or it can be enforced by the court. Well, I mean, the
federal
judge.
securities class action, no, the judge, the court.
I mean, he hears the case and the judge decides.
Well, a settlement, again, 99% of these things settle out. I think since the PLSRA's enactment in 96, something over 3,000 cases, 30-something have gone to trial, 99% settled. So you're talking about a proposed settlement that goes to a judge, and the judge decides ultimately whether to accept the settlement or not. Did that answer your?
No, yeah.
Okay.
I don't know the answers. And in these cases, notices go out. There's a pot of money. The settlement legal fees come out of that pot.
In the typical case, I believe that is pretty standard, although, I mean, I don't know if it comes out of the exact same pot or if there are arrangements a la the settlement agreement that you struck, where there's a separate payment, a payment deemed to be separate and distinct from the recovery to the class.
It's my understanding that almost all of them come from the settlement agreement, and then that's what the little postcards you get in the mail, or if you look it up in the Wiki and Desk and all that, they show how that's all done. And there's a large sum of money, and out of that, of which the fees are paid. So I think, like I say, it's pretty transparent. But then, of course, that does reduce the amount of money to the trust because the funds came out of the settlement.
But you can't. One of the interesting things to me about the securities class action is that there's really no way to predict what your recovery is going to be. When you see these notices, there'll be an estimate. Some of them may have an estimate per share recovery. And they may break it down as far as to an estimate of a per share attorney's fees. But the reality of it is you can't sit there and say, oh, well, these were my losses. I've lost $1 million on this stock. And based on the settlement agreement and what it says, I'm going to get $1,000 back. Those are estimates because the actual recovery is going to depend on how many members of the class actually file a claim. So it's almost like the more members file a claim, the less your recovery is going to be. But one thing's for certain, if you don't file a claim, you get zero.
I mean, it all just becomes mathematics at that point.
Yeah, but you have no way to predict.
But it doesn't matter. The pot of money is the same as how many times you divide into it. That's right. So it's just mathematics.
The pot of money,
yeah.
but
I mean, if it's $1 billion, and like when
yeah.
Toyota gets sued, and there's $1 billion, and some lawyer gets it, they split it up, and it comes right out of the corpus of the account. So that's my point. Okay. Well, good. And now, if we wanted additional information, how would we get that?
Oh, I'd be delighted to sit down with you and the other commissioners to talk about this further. Mr. Chairman, may I just make one comment about staffing and resource allocation? Sure. Thank you. I would love nothing more than to spend a bit more time on the class action litigation component of the bigger picture that I have to oversee with my wonderful colleagues. I oversee a big litigation function. Securities litigation is one part of it. As you heard from Betsy, who's wonderfully gifted in bankruptcy and creditor rights, bankruptcy law matters arise from time to time, thankfully. Kind of rare. We've had a couple that we've had to look at. We also review and analyze other potential litigation matters like FX litigation claims, which I remember we talked to you about in early 2011, LIBOR securities and antitrust law issues and things like that. Suffice to say that I'm responsible for, along with my three colleagues, a wide array of litigation matters, but none of them, sir, have come remotely close in size and significance to the lawsuit that was brought against Boney Mellon in 2011, where of the state's estimated $200 million loss, approximately 80%, or $160 million, was sustained by the trust funds. And so once that suit was filed, our job in legal, our little team, was to, as you said in January of 2011, to recover every penny due to the citizens of South Carolina. And we staffed that case accordingly. Every one of our lawyers spent time on that case from the time that the subpoena came in January 2012, an amazingly and truly overbroad subpoena, which outside counsel did not do a great job of fighting to restrict or limit. And so our lawyers were forced to review hundreds of thousands of pages of documents. We were very proud to assist your lawyers in prepping 8 retirement system employees and 1 commissioner for their depositions. They showed up ready, and they did a great job. We answered many questions from outside counsel, and while we didn't get to submit a bill for the legal time we worked on that case, I want everybody to know, the commissioners, the participants, and the beneficiaries, I want them all to understand that the commission's staff, and its legal staff in particular, did its utmost to assist the treasurer's case and to maximize the trust fund's recovery. And if I had to make that staffing decision again, sir, I would unhesitatingly do it. It was the right thing to do. $160 million loss. The recovery on securities litigation in the fiscal year ended June 30, 2013, is approximately approximately it's a little over $2 million, very significant. One of those items constitutes half of it. So we had recoveries from 60-something matters that equate to about $1 million in losses. I would make the same staffing decision again in a heartbeat.
I don't know what your point is, because all you did was run a report from Bank of New York.
Because
if your staff's so low that it took that 5-minute soliloquy to tell me that you couldn't push the button once a quarter, well, then you really are staffed.
I apologize for
I don't know what
that,
point you're making.
we will get current, and I do apologize.
He was wrong not to do the quarterly reports, and he said so, and he's going to do them in the future. Okay. Any other questions? Any other commissioner? Let's move on to the next item with performance incentive compensation. Who's going to make this presentation? Dare you, or is Suzanne going to do it?
So obviously, everybody that was here last year, you have a background on the performance incentive compensation, or PIC plan, which is actually a part of the overall compensation policy of the organization. I said earlier, we hired McLaughlin in early 2012 to evaluate the plan. It was approved last year at a commission meeting, and the compensation policy adopted at the May meeting. It was utilized for the PIC payment for the fiscal year ended June 30, 2012, which was made in October 2012. This year, there have been no changes to any part of the plan terms or mechanics. Again, just as a refresher to make sure people understand what the PIC plan encompasses, only involves investment staff, no operations staff. Although, my feeling is that everybody in this organization plays an important role in the success of the organization, but this plan is for the investment staff. There's a maximum opportunity determined for people on the investment staff. Oops, sorry, wrong button. 3 levels: analysts, officers, and directors and above. And the max opportunities for this year that we're talking about for payment is 60, 80, and 100%. These are determined at the beginning of the plan year. If you recall, at the May meeting, we made you all approved a similar determination for the fiscal year that we just entered. So this is the year that we're talking about the payment. You have to still be here to get paid. So you can be employed on June 30, 2012, but if you aren't here in October when this payment gets made, if you approve it, you don't get a penny. And that's an important recruiting tool, I would say.
Excuse me, I misunderstood.
Yes, sir.
Did you say that this is done at the beginning of the year, but then we did this one in May of this year?
No, I said the plan was approved in May. At the beginning of each year, these maximum opportunities are approved, and I just gave the example of it this past May. You all approved the ones for the year that we just entered that we'll pay next October. But this was for this year that we're going to be paying now. And in fact, you approved the same levels for this current fiscal year as well. And net returns, net of fees have to exceed policy benchmarks. We've talked about that. So I'm going to apologize for this schedule because it is an eye chart. It was in last year's presentation, and I promise you it will not be in next year's presentation. I believe McLaughlin actually did this, but this summarizes the plan. I'll spend just a brief amount of time on it. We talked about expressing the maximum PIC opportunity, 68 to 100% of your salary. There's a chart that says, based on years of employment with the investment staff, you fall into a certain scale where a certain percentage of your full PIC is based on a certain year of performance. In general, if you've been here for a long time, 4 or 5 years, you benefit from the 3 years or 5 year time frame. If you've only been here for 1 or 2 years, you don't benefit from those longer periods. More of your percentage of your PIC is based on 1 year or 2 years, and in fact, there was a discretionary component to make up the difference. That's all that means. The policy benchmark doesn't have to be met, it has to be beat. And the scale is by 0 to 50 basis points. And there's a 0 to 100% earning, so if you beat it by more than 50 basis points, you've earned 100. You can't earn more than 100%. This was an example at the end of the year. if the one-year return was beaten by 20 basis points, that's 40% of the 50. You beat it by 55, that's more than the 50. You got 100% of that term, et cetera, et cetera. And that's how, and that was the maximum, that's how much the person would be paid in PIC. There's a number of other terms of the plan, you know, if there's significant negative performance, et cetera, that you can read, but, you know, they aren't really applicable for this year. But it's a fully defined plan that was presented to the Commission and approved by you last year. You've seen this chart in the budget presentation. Here it is again. In order to earn the PIC in these categories, this has to be greater than 50%, or you don't earn 100%. If it's less than 50, there would be a prorated portion. Everything was earned 100% this year. In the package and in the policy, there are two things that our consultant HEK reports on. Number one, were we in compliance with the AIP? And number two, to review and verify these returns and the excess. And HEK has provided letters on both of those issues. They were available for your review, and they have confirmed that we were in compliance with the AIP and validated the returns. So it's pretty straightforward. This is a plan that you installed, and the returns were generated and verified. 14 investment staff are eligible based when they join the team, and the total formulaic calculated payment is $1,400,645. It's based on the max opportunity that was earned, and the people that had discretion. Our CIO determined that they earned the max of that piece of their of the PIC. The Commission not only has to approve the total payment, but the policy also requires approval of any aspects of the CIO's compensation, so you also specifically approve that. Internal Audit and Compliance reviewed this calculation and validated it. Upon the Commission's approval, we will send the package to the Comptroller General for payment as soon as possible. Any questions?
Just a question, kind of a follow-up from this morning about the letter Ms. Bernard threw over. Russell Investments synthetic exposure data. Did you use the numbers off of the in BMI reporting, or did y'all do that extra math that you were talking about that might be needed to refine?
Well, to look at the actual exposures by asset class, we included the Russell overlays. So if you were holding cash in Russell overlays, we're looking at the total notional value of the Russell overlays and what the exposures were. So it's what market you were actually exposed to.
And would that correspond, would that number that you used correspond to the number that's on our with and without overlay reporting?
From a performance reporting from a calculation of returns? Mm-hmm. Yeah, I think where the problems come in on the calculation of returns is Boney Mellon does a line item that's doing just Russell that looks on its own, it's kind of confusing. So when it's in the total fund calculations, everything's fine. But when you look at it line item, it can look a little screwy. So the short answer is yes. Everything's fine. But we'll go back and dissect that for November, because it is, we find it confusing too, but it's all been handled correctly.
Thank you very much.
It's really all math. We just have to verify that the math is correctly done. Is there anybody here who has a doubt about the math?
No, but Andrew, if you want to make a couple of comments, because given just sort of the nature of it, you were doing an audit of this as well.
So I posted the audit report like 2 hours ago. I don't mean it to be last minute, but given the nature, we just got the HEK report. Everybody was extremely busy. I was here late last night. I promise it wasn't because of lack of effort. In summary, we evaluated the accuracy of the fiscal year 2013 proposed payout and concluded it was accurate. We did note 2 observations which did not affect the payout, but I think it's something that management, agrees with, and they'll make sure that they address the observations. I can go over them really quickly.
Andrew, can I get you to stand up?
Yeah, sorry.
Yeah.
I usually don't have a problem with volume of talking.
At least move over close to the mic. I'm sorry. Speaking to the microphone.
I'll come to the podium. Make it easier. So our 2 observations were the required time frame of 60 days in which the consultant is to provide a report on portfolio performance and compliance does not appear accurate. Within the compensation policy and the section about the PIC policy, the consultant's actually required to do the report within 60 days. Both HEK
and our former consultant have missed that deadline, it has no material impact on the payout. 60 days is a really tight deadline given the time it takes for BNY Mellon to compile the numbers. So what we're recommending is that day is extended. I think we proposed 75. That would still be in time for the commission to receive the letters, but it would just ensure that we don't want to rush the consultant to meet the 60-day deadline. Obviously, the accuracy of that letter is extremely important. The second comment is the annual process for the commission approval for fiscal year 2013, RSIC's performance award scale and maximum pick opportunity for each position classification was not clearly documented in writing. The policy, and I'm an auditor, I read the policy word for word. The policy basically says every year the maximum pick opportunity and the performance award scale is supposed to be approved by the commission. The policy was adopted towards the latter part of fiscal year 2012, which was extremely close to fiscal year 2013. And all the comp committee members I talked to, all the employees at RSIC that I talked to said basically it was assumed that was going to apply for fiscal year 2013. But technically, what internal audit would like to see is there was a separate proposal in the beginning of 2013 that said here's the performance award scale, and here's the the mathematics behind it. So. And then we do have, some control opportunities, which is that the policy is just revised in certain areas to add additional clarity, which, we've discussed with management, and I think they're comfortable with. So.
Okay, thank you.
No problem.
Do I hear a motion that we approve the supporting documentation as acceptable for purpose of the Commission's compensation policy, authorizes both the aggregated performance incentive compensation amount and the CIO's performance incentive compensation payment as presented in the supporting documentation provided in the meeting materials, and direct staff to take all steps necessary to effectuate disbursement of the performance incentive compensation payments consistent with the compensation policy as set forth in Roman numeral 7 on page 4 of the proposed motions. I so move. I hear a second. I hear a second. Any additional discussion?
Yeah, one quick question. Were there any discretionary bonuses or portions of the discretionary?
Yes, according to the chart, a number of the employees with less than 3 years involvement on the investment team, a portion of their pick, up to 50%, was based on discretion as approved by the commission. And our CIO has full discretion to determine how much of that they would earn, and he determined that all those employees earn 100% of that piece.
100 of the 50?
100 of the 50. I think in one case, of the 2-year person, it's 20%. I can get you the exact details if you like, but.
Thank you.
All in favor, signify by saying aye. Aye. All opposed? One opposed. Mr. Loftus. The next item on the agenda is, I believe, retiree representative candidate interviews, and I'm getting ready to take a break, mainly because we need one, but secondarily because we need to set up a place for the retiree representative to sit and talk. And this is an open meeting, and each representative has the ability, power, and right as a citizen, or even non-citizen, to be here. I am requesting, however, that they depart the room when the other person's being interviewed. That's the way we did it before, and nobody seemed to mind. So let's do it the same way this time. And in that regard, I'm going to say something that I've been waiting to hear somebody say all of my life as a Williams. We're going to go in reverse alphabetical order. As the retiree representative, under the law, it requires a unanimous approval of all the voting commissioners. The purpose of this meeting is to interview, and then we'll deliberate in private and make a decision, we hope, after that. Both candidates, everybody's read their information, and we'll give them a chance to talk. Technically, our governance policy says each person must be nominated by somebody, and I'm not 100% sure, but just in the interest of caution in making sure we do it the right way, I do hereby nominate both Dudley Blair and Ron Wilder for this position, so that we've covered the process of interviewing only people who've been nominated. So, Mr. Wilder, welcome. You've been present for a good bit of our proceedings, if not all of them today, so you see how we function and what we do. What makes you, in your opinion, the right person to be the retiree representative on the commission?
Thank you, Mr. Chairman. I especially appreciate the reverse alphabetical order, and I sympathize with you over your life about that. If I could just spend a couple of minutes telling you where I came from and that sort of thing, and then go on to talk about my education and experience that could relate to this position. I'm a native Texan. I was born in Freeport, Texas, which was a company town in those days, Freeport Sulphur and Dow Chemical. Small town. I lived in an age when you could, when a 10-year-old could ride his bicycle around town after dark, and parents didn't worry. It was a nice time period to grow up in. Then went to high school in Houston after my parents moved there. Stayed in Houston for undergraduate studies at Rice University through the master's level, and then on to Vanderbilt for the PhD studies in economics. While at Rice, I had acquired or deserved and earned, I guess I should say, an ROTC commission in the Army Reserve, and I was able to delay my active duty until after graduate study. So with the PhD, I headed into the Army. They didn't know what to do with me, but they fortunately didn't ask to give me a combat infantryman's badge. In fact, I went to Vietnam and was never issued a weapon. So I had rather unusual military experience, but learned a lot about cost analysis and the way bureaucracies operate in that experience. Then sought a position in higher education. Was fortunate to find one here at the University of South Carolina, where I remained for my entire academic career. So I joined the Department of Economics and what's now the Moore School of Business at USC in 1970, and then stayed until retirement in '06. I'm a retired member of the retirement system, so I meet that qualification that this member must have. I'm also not employed by state government or by anyone else at the present time. Now, what about my experience do I think contributes to my ability to do this this position as an investment commissioner? Well, first of all, I do not have a strong background in investments, in investment management, portfolio, and those things. But what I do have, I think, is a broad education in economics, an understanding of the economic environment, an understanding of risk, risk versus return, of present value, the ability to think about net present value for a project or for an investment portfolio, as the Retirement Commission, Investment Commission portfolio is. So I have a broad understanding of that. I think I'm still a good student, a good learner. I can learn the details that's needed by a commissioner about investments and about investment management as I go along. There'll be a learning curve, of course. but I believe that I can do it. I find it to be an exciting opportunity to do public service at this point in my life. It's been several years now since I was active in teaching, and it's an interesting and opportunity that I believe I could serve well in.
Okay, thanks. I'll start the question with you. All right, we're going to go around the table. We'll start with you.
Well, I've known Ron for 40 years, so I don't plan to learn a lot at this meeting, but I thought you might share some of your ancestors that were tied to South Carolina. You said you were from Texas.
Oh, that's right. Travis Pritchett, of course, is Samuel Travis, so he had some connections to the Alamo. And but my connection to South Carolina, I learned after I arrived here, is that my great-grandfather Wilder was born in Williamsburg County. And like many Carolinians, he followed cotton west and ended up in central Texas, where my grandfather and father were born. And the family learned that there were better opportunities than cotton, and they found education. And so I suppose that accounts for some of my roots in the educational process.
David, you got a question?
Well, my ancestors, my mother particularly, is from Williamsburg County also, so I'll give you a notch right there. They followed their fortunes west to Columbia, so so here we are. Now, tell me a little bit about your economic background and how, and of course, I'm a non-voting member, but I represent the PIBA, the administrative arm of the liability side of the trust fund, so I'm concerned about the liabilities and how the investment commission takes those into account in determining what investment allocations to make, what managers to choose, and so forth. How are you, the time value of money you mentioned and things like that, and the present value. Tell me a little bit about your experience with actuarial valuations or projected liabilities and things like that, and how they would come into play in your decisions here.
Yes, I'm, of course, not an actuary and don't know too much about what actuaries do other than make projections and make assumptions about the future. But what I have done in consulting is to do some work in valuation of future income streams, in which had derived an opportunity cost discount rate, project future income streams and bring those back to the present in an evaluation kind of a consulting job. So I have done that, and of course in teaching undergraduates and MBAs I've used the net present value concept in talking about the theory of the firm and what the firm tries to do.
Follow up on David's question. What's your understanding of how the system determines its liability and so on? Do you have any insight into that at all? You said you're not an actuary, but what is your understanding of liability?
My understanding about the 30-year constraint is that there is a discount rate that's been arrived at, 7.5%, and that the future cash flows on a net basis in the future, when discounted back to the present at 7.5%, should be larger than the current value of the assets, based on some actuarial assumptions and projections. And so that valuation then drives, under the current law, it drives what the rates are for the active employees and their employers, feeding into the into the retirement system assets.
What about the benefits being paid out? I mean, that's a real liability.
And then, right, and so there are positive and negative cash flows in the future for the system, and where the negative cash flows are the benefits paid out, and the positive cash flows are the future contributions, and then the earnings of the portfolio in the future.
You mentioned calculating present values. I think of what we deal with as actuarial present values. You know why I said actuarial present value instead of present value and looking at the liabilities?
Well, my general understanding of that is that we seek the advice of actuaries, the Commission does, in making the future projections involving assumptions about life expectancy and those sorts of things that affect benefits paid out and contributions coming in the future. But beyond that, I don't have any specific knowledge about, actuarial science as far as having studied it.
Mainly deals with the liability side of the balance sheet. We mainly deal with the asset side. As you heard today, we consider our liabilities in what we do.
Yes. Thank you.
Actually,
I'll recognize you for questions.
You don't have to worry about actuary. This man's going to become one by osmosis.
Boring lifestyle. How did you come to learn about this opening?
Well, I had heard that there was an opening and didn't really consider applying for it, and then apparently there was a candidate who turned out not to be qualified by residents, and so at that point Travis Pritchett contacted me and asked me if I would be interested, and we discussed it for a while. I thought about it, talked to my wife and that sort of thing, and got back to Travis and said, well, yes, I think I would be interested. He said, okay, I will nominate you. And that's how it happened.
In the whole broad world of investments, anything interest you particularly? Any type of investments?
Well, the thing that's most interesting to me as a layman in investments is what the Commission now calls alternative investments. Mm-hmm. And I've just begun to read a little bit in the finance literature about that. And there's a good bit of disagreement in the finance literature, as far as I can tell, that about whether alternative investments over the long term do better than broad index funds in publicly traded securities. So that's a very interesting issue, and I've just begun to look at that. Don't know anything about it yet, except that there are interesting questions there.
Are you a fast reader?
Not as fast as I used to be.
I'm sure you are. With your resume, I'm sure you are. You will have plenty to read, believe me.
Thank you, Alan?
I mean, just kind of looking over your list of papers, right? You wrote a couple when you were still in Texas, it looks like, on southern ports. I'd be curious, sort of, and it looks like electric utilities, right? I mean, obviously, those are two very large economic things. We've never really had an infrastructure, effort or direct effort, statewide here, but obviously those are two important industries for South Carolina. I'd be curious, any thoughts on the roles of pensions that are buying infrastructure assets, trying to play in these highly regulated markets, nuclear. It looks like you wrote a lot of stuff on nuclear, but outlook for those.
Yeah, I think the concern about nuclear is the risk of bad things happening that can't really be based on past history. For example, Fukushima, and that makes it a very an investment, say in the sort of firm that has that's building the AP 1000 reactor in South Carolina. to invest in them, I think, has risks that are very hard to evaluate. The port and the electric utilities, I did while I was here, did a study for South Carolina ports and looked at their economic effect on the state. Interesting thing at that point was to see how widespread the effect of the port was, not just the Port Charleston area, but especially the Greenville-Spartanburg area, big users and beneficiaries of the port activity.
Well, obviously, a lot of what we're concerned with is things like asset allocation, and which are very intimately related to what happens in the world of economics and finance. Do you follow things like the Federal Reserve or their actions? Obviously, it's quite a topic of discussion presently. Do you have any depth of knowledge as far as that area of investments? And obviously, you said you didn't have a lot of experience in investments and finance, but certainly that's an area that we're very much concerned with.
Yes, well, I taught open market operations and that sort of thing over the years. But to me, the really interesting thing right now is that we've been in monetary stimulus so long, and it's so deep that excess reserves in the commercial banking system are over $1 trillion. This is money that could be loaned but hasn't been loaned. So the so-called liquidity trap we're in, and how long is it going to take to come out of that? No one knows. And Mr. Bernanke is not telling, except that it'll be the next time or the next time after that. And so this creates a lot of risks for portfolios, because it's another risk that can't necessarily be judged on the basis of of past variance and covariance. Such a big action by the Fed. I think it was needed, but we don't know much about how it's going to unwind and what effect that will have on the markets.
Just along the lines, you also mentioned you were interested in risk. Given the aftermath of the financial crisis in 2008 and what happened with the banks and subsequent actions, do you think that the banking system is in the kind of shape now that could withstand that kind of stress again?
I don't know. I see arguments on both sides in the press and on television, and I don't know. I haven't studied it closely.
Okay. Let me ask my one question. You've talked about Travis and you've talked about Williamsburg County. Other than that, do you have any business, family, or other connection with any other commissioners, or have you talked to any of the commissioners about what this position would entail?
No, I have not, other than speaking with Travis. I came up to the commission offices one time and spoke with Derry Oliver and got to meet him, but I haven't spoken with any other of the commissioners until today.
Nothing wrong with it if you had. I just would like to get that out on the table. Rebecca, go ahead.
I think one of the things that you will do a lot is collaborate with the staff and work with them in a variety of searches for managers and other sorts. And I know personally it has been an opportunity for me to learn a lot from them about some of the investment classes, as well as what exactly they do every day. So I guess just more a general question. I know you've done a lot of teaching and worked with a lot of students, but your sort of general philosophies on the positive aspects of collaboration, and what do you do when you get to that point that you may have a disagreement or can't reach consensus with the people that you're working with?
Yes, I was a department chair in economics for a number of years, and so in that role, I tried to build consensus, and when consensus wasn't reachable, something would happen one way or the other, and it's sort of hard to describe how the outcome is reached if there can't be consensus. And of course, department chairs have somewhat more power than faculty in that they can set teaching loads and compensation and that sort of thing. But if I'm selected, this commission is quite different than an economics department.
Well, didn't you have some weird professors at times? I was on the other side of the hall, from you, but it seemed to me that it's probably a little different in some of the people you dealt with. I know when I was department chairman, I think I spent 80% of my time dealing with the three out of the 20 faculty members. And so you do deal with these problems that Rebecca's talking about.
Yes. We called them high maintenance faculty, in that they took more time, and they sometimes had to be forced to do things with whatever tools the chair had.
We're about running out of time, but I don't want to cut off any commissioner. If any commissioner has a question you want to ask, we've reached the allotted time. And Ron, I want to give you a chance to. Is there something you wish we'd asked that you forgot to say that you'd like to conclude with?
Well, again, it's an honor to be nominated and to meet some of you so far, and I look forward to the possibility of doing this full time in the future. And I can certainly stay around all afternoon if the commission wishes. If not, then I'll just head on back to the home office.
You're certainly welcome to stay, but I understand the compulsion to go, and that's what I'd do if I were you.
Thank you.
Welcome, Mr. Blair. Let me ask the same question I asked Mr. Wilder. Tell us why you're the right person to be our next commissioner.
As a retiree, I obviously have a vested interest in the success of this commission and of the investors and the fund. As an economist, I have a good broad view of what's going on in the economy and the world. I keep up with things as much as I can, and I hope that my perspective could help the commission in terms of looking at major trends in the world and major trends in the economy.
Okay. I'll start with Travis, just like we did last time, but this time I'm going to come counterclockwise.
I'll ask simply because it ties into one of the questions that a previous person got. How was it you learned about this opening, and who approached you, and so on?
A member of the Employees Association, Retirees Association, excuse me, suggested to me that there was an opening and asked if I would please consider it as representing retirees for the state, knowing that I was an economist and a friend from the university, from Clemson University. Just mentioned that and asked that I please put my name in the hat. And I said, well, I'll certainly consider it. And I did a little digging and spoke with a few other people and said, well, okay, given that, as I mentioned before, I obviously have a very vested interest in the outcome of the commission's work, I would love to be part of the commission.
I will ask my same question. What actually I think is it's more of a touchy-feely question, but one of the things that you get to do on the commission, besides just making investment decisions, is actually working with a lot of the staff, which I think has been really invaluable to me, getting to meet them and learn a lot from them actually, and understand what they do on a day-to-day basis. And so I guess just more as a general question, what are your thoughts on collaboration and working with people and the benefits of that? And then and what do you do when you reach a point with somebody that you're at a stalemate or a disagreement, and how do you seek to overcome that?
Politics. As a manager in the past, I've worked with many employees, but as a faculty member and committee member on many committees, I have had a lot of interaction both with committee work as well as with people working with me, for me, and those that I worked for. So just 33 years of experience at the university, with all of the politics that go on at universities. I have had a lot of experience, almost all of it positive. I have rarely had any problems with either employees or committee workers. So just a lot of experience in working with organizations. Have been president of a Sertoma club a couple of times. I've been in organizations that are civic organizations that work with public groups and raise funds and things like that. So I've had a lot of experience working with people and getting along with people and solving conflict. So I also work. I say that very loosely. I almost volunteer. Clemson has an outdoor laboratory where we have it's called an outdoor lab, where we have a organization called Team Ventures, and we have a high ropes course, a climbing tower, and we have groups everywhere from grade school to corporate groups come out, and we do team building exercise with them. So working with them on conflict resolution is part of what I do on a very part-time basis, maybe once or twice a week, but it's something that I do just for play. It's fun to do that as opposed to working for a paycheck. This is just pure fun.
What if any, prior family or business or social or political or what kind of relationship do you have with any of the commissioners?
With this commission?
Yes.
None. I know no one on the commission, except I may have met Travis once in the past because he was directing the MBA program, academic director of the MBA program at USC about the same time that I was directing the MBA program at Clemson. So we most likely have met. Face is familiar, but that's about it.
How about once you decided to apply for this position? Have you had any conversations with any of us?
None. Other than none of the commission, no.
That's right. I mean, commissioners, I know.
Yeah, staff that contacted me about the meeting, that's all.
Okay. Ed?
What do you think the biggest risk is in investing in the markets today?
Well, the biggest risk I see in the economy going forward over the next 5 to 10 years is inflation and adjusting for that, because I seriously think that once the Fed finally pulls the plug on all of the subsidizing that they are doing, on the money printing they're doing, that we are going to have some serious problems down the road with inflation. They pump so much money into the economy that it is going to come back to haunt us. So accounting for inflation is one of the biggest risks that I think we have going forward, and dealing with it in the economy.
Do you think that there is an inherent conflict in the present mandate that the Fed has between maintaining full employment and stable prices with the Employment Act of 1946. That will be a hot topic of discussion, but do you feel that there's a conflict?
Yes, I do. The Full Employment Act is another potential problem down the road. It depends upon how Congress implements how future executive branches treat it. But I do think that there's going to be problems in trying to lower unemployment below a reasonable level. And of course, that will be a while before that we get to that point. Obviously, we're still at a higher unemployment level than is generally acceptable, but I can foresee a problem of trying to drive the employment rate below 5%, which is something that is not sustainable in the long run in a growing economy.
Thank you.
Alan? And again, kind of looking back over your papers, I mean, you wrote, it looks like a cluster of them kind of around the 1990 recession, around S&Ls and banks and profitability and capital allocation. I don't know if you were here earlier on ours, but I'd be curious what your thoughts were on our capital allocation. It also looks like you wrote several on the financial services market structure, which obviously is changing quite dramatically right now. So I didn't know if you were still interested in those topics, but if you could just come in on our capital allocation and market structure.
Right. I have not been. I have not kept up with the S&L industry in the last 20 years or so. That was something that I did when I was regularly teaching money and banking. But to be honest with you, I went into administration at the university, and I did not have time to keep up with my research at that time because I was both associate dean as well as running our MBA program. So I let my research lag. So I did back off on that, to be honest.
Presumably, you were looking at a lot of the ones that sort of failed around that period. Why? I mean, any opinions or sort of lessons about why they failed in their capital allocations?
Well, what we were researching was expense preference behavior and looking at the reason why the S&L industry at the time had incentives to spend more than they otherwise would have, and so expense preferences, reasons that drove them to have higher expenses than they otherwise would. And so that's what we were looking at, those that failed, to see if expenditures and a inherent way that they were structured at the time was a reason why S&Ls were failing. So many S&Ls were failing at the time, and so that's why we were studying the failing S&Ls.
I see your dissertation advisor was Phil Graham. Senator Graham?
Yes, that's Senator Graham.
He went? Of all the big basket of investments that are out there that we regularly invest in, what interests you the most? What type of investments?
Investments in real estate, watching the real estate market. I've watched it closely, but real estate investment trust, watching them change over the years, has been something I've tried to follow fairly closely. In addition to that, I have tried to keep up with the banking industry and what's banking as well as savings and loans a little bit, but not from a research standpoint, just watching what was happening in that area.
Dr. Blair, and I'm David Avent, and I sit on this body as a result of my being the interim executive director of PEBA, which, we administer the retirement system, which you're a beneficiary of. So we're on the liability side. This commission obviously deals with the asset side. Recently, our investment advisors performed an asset liability modeling, and then that helped shape the asset allocations, the recommendations that they made, and this body approved. What do you? First of all, tell me, kind of your understanding of the liabilities faced by the system or by the trust fund, meaning the requirement that we're going to pay beneficiaries that are now retired and then in the future retire, and how that should affect your how this body should invest going forward.
Well, I mean, trying to keep the system, trying to keep it liquid, not liquid, trying to keep it, trying to look for the right word, invested well enough, securely enough to be able to make those payments and yet grow it slowly enough to hopefully fund to account for the unfunded liabilities that are there. Because I know that in the last few years there have been some members of the legislature, including a friend of mine who is an economist from Clemson, have called for some substantial changes in the system because that it's just not going to work out. We're going to fail. We're going to, and so there have been calls, I know, to reduce the payout of and to increase the contributions of employees. So, I mean, it thrills me to see the investments actually grow and actually increase the assets each year. So it's just a matter of, I know that there have been relatively fewer employees who have chosen the South Carolina employment system if they had an alternative at the university level. Many of my colleagues at the university have said, I think I'm going elsewhere. So what scares me a little bit is down the road, those that have that option, in particular faculty that may have that option, and people that unlike the staff and regular employees that don't have that choice, if they go elsewhere, then we're going to have smaller and smaller income coming in, contributions coming in, and at some point there may have to be an adjustment to the amount paid by employees. I hope that's not the case. I hope that the retirement system investments can keep up with the liabilities that appear to be not growing as fast as they have been in the past anyway in terms of number of people in the system. So unfunded liabilities, I'm aware that is a problem. I just hope that that the Commission is able to invest wisely enough to grow the assets fast enough to keep from having to make drastic changes in either the contributions or in the payouts.
Travis, you got another question? Any other commissioner have another question? We're close to time, but we still got a little bit of time left. Do you have anything else you'd like to say, or answer a question you wish we had asked, or some closing remarks?
No, I just apologize for my appearance. I managed to take a tumble on Monday morning and mess up my face and break my nose and break off a tooth. But anyway, I managed to mess up my face a little bit. So if you look at me up closely, you probably see some pretty bad scars there, but they'll pass.
I wish I could say the same about my face. Thank you for coming.
Okay. Thank you.
Next agenda item would be the opportunity to ask the treasurer questions about the status, prospects, et cetera, of the settlement with Boning. Ed, you want to start off?
Well, I guess we've had some questions that have come up prior to this, and I guess we're still awaiting some answers. But are you now at liberty to give us a fuller or a more comprehensive report on the settlement?
I believe so. I mean, I don't know what you want to ask, so I mean, I know the answers.
Well, I think there was some discussion about the legal fees. And did you finally arrive at a final amount that was to be paid?
That was in the original settlement agreement, wasn't it? All right, let me find my papers here. I believe that's been known since day one, right?
Perhaps, all right, maybe I was not clear, but was it $7 million or $9 million? I couldn't.
You know, I don't know, but I've got it here. You're ahead of me on getting to my paper here. Where's this? It's not on here.
My recollection is that $9 million was the largest, but $1 million of that roughly was cost, and it's about $8 million.
Where's that go to? Yeah. I mean, all that's been in the original settlement since day one, and y'all were given that. In fact, Ms. Diddy took it from the courthouse the day of.
How did you calculate?
We took the Attorney General's scheme, if you will, and applied it to approximately $72 million. We weren't able to use all of the savings. I tried to get all the savings in it, but we got all of the cash and part of the savings, and that's what it came out to.
I guess the meat of my question. Where's that $72 million? Where does that figure come from?
$72 million is part of the savings. If we utilized all of the service credits, back up a little bit. Of course, we went to New York, and late in the day, we got closer and closer to settlement. We finally got where I figured I thought we could settle at, which was the $25 million plus the $1.5 million. And then we started pounding away on what else we could get. You know, I was prepared to take the stapler off the table. I wanted everything I could get my fingers on. We worked up these credits that have been talked about with different services that the bank has. Those are all I had to negotiate with because that's all they have. I couldn't negotiate rental cars because they don't sell rental cars. So we negotiated these service credits, and the total value of those could be up, depending on our level of usage, $105, $110 million. It just depends. So, of course, I asked for fees on top of for the 100 at the top range because we had already settled our case. Our case was done. Not one penny of these legal fees came out of retirement money. That case was settled, done, but slammed our hands on the table long enough, fought like cats and dogs. We got that money. In fact, we left the room, then came back for a second session. And again, it was the same theory as the first time I was in the room. I was trying to get as much as I could with the leverage that I had. And that's what it came out to be.
Did you have a schedule or a written thing showing how you came up with the 72?
It's been on my website. It's been on my website for 2 years.
For 2 years?
Yeah. We put as soon as I took over the lawsuit, you know, the suit was filed by previous treasurer, previous attorney general, and when I took over, we made sure to put all the information on the internet, including the retention agreement.
Well, how did you know 2 years ago what the value of the settlement was going to be?
Oh, I'm sorry. I thought you said well, we figured it up. I mean,
who figured it up?
I mean, we did. It was just, I mean, we took mathematics and figured it out. I mean, y'all can do the same thing.
Where did you get the data to do the mathematical calculation? Did you take that figure from Bank of New York, or is it some consultant who looked at it?
No. Well, this was all done, you know, this is a settlement. You're a lawyer. You probably, you know these cases. People settle cases on the backs of cars. They settle them in handshakes, all sorts of things. We were in there arguing about what the services were worth, and that was what we came to. We weren't able, if we left that room, we wouldn't. If we had gone home that day, we wouldn't have settled the case.
Well, I understand you agreed to the settlement and you agreed to the attorney's fees, but my clients always want to know what the value of the settlement is, and somehow you have to come up with a valuation for the settlement.
We did. And I told you that. I don't know how else to tell you. I mean, you
Oh,
can do
$72 million.
Yeah,
But
you can do
You don't
the
know
math.
where that came from?
Yeah. Well, let's see.
To us looking at it and to the retirees looking at it, it looks like it was a $34 million settlement. $25 million cash to various people and $9 million of lawyers, $34 million. So where's the extra $38 million?
It's the service credits. It's the credits.
How did you compute that then?
Well, I mean, Reynolds, I don't know what to tell you. We had the cost of the services, such as if you each hedge mark at $3 billion, what would be the value of that?
$3 billion?
And that's what we did.
Over what period of time?
I don't know.
Did somebody compute these things?
Yeah, we did it when we were in the room. I mean, if you'd asked me for this, detail, I could have gotten into detail. But
we asked you, the lawyers for it.
Well, but Reynolds, here's
we'd have it 4 months ago, and we still don't have it.
Well,
we do not have it. And they say it doesn't exist.
Also, I guess the other question I would add.
Would you rather I not have paid the lawyers? Is that what you're saying? Would you rather we didn't get the severance credits?
I'd rather you be able to explain to the retirees why you paid the lawyers what appears to be $4.5 million more than they earned.
I didn't. We paid them. We were able to secure a payment. Unlike the securities litigation here, where the money comes from, the security, the interest of the retirees, this was paid after the retirement case was settled. It didn't affect the retirees one bit. This was their settlement was done. It was finished. We went back and asked for a settlement again. I mean, for the lawyers' fees. And we had to attach. We had a certain amount of time.
So you're saying that $9 million came out of Bank of New York's money?
That's exactly what it says.
Retirees could never have gotten any of it?
That's exactly what it is.
And if the Bank of New York said, we're not paying the lawyers, that would have been fine with you?
No,
it would have been fine with your lawyers?
It would not have been fine, but that's the way I did it.
To the retirees that I talked to, what it looks like to them.
But to the retirees,
is it every dollar that went to the lawyer is a dollar that could have gone to them?
Well, and you have
if
done an
they're
excellent job of spreading that, but it is not the case. You have the settlement agreement here, and you're a lawyer, and you ought to be able to read it and be able to explain
I can read it, but
and what
I
we
can't
did
tell
is
what the value of the settlement
and what we did was because it was outside the settlement. It was outside the settlement, and the Attorney General, the State Treasurer, and the judge, and the two parties involved, especially the people who were paying the fees, all understood that, and it's in writing. And so we had to come up with the fees as best we could.
So are you unable to tell us how the fees were calculated? And do you expect to never be able to tell us that?
No.
When will you be able to tell us how the fees were calculated?
Well, in the first place, I'm interested in several things here. And it's, one, how long we're going to go on with this. We keep asking the same questions over and over and over. And I'm more than happy to give you this stuff. But when you talk about the retirees, I've probably given 150 speeches since I've done this. I've yet to find a retiree to ask a question other than those three right there and you. So I don't mind answering these questions. We gave the settlement information the minute we got it. We put everything we could online. No one could have been more transparent. And you knew it when you asked me questions the first time that I was forbidden to speak about it, and yet you did it anyway in an effort to generate the news story, which you got. And you've been doing that ever since. Now, I'll tell you how we generated these fees, which you could easily do, $5.2 million is what we apportioned to HedgeMark.
Okay, when you say, okay, tell us about that.
Well, 10 years, that's the savings. If we put $3 billion as an annual credit to 20%, equals to $5.2 million.
20% of what?
Of what the fees would have been.
What would the fees have been?
Well,
20% more than 5.2 million.
Yeah, you do the math.
Say that again.
20% more than 5.2 million.
Did you apply a present value to that?
I'm not sure. I mean, it's so easy to sit around. In fact, Reynolds, when you wrote in the Greenville paper, you said to the Greenville editorial, you said, it's so easy to sit around and ask questions and it serves nobody. You know exactly how this was done. Your lawyers have been briefed. You've been briefed. The commission's been briefed. We've got these numbers here. But this was done in a heated pitch battle between the Bank of New York and the state of South Carolina. And if we had waited till everything was buttoned down by
by accountants and CPAs, we would have never closed. We did something. Converse Chellis and Henry McMaster started a case that this place didn't want anything to do with. And we brought back and put $20 million in the retirees' pockets. And it's not happy. You're not happy, and those 4 people there aren't happy,
20%
but everybody
of
else
$5.2
is.
million is $1 million. Tell me about the rest. This is the first I've heard any of these figures. And I think the lawyers and the people that in the briefing will say this is the first we've heard any of these figures.
Of course, after the retirees had been made whole, or not been made, they had received as much money as we could get for them, we did this. There was, let's see here, securities lending, the split, the increased split, 90-10. That was valued at about $2.5 million a year.
$2.5 million a year?
Mm-hmm.
I thought we were only paying. How much are we paying a year, or getting a year for paying a year for securities lending?
Paying?
It's all captured in the split back to Bank of New York.
Well, roughly how much is it?
The past 4 years, I think it's averaged, and this is to pick up custody, securities lending, ancillary services, the whole thing is, I think, on average $300,000 a year.
But not 2.5
for the past 4 years.
So were you
$300,000?
Had you been there? Would you been buying or selling? Because I was selling, brother. I was selling. I was trying to get as much money as I could, because that was the whole point of me going to New York. I wasn't going to New York to give money back. What we talked about when in this conversation was rates are going to go up. We're going to have to pick an average, and this was the average.
I don't know what you're trying to do. I just what I'm.
Yeah, I know exactly. Everybody in this room knows what you're trying to do. And so if I'm supposed to apologize, or if you need me, this is what we should do. Next time the time you go to argue a case and a settlement, if you need me to come and argue for your fees, I'd be more than happy to do it.
You're welcome.
Because I can tell I'm going to do a better job than you are.
Precisely how they were calculated.
If you're going to give that away for $300,000, I got $2.5 million.
My clients get every lawyer gives a client a calculation of the fees to show.
Well, I'm not the lawyer.
To make sure
I'm the state treasurer. I'm not the lawyer.
Yeah, but did these guys work on an hourly basis, or did they just simply say we're going to take a percentage? I mean,
it's a percentage. It's in the Attorney General's payment scheme, which was on my internet for 2 years. Ed, go take a look at it. So,
Can I offer a suggestion?
Yeah.
Because, and I certainly hope there, we don't get into, undue animosity here. I think the treasurer is saying that he's able to provide the details of the list of the value of the services on which the attorney's fees were based. Let's face it, that's one question that's been asked. It appears like he has the list. It's clear we asked for that, and we asked the attorneys months ago, and I guess it's, that was long ago.
I can't give the written list because
but
of
I
the Bank of New York.
If your staff could give us, or your attorneys in a private session could now give us these details, I think that would go so far under transparency to answer these questions, because, I mean, let's face it, the staff gets asked to justify, why do we pay this many fees? What was the calculation of fees? I mean, it's simple. We all know what one of the questions
just ask about fees today.
No, there has been. Yeah. You're reading numbers off of a list. It would be nice to get an Excel file, which you have excellent staff that could give us, that would list line item. Here it is. Here's the number and a note.
I can't
Here's
give it
how
to you
it's
in
calculated. Just like we presented all day.
The Bank of New York will not allow me to give this.
Even in an executive briefing.
I thought you said this had nothing to do with the settlement.
They have future litigation, and that's all I'm not a lawyer. Why don't you go over to the Attorney General's office and ask to talk to him? He'd be more than happy to talk to you about it. He approved all this.
The Attorney General's office told us in a meeting in the room, in the presentation room down below, that you approved the fees and that they didn't know how they were calculated.
Well, their man was in the room.
Their man was in the room.
Yeah, he was sitting right there, and he was pounding the table with us.
Was correct.
He was pounding the table with us.
The
when we
treasurer
came back,
and his experts told us what the fees should be. But if you'll furnish the list to the commission, let the staff.
Bank of New York won't let me furnish this because this was included in the whole. We are in litigation now. The attorneys can talk about that.
Can I just ask a simple question that gets us to the practical matter? Right? It's clear the settlement numbers are some portion of cash and some portion of other discounted future services, the value of which is unknown. Right? And one of the big questions, right, is lawyers took all the cash because future value, discounted future value of unknown services doesn't have any value to them. Right? Mm-hmm. Whereas if they'd taken their payment in kind, right? It would have been.
They'd be getting dribbled out over the next.
Or they might not get any cash.
Or they
That's
might-
right.
And we
If
cap
don't
them
use
out
the
and they're
services,
gone. So
right?
we're able to cap them out and they're gone. Whatever we use, they can't get any more funds.
So I guess my only question, I mean, goes back to, what's, and this is a very, very practical, real question. I mean, back to risk systems and stuff. I mean, given we have procurement laws, right? I mean, how even applicable are, some of the, I mean, there's real stuff we could use tomorrow, right? We could sign for tomorrow, right? If we don't run into other procurement problems, right? I mean, I don't know. Are we going to be able to go back and reclaim the cash? I mean, I don't.
Which cash you talking about?
I don't know.
What the-
I mean, I'm assuming he's talking about some half of
the $20 million is here.
Well, I know. I guess he's talking about some half of the.
Oh, I don't. He's,
legal,
he's made
right?
it up. I don't know what it
Because
is.
if legal fees were just based on actual cash receipt versus some discounted future thing.
The legal fees were settled after the fact. And to be quite honest with you, I felt very pleased that I was able to get as much money out of them as I could. And because I didn't think I was going to get that much.
Right.
But I thought I did a really good job, and I'm happy about it. Now, it's politically expedient for him to drag this out and all that. And,
Oh, well,
you
let's
know.
not get into political expediency, please. Let's let that dog die.
Adam,
Yeah.
in answer to your question, the legal fees were not based on cash received. If they'd been based on cash received in the contracts, the legal fees would have been around $4.5 million.
Right.
If there's only cash.
Right.
Only cash.
So they were
but that's
based
not
on
part of the
cash
scheme.
plus the value, whether
Yeah.
it's mythical or unknown.
Which we could
future
get.
services.
We could have all of those. And if I could listen, if I could have got them on how many parrots were sitting outside on the porch, I would have gotten paid on that too. I was arguing my side of the case. That's why I went there. I didn't go to give away money. I came to get money. We got as much as we could for the lawsuit. We did an excellent job for the retirees of this state. We were lucky to have gotten that. We moved on after that. We went outside. We came back. We did the best we could for the lawyers. With that, and I'd have gone back again if I'd had to go back. I don't apologize one bit. You've just done an excellent job of taking advantage of the situation. But the retirees I've talked to all across the state are very happy about this. Most of them don't care, but when I talk to them, I'll bring this up and talk to them for 15 minutes or 20 minutes in a speech, and they listen and they like what they hear. So, we can go through this. The commissioners, we'll sit here all day long.
So I take the bottom line of what you're saying. We did not expect to ever get an explanation of the $38 million in value you perceive there to be in the
I just told
services.
you don't have a pencil? Here, get a pencil there.
You told me about 20% of $5
Yeah,
million
well, I mean, there's a
is $1
list
million,
here,
and you told
but we
me
got-
about
we
a
got
savings
stuff.
off of a $300,000 a year expense.
And if you want to penalize me for doing a good job, go right ahead.
Well, let's at least get the
Yeah.
minutes.
Well, yeah, let's go. I mean, we'll go through the list. I'm more than happy to do it. Let's see what this one is. Look, the $1.5 million in cash for training, which, by the way, I thank you for. You don't want your people to get any of that cash, so we won't. The PIBA and the Treasurer's Office will use that money for training. Let's see, documentation cause an aggregate cause an aggregate amount. Oh, that's just, I was trying to, $25 million was just in the settlement itself. Let's see, 5. 25. Is that it? That goes
on that.
Oh, hold on a second. Yeah. 5. Okay. Oh, yeah. Yeah. All right, here we go. I'm sorry, I was only reading the top numbers. Believe it or not, I've kind of moved on from this. Got other responsibilities. Okay, we'll start at the top. If we got all day, I got all day. Let me do this properly. So $5.2 million went back to the local government investment pool of the Treasurer's Office. The Treasurer's Office did not get a penny of any expense. Every flight we took, every lawyer we hired, everything we did came out of our general budget. We didn't get a penny. The 5.2 went back to the local government investment fund, which is the school system of Florence.
Is that part of the $25 million cash?
That's part of, no. Oh, that's part of 25. So we're going down the whole list here. Securities lending is between $2.5 and $10 million. There's a range because we didn't know how nobody can predict the future. We did a range, so we took between 2.5 and 10.
And that's the change going from 15 to 10?
That's right, the 90-10. Which, by the way, we got them to do that immediately. Or you actually. So, HedgeMark platform is between $20 and $50 million. Depends on how much money we put on that. I think we used the value of 35. It's $150,000 a year, which is $1.5 million, which was cash for training. It's $25 million in cash that went to investment commission.
20.
And the capacity associated with fund those. Okay. What's that come up to? Documentation of loan parties causing arguments. Okay. What's that equal to? Is that 78?
86.7.
Yeah, that's 86.7.
If you're using high range on securities lending fee, 78 if you subtract that out.
Mm-hmm. Anyway, I think it was between 72 and 78 because I couldn't, I tried for the highest range, but they beat me down. So that equals between 78 and 101, depending on which range you have there. And that's how we did it. It was as simple as that. And I felt pleased when we left there on both accounts. I'm proud of it. I mean, there's nothing you can't pick there. As a lawyer, you can pick all you want. But this is a case that the commission said they'd rather not file. 2 state officers before I came along filed it, and we did the best we could with it.
Okay. Thank you for that explanation. I'll get staff to look at it and see if their reaction to the evaluation. At least we got some figures to work with now, which we've never had before.
And so your argument would be that you think lawyers should get less even if it didn't cost anything from the retirees. That's your argument?
My argument,
we shouldn't
my
pay unless
argument
it's
is
cash.
that if you claim that a settlement has a $72 million value, you ought to be able to explain how you got there.
And it just did.
And you ought to be able to put it in writing. That's my only argument. And that the
Can't put it in
retirees
writing.
are entitled to know that.
Yeah.
That's all. I think your lawyers did a good job for you.
Thank you. They wouldn't think that. But that's what you put them through. They wouldn't think that at all. In fact, nobody in my office, the Attorney General's office, Bank of New York, anywhere thinks that. You've made a great hay out of this. And it's been a very, very good effort on your part. And in fact, as a politician, I have to sit back and admire how well you've done with so little.
That's really out of order. I'm not a politician, and just trying to get straight answers to the question is certainly nothing to be ashamed of. That's part of my fiduciary.
Are there no limits to the hypocrisy that I hear in this room?
You're frustrated at all that you couldn't when you tried to force me to speak. When your own legal counsel said so. When the own commission said go to the executive, you're frustrated everywhere. You overruled the whole entire commission. And of course, not one commissioner said anything, but we voted to go into executive session so this could have all been taken care of. And you said no.
That's just not true.
It is true.
You did not cast such a vote.
We
It's
did
just
too.
not true.
We did. It's all. I got it on the video. We'll watch it.
Okay. Put it up there. We have equipment.
I don't have it with me. Sorry.
Well, the minutes don't reflect that we had a vote to go into executive session. I can't overrule a vote to go into executive session.
You certainly did.
I did not.
Okay.
All right, that concludes that. Does anybody want to go into executive session? I promise not to overrule.
Yes, we got to go into executive session. You remember that, don't you? Yeah, of course you went into executive session. When I bring that back, we'll get to play that next week.
We got some pending matters to cover in executive session, so we might as well go in there and do it. By unanimous consent, we're going to go into executive session to receive legal advice, discuss personnel matters, and discuss investment matters pursuant to South Carolina Code Ed 9-16-80 and 9-16-320. We can't do it by unanimous consent. I have a motion. Ed, I second that motion. All in favor say aye. Ayes have it. We're back in session now. The commission did not take any reportable action, but we did take 3 votes which pursuant to the code 9-16-80 and 9-16-320 will be publicized when and only when doing so would not jeopardize the commission's ability to achieve its investment objective or implement a portion of the annual investment plan. The other order of business that we discussed was the election of a retiree representative. We did not take a vote in executive session, so we now need to take a vote
in public session. And first, let me do a poll of the commissioners, one by one. Since the statute requires it be unanimous, I think it's necessary that we make it crystal clear that it's unanimous. Dr. Pritchett?
My preference is Ron Wilder.
Rebecca?
Ron Wilder.
Ed? Ron Wilder. Alan?
Ron Wilder.
Curtis? Ron Wilder. It is unanimous. Dave has no vote, but he gives a solid endorsement to the unanimous vote of Ron Wilder. That's what I just said. I do vote for him.
Okay.
Now, do we have any unanimity on whether to repeat, or what do you call it? Adjourn or not?
So moved.
Second.
You wanted to repeat?
I was like, I got that. We are adjourned.
Okay.